going into which stocks were hurt the worst, it was pretty much across the board. Suffice to say, anything which needs great imports, for example, aerospace and aviation stocks are in a huge peril right now because a multitude of their parts are imported. The Nikes and the Adidas of the world, as expected, in a lot of pain. Bond yields plunged to the lowest level since October 10th. Since October, the 10-year was at 4.07%. Several nations have responded with retaliatory tariffs. There's Canada, the European Union, a whole host of them. So you're going to see that getting updated on, and which is adding really to the concerns and fears. Oil prices have plunged despite key producers, and because of key producers hiking output, the Brent is below the $70 mark. Asian markets have opened deep in the red as tariff turmoil takes over. I want to pull up the implied open for you in India and just focus on what India is going to look like this morning. It's going to be another weak start. We had a weak start yesterday as well. But what was interesting is yesterday we had some extent of recovery. Could you see that today? If you see any kind of, I wouldn't say silver lining, I would say green on the screen, it could be because of what Trump is saying. And now here's the tricky bit, because the White House and White House officials come out and say that the tariffs that they have announced are not a negotiation tool. And then just a couple of hours later, aboard Air Force One, Trump says he would be open to tariff talks. Listen in.
You know, it depends. If somebody said that we're going to give you something that's so phenomenal, as long as they're giving us something that's good. For instance, with TikTok as an example, we have a situation with TikTok where China will probably say, we'll approve a deal, but will you do something on the tariff? The tariffs give us great power to negotiate. Always have. I've used them very well in the first administration, as you saw, but now we're taking it to a whole new level because it's a worldwide situation. And it's very exciting to see.
Yeah, and in some sense, some of this give and take would happen because the EU, for example, has retaliated very, very strongly, right? Macron saying that let's not have European Union companies invest in the US any which ways. I mean, the statement as it was quoted was that what would the message be of having big European players that invest billions in the American economy at the same time that they are hitting us, which is very, very strong. The outgoing German Vice Chancellor saying that last night's decision is comparable to the war of aggression against Ukraine, and the magnitude and determination of the response must be commensurate. So there is some strong words coming in, and it almost seems a given that there will be some to and fro, independent of what statements the White House makes, in the immediate aftermath of this not being a negotiating tactic. So you're saying negotiation, not retaliation, is what we will see.
No, the worry...
Because people are... Sorry.
The worry here is, okay, look at that, right? So India, we pointed this out, 13% is the weighted average rate. For the EU to the US, it's actually 5%. It's much, much low, and it's effectively taking, as we heard yesterday, taking the axe to trade that has seen tariffs come down over the years and free trade being encouraged, that puts paid to all of that. And so what was made, the point that was made yesterday, does this mean that people will not step onto the negotiating table? Is it too strong a move by Trump? That's the point.
Yeah, all right, let's take that question. You know, I think one interesting nugget that I found is a claim that these tariffs have been generated, the tariff price on which the retaliatory tariffs have been announced have been generated by AI chatbots. And people did this whole exercise where they went to 3 or 4 chatbots and asked them, what should the right tariff be? And it gave the exact same answers of what we're seeing. Steve Englander of Standard Chartered Bank with us this morning. Jonathan Barrett, ETO Markets with us this morning. Welcome to both of you, and thank you so much for joining in as we try to make sense of what's going on. Steve, I'm going to come to you first. Do you think a negotiation is what happens next, or we see a deepening of these tariff salvos from either side?
I think some countries will negotiate. If you're a small, relatively poor, middle-sized country, I don't think you're going to take the risk of, trying to retaliate and hoping that that kind of works as a strategy. As mentioned earlier, EU, even Canada, that does a lot of trade with the US, there may be more leverage. And the possibility for, regions like the EU to retaliate may have been enhanced by the market reaction that, if the EU retaliates and the US comes back and counter retaliates and markets drop another 5 or 10%, I think the US will get the blame rather than the EU. And that's probably something that they would want to avoid. It's a marginal thing. It's, obviously if they were really concerned, they wouldn't have done this in the first place, but it may make them a little bit more cautious in the next round.
And I want to come to you on this because ultimately at the end of the day, what a lot of people are talking about is the ultimate impact of tariffs, which is that US consumers will eventually have to pay more. And what is said often is that when two elephants fight, the grass suffers, right? So will at some point sense prevail is the question that a lot of people are asking right now.
At some point, all my forecasts.
Sorry, that question was
right.
for Jonathan.
Okay.
That's all right.
I'll just finish with
Thanks,
At some point, all my forecasts will be right, but that point may be far, far away from now. Over to you, John.
Okay, thanks very much. No, that's okay. Look, at the end of the day, yes, it's going to hurt the many. I think one of the big concerns we've got is we've all of a sudden sort of got increase in prices. We're also coming in, remember, on, inflation expectations sort of going out for 5 years. Consumer confidence, company confidence in the state has all fallen off a cliff. So we're dealing with a complete dynamic where people are seeing this as being a negative rather than a positive. If it was a positive, prices and equities would go higher, but they're not. They're falling. They have been falling for quite some time. So I think if Trump's out there to say, let's come to the table and negotiate, some countries are going to say, well, we're not. We're just going to retaliate. And I agree with Steve on what he said. This doesn't need necessarily fall back on the states. It might fall back on the states if people say, well, you called this and all of a sudden we're in a trade war. But one thing I will impress is that it's now opened the whole globe to renegotiate supply trade dynamics. And to me, that's a big important thing. We're going to be out there trying to find new markets for our goods.
Okay. Jonathan, and of course, good morning and good evening respectively to both of you. But what happens as a result of the deflation in commodity prices, for example, because a lot of people are taking heart from the fact that there will be some straws to clutch in. I mean, if crude prices come off the way they are, do some of the oil importing economies and some of those countries benefit tremendously. Now, if in the best, or rather, okay, let me rephrase. If during the worst geopolitical times, if crude prices were not able to cross 80, 85 convincingly, then in these times, do we see crude prices crater further?
Well, I think this is the trade-off with the tariffs, because last night you saw all the commodity prices sort of come off. And you look at copper, which is a litmus test for the global economy. Only last week it was trading on record highs. Now that's started to come off. So when you see all the commodity markets under pressure, that is a trade-off that we're not going to see sort of prices go over and above what the tariffs are, because the import prices will start to come off. Let's hope that is the case. Let's hope the commodity prices can come under pressure to compensate for that 10% increase in the prices that Americans have to pay for goods. And I think that'll be the case. I think that when you look at copper and you look at some of the other base metals, I think given where we are, given where confidence is, that'll be a good silver lining for the general economies to say commodity prices, input prices are going to be lower. So therefore, I think it's a positive thing. Short, sharp sell-off, but thank God their commodity prices aren't continuing to move higher, because then we will have inflationary concerns.
Jonathan, how are you looking at equity right now? Globally, I would say US equity as well as emerging markets. Are we in for a rough patch? I mean, you get statements from President Trump saying that everything is okay and markets are doing great. But is there going to be, more pain in store? Are we in for a protracted sort of painful period?
I think it is a balancing act, and we'll see how import prices behave. But at the moment, I think we're in for a much rougher time. If you think we've already had a 20% correction or close to it, I would be thinking that we're going to see a further and deeper correction. But this is a silver lining for those people that want to get back into the market. Very hard to get in on high prices. So I think there will be a base, and that's when you start to buy. So at the moment, stick to the sidelines, put your money in cash, and hold on and wait for when you think there's something similar to a low, because that'll be an opportunity to really take home once these markets return.
Would you come in on that? In that we've been talking about the possible end to US exceptionalism, and I know that you can't read too much into a single day's trade, but on some days when the market moves the way that it does, it becomes hard not to. What would you say about the flows and your anticipation of flows from this point on?
I think equities will continue.
Sorry, the question is for Steve.
Oh, that's right. I thought so.
Okay, thank you very much. I'd be interested in hearing what Jonathan has to say. But look, there's a risk it damages U.S. exceptionalism. And for the following reason, we've argued that the depth of U.S. capital markets, the availability of assets to invest, the rule of law, all the kinds of good things that you want, the price mechanism working is the real sort of source of U.S. exceptionalism. And you look at the way they put these tariffs on, where officials were lowballing what they were going to do, and this is far worse than anyone expected. It's far high. It makes you worry that whatever they say, that they're not bound by what the market sort of thinks is a reasonable range of outcomes. And yes, this is just tariffs, so it's we're talking about the merchandise trade account. At some point, it could be the services account. Some point, it could be the capital account. It could be many things. And I think it endangers the confidence that the market has that if you put capital into the U.S., you might be right or wrong in your investment, but the rules of the game are something that you can count on.
Steve, John, thanks so much for taking the time this morning. Speaking to you has given us perspective.
Thank you.
All right, and now let's talk about what happened in trade yesterday. I don't know how much you can glean from that, because a lot is going to depend on what happened overnight in global markets. But let's talk about it, because you had flows. Let's first look at the flows picture. You had foreign institutions that sold once again to the extent of 2,800 odd crores. A very small buy figure by domestic institutions to the extent of 221 crore rupees. But if anything, the IT index's move of 4.2% lower was a precursor to what happened in the US markets. And we were speaking about that through the day. It's the expectation that US growth will suffer. IT contributed to most of the declines on the Nifty 50 as well, which, by the way, saw a very small decline, relatively speaking, 0.33%. And so Indian equities, you can argue, got off lightly, relatively, amidst the global sell-off and the risk-off sentiment that is prevailing globally. The implied open had suggested a 400-point gap down, and so we ended up much better than what was anticipated. Of course, right now it's 100 points or thereabouts. The mid-cap index, in fact, ending with gains of about 0.2%. The small-cap index ending higher by 0.7%. The market breadth tilted very firmly in favor of the advances. And you know what they say, one man's medicine is another man's poison. Pharma stocks gained handsomely as they escaped the higher tariffs. Defense and PSU bank stocks also were a bright spot in trade yesterday, and banks held up. Market breadth very strong, with nearly 3 stocks gaining for every loser. Apart from IT, Dabur was a big loser, dropping over 6%, and the bleak outlook on margins spooked the street.
Yeah, so on the trade setup today, I'm standing on the shoulders of Bank of America, and in their India strategy note kind of encapsulates what ideally could be the template in the near term, right? So their note says that optimists are arguing that India's economy is relatively better placed. You can't argue with that, yes, relative to a lot of others, but this does add an additional risk for the market. We were not out of the woods at 23,500, right? So Bofa is rightly saying this adds an additional risk for the markets, and therefore there is merit in staying cautious. They are staying cautious, of course. They prefer domestic rate cyclicals versus global plays. Again, a good thought if you think of it. You don't know, independent of whether earnings take a hit or no, multiples for a lot of global companies will take a hit. Yesterday, IT companies' earnings haven't gone down, but multiples are getting contracted because of the right reasons. So therefore, you might as well play domestic plays, and in domestic plays, very likely that rates will come down, as we'll probably see next week as well, and therefore, you want to play maybe the rate cyclicals. It's not a bad idea to do that, and a lot of them are actually trading at dirt cheap not dirt cheap, but reasonably cheap valuations, and there might be upsides there. The quarterly updates aren't bad, as we will talk about as well, some of them at least, so which is great, and they prefer financials. Real estate, some would argue that is a bit of a dodgy call, but be that as it may, real estate. Ex-Tata Motors autos, interesting again, or global plays like IT, metals, energy. So the choice of stocks is different. A lot of people are saying, like Parag Thakur was saying the other day, right, that metals are virtually now a domestic play with the safeguard duties being put in, because these guys are now having a pricing power of their own and domestic consumption of their own. So difficult to say on the sectoral calls, but broadly, that seems to be the template which might hold true for the near term, unless, guys, our earnings show some exceptionalism, which maybe in quarter 4 is unlikely. Maybe you could argue quarter 1, quarter 2, yes. Quarter 4 exceptionalism might be a bit of a difficult stretch.
Even because of base effect, I suppose, which is why you're going to
quarter 1 and quarter 2. Yeah, that's true.
So I wonder if consumption is going to be a theme that shows some kind of a comeback if you're looking at the next 2 quarters out, only because of your tax rebates coming in.
And the base effect,
And the base effect on the other hand. And then if you're looking at that domestic play more and more, I think not just your staples, even if a bit of your discretionary and consumption facing theme might be something that's
an interesting point.
Back in focus. And before we go to the F&O setup with Puneet, I wanted to pull this up. Okay, I'm not making this up. This is something which has come from the White House handle. Even as President Trump has, I would argue, set a fire to the world, they have posted this picture of him ready for the weekend, saying it's almost Friday. It's an interesting message if you look at it. It is almost Friday. It is Friday for us, but yeah, that's the message coming from there. It's almost Friday. I wonder if it's also a sign. You don't know what's coming on Saturday and Sunday.
Man,
I hope that's not the case.
No. I'm very happy for this weekend to arrive. Please don't.
Yeah, well, that's the plan as far as Trump is concerned. All right, let's get to the stocks this morning that we are looking at very quickly, and then we'll come to Puneet for his F&O setup. Masgao Dock is the first one that we're seeing, which is on my watch list. The government will be selling 4.83% stake in Masgao Dock through an OFS. It's a thumbs down because now you're going to have more supply in the market. Although the stock was up about 5% yesterday, that is why you might see some pressure coming in on Masgao Dock. The OFS includes a base offer of 1.14 crore shares representing 2.83% stake, additional 2% stake under a green shoe option. The OFS floor price has been set at 2,525 rupees per share at an 8% discount to yesterday's close. The shareholding pattern will be the Government of India now will have about 84%, and that remains pretty much same. FIIs will increase, has increased to 1.55%. This is from December 2024. DIIs also have gone up, and public has actually come down as far as Masgao Dock is concerned. After the OFS, the Government of India's share may potentially reduce to 80%, which is why we need to look at Masgao Dock and see how it will work out. Just the supply demand equation tells you logically that it should be a thumbs down, but this has been a stock which was zooming, especially in the last bit of yesterday's trade. Bajaj Finance is the other one that I'm picking up, and there was quite a debate in our newsroom about this. So Bajaj Finance is going to be particularly interesting. Business updates is the focus here. Growth is largely in line with expectations. AUM growth of 26% is at lower end of the guidance band. The band was 26 to 28%. New loan growth, the company saw a 36% increase in new loan growth during the quarter. And the AUM has been added by 18,700 crores during Q4. Remember, the RBI story that was doing the rounds yesterday took a bit of a hit on the stock. It then recovered, though. You see the recovery through the day after the dip in the middle of the day. RBI has reportedly sent a letter of displeasure to Bajaj Finance regarding their co-branding credit card arrangements, which require explicit approval from the Department of Supervision. Having said that, all things considered, I think it will be a thumbs up for Bajaj Finance, simply because in what is a seasonally weak quarter, you are seeing at least that they've hit the lower end of their guidance. So watch out for BAF. Also, the focus on financials as people look for safe havens as a broader theme, which brings me to the next stock I've picked, which is Bank of Baroda. There's a UBS note on it. They've upgraded it to a buy from a neutral. All the focus, remember, thus far has been on private banks. Now, public banks also coming to the fore. In fact, UBS has hiked the target price to 290 rupees from 270, upgraded to a buy on stable outlook and attractive valuations. They say that the NIMs, that's the net interest margins, will witness relatively less pressure versus private peers. Valuations are undemanding and they expect credit costs to remain controlled. They're pretty excited about SBI as well. They've upgraded it to a neutral from sell. They've hiked the target price to 840 from 760 and say the risk reward is now balanced. Sustaining NIM's key for re-rating, and they've raised the EPS estimates by 3 to 5%, but see limited upside to core PPOP to assets ratio. So I think public sector banks is also something that you could look at, BOB more than SBI.
We briefly talked about this. Neeraj made the point on crude. So I've decided to pick OMCs in focus, and the fact that Brent crude has fallen below $70 to the barrel, at least sentimentally, is positive for these companies. Generally, a fall in crude implies slow economic growth globally, but we've spoken about Indian resilience relatively speaking, and certain high frequency indicators would suggest that activity is actually picking up. Of course, the marketing margins, which have been under pressure, will improve if crude oil prices fall. But on the other end of the spectrum, you could argue, of course, that they could see inventory losses as well. But broadly, one would argue that this is more positive than negative, a fall in crude oil prices. So therefore, watch out for IOC, HPCL, BPCL as well. Avenue Supermarts is a thumbs down based on the quarterly update. The standalone revenue from operations rose as much as 17% in the fourth quarter, and it stood at about 14,462 crore. It's not all negative. It was positive on the back of the store addition that took place, and in fact, that store count stood at 415. Macquarie on Avenue Supermarts has maintained an underperform rating with a target of 3,150 crore rupees. It says that the Q4 sales growth was largely similar to the third quarter, and there was actually a marginal sales growth miss. They see healthy store additions though, with 50 stores added over the course of the financial year. The target, of course, was 3,150, implying quite a bit of a downside. That is a thumbs down from my end. HDFC Bank is a thumbs up, and this is on the back of its quarterly updates. Total advances in the quarter were up by about 5%, 5.4% or thereabouts. Deposit growth was about 16% higher. And if you've been tracking this bank, you'll know that this is where the focus is. They have to ratchet up the pace of addition of deposits. CASA grew by as much as 5.6%. That's current account, savings account. But the problem is that the growth has returned, but the deposit growth has not been as high as was anticipated, as was hoped for. And that could be seen as a little bit of a negative. Macquarie has said that it's maintaining an outperform with a target of 2,300. It says that the core issue is that the deposit growth is below expectations. However, the loan growth is in line, and they expect the net interest margins to increase gradually in the short to medium term. Of course, that will be apparent in the Q4 numbers that get reported later on in the next couple of months or so. Morgan Stanley, on the other hand, has maintained an overweight rating with a target of 1,975, and it says that the strong sustained deposit growth is positive, and there is also an improvement in the loan to deposit ratios. Remember, this is a very key metric to track for HDFC Bank. They're awaiting margin progression in the quarterly results as well. Neeraj.
Okay, the three stocks on mine. Bandhan Bank, and Harsh was saying that the numbers look good because there's a strong loan growth and deposit growth, up 4.5% quarter on quarter and 7% quarter on quarter respectively. So loan growth and deposit growth both look good for Bandhan Bank in quarter 4 update. There's a shrink in LDR, and the CASA growth is up 6% quarter on quarter. So very likely that in addition to some of the other strong updates, Bandhan Bank has delivered a strong update. May see a reaction, let's see. Interglobe Aviation is very interesting because I think the crude downtake, as Alex spoke about OMCs, this one is right up there too. Crude downtake will aid sentiment and to earnings as well. The math is, as per a Jeffries note, that a 1% dip in crude implies circa 4% increase in EPS for Interglobe Aviation. Remember, earnings are anyways expected to be strong because of the Mahakumbh effect and the fact that crude prices are not very high even in the quarter gone by. And while there is a stake sale overhang by and large, one knows that until the earnings come out, there is no stake sale happening, right? So you can technically ride a trade till the earnings come in without a fear of an overhang of a stake sale coming in. So therefore, Interglobe Aviation could be a very good one as well. And lastly, the third one on my list is 361 WAM or 360 Wealth Management. Now, the reports suggest that one of the co-founders and a team of professionals of 361 have resigned in order to start something else. Now, this business is about the relationships that all team members carry, wealth management that is. And if a co-founder and some of the other people have resigned, it might well bring about a hit for the stock, so a business, and therefore I would suspect that the stock could see a bit of a red in the screen today. So do keep an eye out for this one as well. But what about the overall broad setup? I think it's important to get in Puneet to try and dissect the derivative cues for us. Puneet, difficult as it is, let's try and make sense of what the derivative markets are telling us.
Well, definitely, Neeraj. It's a very difficult session to call today, and it was as yesterday as well. So Nifty at around 23,250. The support on an image side is roughly at around 23,100. But based on the implied open of about 109 points, it could be that the start might slightly be around that, but it'll be very important if we can sustain that level of 23,100 on the support side. The resistance also at 23,480 odd levels, that's also come down from 23,800 over the last week, but we've had numerous news flows on the negative side. So that's resistance levels also moved to 23,480 now. I just want to put up the Nifty open interest distribution as well, because we've seen a lot of the Nifty put increase at 23,000 levels, and we can see that big candle there which was formed because of the trade yesterday. On the call side, while the maximum is at 25,400, we've seen an increased interest at 23,500 as well as 23,600 for the calls as well. If you look at the open interest gainers and losers, that'll be something to watch out for, because we might see a trend reversal for a lot of stocks today in trade. But as of yesterday, we've seen short build up in stocks like KPIT Tech, and we've also seen some short build up in persistent systems, and we have some delivery data to back that data as well. While on the open interest losers side, we have seen some longs unwinding on Siemens, and the demerger is the news there to watch out for. On the other side, some short covering has been seen in stocks like BL as well as Glenmark Pharma. And if you can just pull up the delivery data, and that is something which is going to be something to watch out for, because while we've seen for Persistent and for Coforge, I want to talk about, because while we saw a huge correction on these stocks yesterday, and the delivery data also wasn't that great on the low side, so logically you should expect these stocks to be in the green today just based on this particular data. It's not going to be that easy going forward based on US Trump tariffs and the other factors that are going to be impacting all these companies with high US exposure. In terms of Interglobe as well, the stock fell 1%, delivery data was over 70%. So logically on this data point itself, it should imply that the stock should go down. But just on the crude data point as well, which is coming yesterday, a fall in crude prices will benefit the Interglobe Aviation stocks as well as environment. That's something to watch out for. So overall, a lot of data points to watch out for. I think we'll have to see which one trumps it, but a lot of fundamental factors in all these stocks to watch out for in trade today.
Which one trumps it? That's the line. Trump is trumping it all. I'm going to quickly pull up the implied open. Thank you for that, Puneet. Before we get to the other stock that is in our focus, 114 points in the red. So, be prepared for a rocky start. Meanwhile, fundamentally and in terms of news flow, what is happening? What are the stocks you should focus on? Let's talk about Aditya Birla Fashion. They've had a recent analyst call where the company talked about a strong guidance for the coming quarters. Mahima is joining in with more details. Yes, Mahima, why is ABFRL in focus?
Right. So, they've overall said that this in the next 5 years, there will be no organic growth further through any kinds of mergers and acquisitions. The growth will only be through organic ways. No further fundraising, and overall their focus remains on profitability. Now, in terms of the two demerged entities, the first one being Aditya Birla Lifestyle Brands, they are saying that they target to double the revenue in the next 5 years. They target 300 basis points EBITDA margin expansion plus a 70 plus ROCE. In terms of debt, they have said that they expect to be debt free in the next 2 to 3 years, and they expect a strong cash flow generation and would become a dividend paying entity going forward. Now, in terms of guidance with respect to demerged Aditya Birla Fashion Retail Limited, they are set to triple revenue in the next 5 years, EBITDA margins to expand to 7% from loss making currently. They are targeting 18% plus ROCE by FY 2030. They are set to open 250 stores every year, as well as increase the store size as well. In terms of the composition of their stores, 70% will be franchisee owned stores by 2030, and 1000 plus stores they target to open in small towns. So they are now planning to tap into the tier 2, tier 3 cities as well. They plan to add 20 to 25 Pantaloons stores each year, and overall they want to improve their inventory turnover also by from 2x right now to around 3 times. And lastly, they are expanding stores in a cluster based approach. So this is the overall view as to what the guidance has been given by the Aditya Birla Fashion Management, and this shows that management is now confident about the growth going ahead.
Thanks so much for getting us those details. Of course, ABFRL among a large list of stocks that you should watch out for in trade today. We're joined in studio now by Kush Bora of kushbora.com, and we'll get to him in just a bit. But before we do that, let's talk you through a few more stocks that you should keep on your radar. We've got Alivus Life first up. It's gotten voluntary action indicated for its Gujarat unit, which is considered a positive update. There's also Ventive Hospitality. HSBC's come out with a note. It says that there's a 19% upside from this point. Bank of Baroda, we spoke about this earlier today. It's on Tamanna's watch list. UBS has upgraded the stock, and it looks at SBI also positively, by the way. AB Fashion is set to triple its revenue in 5 years. Keep that on your radar. Siemens, the demerger date has come in. It has been set for 7th of April.
Well, we certainly watch out for the oil marketing companies with crude slipping below $70 per barrel. Avenue Supermarts, the Q4 revenues are up about 17%. Store additions don't look all that bad. Watch out for this one. Adani Wilmar, revenues risen 36%. Should keep an eye out for that. Strong growth in advances for HDFC Bank, though one could argue that it's almost in line with estimates, but certainly not a bad number. And in case of Bandhan Bank, strong loan and deposit growth as well as CASA uptake could aid sentiment for this one today.
Okay, L&T Finance is a thumbs down. The loan growth has slowed, so that is one to watch out for. Chakri is joining us now of LGT Wealth. Chakri Lokpriya and Kush Bora, of course, with us in the studio. Welcome to both of you, and I hope all of you are also feeling the thank God it's Friday mode. Since that's what the whole world is waiting for. Chakri, let me begin with how you have seen all the bank updates coming. Because, you know, these are times when you have to stick to what you can actually see and look at cogently instead of just predicting what Trump will do next. Do you think that there are some silver linings there?
You know, it's remarkable that that we've survived through this entire phase, and that, you know, for the next 6 months is going to be very interesting in terms of it's going to be very tough. Simply because, you know, if you have 180 countries around the world which are now negotiating with the US government, with Trump, to come up with bilateral agreements, that's going to be a constant flow of information up and down over the next several months. So against this backdrop, you know, India will also be doing that in the fall of this year, negotiating with the US bilateral trade treaties. So until then, you know, there will be the fear that, you know, as if US slows down. Now tell me something, if, you know, if we're all talking about a fear of recession in the US, it already must be in the mind of Trump and his advisors. So which means they must be having some follow-up plan, is what I would assume, in lowering the impact of inflation in the US. But nevertheless, in the short run, you know, the fears of inflation and therefore slowing down US economy, which will have a collateral damage not just on exports from India, but also if the US slows down, India also slows down.
All right, so that's an interesting takeaway from that. Of course, everybody's watching this very closely. Kush, I'm just wondering, what strategy would you suggest at this juncture? A lot of people are saying wait for the dust to settle, don't venture out and try to be brave in this kind of a scenario. What would you say?
First up, a small correction to what Tamanna said. It's not TGIF. Say what you will about the guy, but he knows how to be the center of memes and catchphrases. So from now on, for me, it's going to be TGIAF. Okay, even if it's a Friday. Thank God it's almost Friday. I'm going to go in with that feeling.
I was wondering what the AF was.
But we can't change the day of the week, na, Coach? It is Friday for us.
He just did. I mean, you never know what he comes up with next, right? So that's Trump for you. No, but to Alex's question very specifically. See, I think yesterday what we saw could well be, more of a domestic play, which is the expiry effect. The real impact of the Trump tariff, gameplay will actually be felt today. That is also to say that today, if we don't react and if we don't go to those 23,000 or sub 23,000 levels, I think the immediate impact of that is done and dusted, and we can say that yes, we've come out relatively unscathed out of the entire event that's transpired. If we don't, then perhaps there are data points suggesting that we could slip a little lower, perhaps to 23,000 levels. Just to start with that, a few data points. For the last 6 sessions, if you don't count 2-3 points here or there, we've made lower highs, which means the momentum on the upside was missing. FII selling is back, very silent, very quietly, but for the last 3 days, FIIs have been selling. Also, if you'll recall, just last week we discussed that the FII net long position was at 60%, and typically, in my studies, that's been the highest that they've usually come up to, and that's turned out to be true yet again, where FIIs are now net long 70%, which means now the short sell has actually gone to 30%, which is actually relatively high. We've moved 10% on the index short on the index futures. Now what are these data points indicating? That from a near-term perspective, the upside is relatively capped, but so is the downside, where the 22,800, 23,000 levels are going to act as good support. So I'll continue with the view that we've been discussing for the last couple of years. So long as 22,800, 23,000 is maintained, you stay long. You could go long, buy on dips depending on how the day is reacting. But I think for any fresh momentum, the immediate result has to be, the previous day high being taken out. Bank Nifty, if I can just quickly cover that also, that's more of a case of the tail wagging the dog, where what's happened right now is that the Bank Nifty is holding above the 200-day moving average, but for the last couple of days, if you see, it's been more of the PSU banks. Now, they don't have that kind of weightage to take the index much higher. So if FII selling returns, the HDFC banks and ICICI banks of the world will remain under pressure, and you will see upside pressures. So just be a little cautious. The view is positive, but consolidation with a positive bias is what I'm aiming for both the indices.
Yeah, but I think it's a valid point that yes, PSU banks don't have the strength to do it, but I wonder, with the banks doing what they are and IT being completely out of favor, does it make banks the central port of call, and within that, then therefore PSU banks kind of become the icing on the cake, if not the actual cake itself. Are banks a part of your list today, Kush?
Not banks, but financials.
Okay.
I was listening to your commentary, and yes, I mean, financials do make the cut right now. So PNB Housing is one stock which has actually done rather well over the last few sessions. Good up moves last 2 days, despite the kind of market moves. The stock itself has had good volume participation and good price action as well. So on the upside, you're looking at targets of 955 and 975, 920 being the stop loss. Given the texture of the market, I have a short call as well today, which is, I think, the most obvious one you can get, which is Tata Motors. The stock had actually attempted a recovery, 700 odd levels. It's starting to see pressure. Yesterday, 200-day moving average also given up and closing at the low point of the day. So it's got a few negatives going for it. 645, 635 are your targets. 665 is where you place that stop loss.
Okay. So, PNB Housing in focus. Financials is something that Kush likes as well. Talking about financials, this is going to be on top of mind because of the series of updates that have come on quarterly businesses, on the quarterly business updates. Harsh is giving us a detailed breakdown. Harsh, the overview first. The sense is that what we've seen so far, and of course not everything has come in, is not as bad as expected.
Well, not at all. And also to be kept in mind is the fact that it's a seasonally strong quarter. So in general as well, Q4, you generally see a bit of a increase with regard to where growth is concerned outside of consumer lending, which is Bajaj Finance. So, so overall, you'd see growth at a better clip, at a healthier clip in Q4. But let me quickly take you through numbers. L&T Finance. Now, on a book size of 95,000 odd crore, you would expect this one to grow faster, but not so much. 3% QOQ growth, just about 19% YOY, slightly on the softer side in that sense. The one positive is collection efficiency has improved. So that's something that may well reflect even in the commentary in terms of how asset quality is evolving and whether a bottom is getting or is forming shape in terms of credit costs. So that's one thing. The other one is with regard to Bandhan Bank. Now, strong numbers with regard to growth, MFI growth not coming through, but despite that, very, very strong numbers. 4.5% QOQ on the loan growth front. Deposit growth is at 7% QOQ. But when you're looking at the full year numbers, just about 11 to 12% on both loans and deposits respectively. CASA also grew fairly well in this quarter, 6% QOQ. Is this sustainable in the next quarter, or is this just a one quarter thing, is something you'll want to look out for? And the loan to deposit ratio has shrunk as well. So we'll have to look at whether a lot of the deposits are back ended and there's just been some tailwind with regard to deposits. That tends to happen in Q4 as well. RBL Bank growth was weak, largely in line with how the industry has grown, and therefore no increase in market share. For a book size of 95,000 crore, you would expect that. Deposit growth though has come in at a fairly healthy clip. Yes Bank is concerned, well, again, very, very slow on the loan growth front, just 1% sequential, did not impress. We're looking at deposit growth at around 2.5% QOQ. Again, very unimpressive overall in terms of the numbers. Last off, I want to flag UCO Bank, very strong numbers in that sense. 5% on both loans as well as deposits sequentially for a PSU bank, looking very, very good. Some of the PSU banks in general have also done well. Just wanted to mention that as well.
I just want to thank you for that, Harsh. I just want to bring back AU Small Finance Bank. I think we briefly spoke about it on the closing show yesterday. But the other part of it, apart from business updates, is going to be book quality and the asset concerns receding. AU Small Finance Bank also had pretty good updates. Do you think that there are some of these that you would look at today, AU, Equities, any of them that you see as promising on charts?
So there's definitely a spurt that can't be ruled out. Bandhan Bank, I'm seeing, fairly good moves. AU Bank also fairly good moves. The only thing is, it's again that case of, once bitten, twice shy. While these have good updates and then hence the, a strong price action. From a technical standpoint, some of these are coming up, against resistance levels. Also, time and again, we've seen that, the rallies do come about. It's not that, they're not volatile, and volatile on the upside as well. So you've got that volatility, but then they give up gains rather fast. So I'll stick to the same view that we discussed yesterday during the closing show, which is if you want to go with them, I would still prefer the PSU banks, maybe, slightly second, and by second I only mean second to SBI, which is the PNBs and Canara banks of the world. You might want to stick to that. There's a great degree of margin of safety there.
Okay. Important to get Chakri's view on the banking updates as well. Chakri, a spate of them coming through, and HDFC Bank stood out to me interestingly because though some might argue that 15% odd growth in deposits was a decent number, some others who've been looking at this very closely would say that he wanted a little more. But CASA, as Harsh was pointing out, that tailwind coming through in the fourth quarter, so looking good for a lot of financials.
Financials in general are doing well. Within that, I'd agree with Kush that PSU banks are actually better placed fundamentally also. Fundamentally, their balance sheets are strong, the valuations are very attractive, the provisions are very much under control. So the SBI's, Canara banks, Union Bank, Bank of Baroda are all extremely attractive. Given that they're also domestic facing, corporate facing, and have less of external risks. They only have the collateral damage of that, if overall economy slows down, then clearly banks also slow down. But outside of that, they're strong. Now, HDFCs and ICICI and Bajaj Finance, all these companies, they have still a consumer overhang. Loan deposit ratios, while improving, are still, I think, not there yet. And therefore, that valuation uptick that one needs to give for these banks to do for better on from here, I think still we're about a quarter or two away.
Okay, interesting. So you would not be going out and venturing out to buy any of these right now?
I would go out and buy the SBI's, Canara Bank, Union Bank, and the financiers, but not the private ones so much.
Fair point. Just want to make a point on Tata Motors, since Kush had it on his list and his advisor short as his recommendation. CLSA has come out with a note on Tata Motors, and a lot of people are talking about the implications of the tariffs, but they've downgraded to outperform from a high conviction outperform, and they've cut their target price quite significantly to 765. The previous target stood at 930. They say that FY26, the current financial year, could be a year of demand rebasing in the US, led by increased tariffs. They're saying that demand elasticity is going to impact JLR's FY26 volume in the US on account of those tariff hikes. We spoke about this in the previous quarter. They had 36% of volumes coming from from North America, actually, and large part of that, of course, United States. JLR to remain free cash flow positive in FY26 is still a positive. And they might see some capex cuts in the near term based on that demand scenario playing out. And they're also saying for the domestic business, the demerger that is set to take place is going to coincide with the CV down cycle getting closer to its bottom. So that's essentially what they're saying. Chakri, very quick view on Tata Motors. Do you think that the negatives are currently priced in, or is there more pain, in your opinion, to come?
We would stay away from Tata Motors, given that roughly 20% of sales there will be slowdown in the US for that until the tariff situation negotiations are clearer. And then it's a little bit more complicated in the case of Tata Motors because the negotiations are not just between India and the US, but it will be Britain and the US as well as far as some of the JLR sales are concerned.
Okay. On to more news stories as well, and 361 WAM, or 361 Wealth Management. As per a Bloomberg report, the Indian Wealth Manager's co-founder and CEO has resigned, along with a team of 5 bankers across Singapore and Dubai, and a total of 10. Agni has more details on this. Agni, good morning. This is important.
Good morning, Neeraj. So, to put some perspective, this is 361 Global we are talking about, not the Indian unit. So Vikram Malhotra had joined 361 Global in 2023 he joined 361 in 2023 to co-found the global unit. Now he was with earlier with other Singaporean companies and overseas companies, but what Bloomberg is reporting is that Vikram Malhotra has resigned along with 10 other private bankers, and they are all on gardening leave. Now we don't know the reason as to why they have resigned yet or where they are headed, but a spokesperson from 361 told Bloomberg News that this aligns with the company's current policies and global business strategy. So as you know, this follows hot on the heels of the IT searches that were going on. NDTV Profit had reported, there was a ground report that we broke in late January about IT searches going on in 361 offices and across multiple IIFL group companies where tax authorities suspected multi-crore tax evasions and were also investigating accountants and senior executives. So as of now, this is a developing story. We are trying to reach out to 361 on our end as well, but this is a big blow to a company whose global footprint was just expanding.
Okay, thanks a lot for that, Agni. And important guys, because I mean this is essentially a people's business, right? You lose key people, you probably would believe that there'll be some business which will be lost.
I'm wondering if, since there is clarity that this is the global business unit, will there be too much of a hit?
But I would suspect that even if the head of the global business quitting with this thing as well, I mean, whatever. Now, yes, we need to figure out what was the percentage of revenue that comes in the global business for 361, because the India business is very strong.
Yeah.
Nevertheless, important one.
Just a thought here. Often when it comes to these business, there are teams that are tied to an individual, and if somebody from the top leaves, they generally pull.
Which is why the 10 people have left along.
Yeah.
So it could be something like that as well.
Yes, but if they bring about whatever size of business, etc. So that's interesting. But actually, Chakri, can you come in on this one? And 361 is the case in point today, but we've seen some teams resign from other wealth managers also in the last 2 months. Maybe not as news-breaking, headline-grabbing, but it has happened. While asset managers or wealth managers are considered to be a great proxy play to the capital market story and go out and buy them, they run this risk of employees leaving, right? And because it's a relationship-built business. What would you think about this particular news for 360 ONE? And how constructive, not constructive are you on that piece vis-a-vis some of the other capital market stories like brokers, like mutual funds, for example?
In wealth management, clearly the importance to international products has dramatically increased, with the GIFT City opening up and for various products to be sold inbound and outbound, and also the market regulations changing. And therefore, the international piece of business is becoming very important because until the recent past, Indians did not have access to foreign products, international products. And now with regulations changing, they're having, and therefore international presence is increasingly becoming a very important component of wealth business. And second, in a wealth business, yes, people are important. And so this does create a temporary blip. It's a strong firm, but it does create a temporary blip. And in asset management versus wealth management, there is a difference because in wealth management, there is more relationships also do matter to an extent versus an asset management less so.
It's a very important points that you make, Chakri. We do have to slip into a very quick break, so do stay with us. And viewers, we'll be back on the other side to talk more stocks. So stay tuned.
Whenever a film sank in 2000s, it was always flop actor. मेरी तरफ नहीं देख रहे, देखो तो सही. I compare an actor's career like the stock market. Sometimes your stocks are low, right? And when your stocks are low, no one's buying. Sometimes your movies do well and your stocks are on the rise, and everyone's suddenly buying that stock.
What point do you think that the film career perhaps is not going the way that you thought?
Itch of wanting to be an entrepreneur started itching a little more, and I wanted to scratch it.
One of the most important lessons is to know when to pivot.
The burn was far more than the earn. We were burning and I was watching my money just go out and like, oh my God, what's going on here?
He sold most of his stock, 80%.
All right, 7 minutes left for the markets to kickstart trade, and while people would fear Armageddon based on what S&P 500 did yesterday, we are okay. I mean, for now, 145 points, though, must say, I mean, the GIFT Nifty or the implied open has ceased to be the exact indicator, but it does give you a flavor. For now, yes, we know we'll start off in the red. The question only is how much and what to do post that. I think that will be a key thing as well. Now, we've spoken about financials. There are a few other buckets of news flow that have come in. And Chakri Lokpriya, I wanted to check with you if you look at Aditya Birla Fashion closely at all, because I thought amongst other things, for that business to go out and say in an analyst meet that we are now not going to focus on M&A, we are going to preserve cash, we are going to focus on growth, get growth at all costs, give some targets, so on and so forth. A lot of sell-side brokerages have taken a liking to that. I wonder if that features in the list of, in the scheme of things for you. Aditya Birla Fashion.
Yeah, Aditya Birla over the last few years has acquired lots of companies, right from companies like Sabyasachi, which are at the high end, to lower priced products. So, they have these amalgamations of companies. So is it a luxury company? Is it a company for the middle class, or is it for the low end? We don't know yet because it's there across various price points. So now they want to stop acquiring, at least slow down, and start growing organically. So therefore, they're going to open a number of new stores. So what that does is, yes, it's a revenue growth opportunity if executed well. And I think that's the key imperative, is now the shift focuses on operational execution. So therefore, the margin improvement over the next, as each succeeding quarter, if they can do it, the market will give it a valuation, but we would wait for a quarter or two before it can actually do and show that.
Okay, Chakri, stay on with us. We're speaking to CSB Bank, Pralay Mondal joining us, MD and CEO, on the back of business updates, which have actually been quite robust. Mr. Mondal, a very good morning to you. What are the details that you can add? We're seeing that your advances are grown nearly 30% year on year. Deposits have also seen a robust clip. Is this sustainable? What is the outlook that you're looking at? And are you seeing a marked improvement in Q4?
Good morning, Tamanna. Absolutely right that we had a good growth in Q4, especially when you look at quarter. We have grown CASA deposits, gold loans, as well as other assets. And the best part of this quarter is that across all segments, in spite of the fact that we had slowed down considerably on some of the unsecured businesses, MFI businesses, etc., which has shown a negative growth. Every segment, wholesale, SME, gold, and retail, each of them has grown 24% and above, and which shows the consistency of every vertical. Liability also did well. CASA grew quarter on quarter by 11%, and deposit grew quarter on quarter by 10%. Overall, for the year on year growth is 24%. And we believe that we can sustain what we are doing already, primarily because this year, FY26, is a very, very big year for us from a tech transformation perspective. We have been all waiting for this. We are changing everything on the tech stack, whether it is core, whether it is the entire surround system, the loan origination system, LMS, everything is going to be transformative for us. And this will be the journey for our retail business, whether it is on the liability side, asset side, fees side. And hence, this is our journey FY27 to FY30, which is 30% wholesale, 30% retail, 20% gold, and 20% SME. This is our vision for 2030. And in another 6 months, that journey will begin. We are all very, very excited about it. But yes, we'll continue to deliver quarter on quarter as well.
One follow-up. As the picture looks very bright, Mr. Mondal, the only fly in the ointment, if I may even call it that, is the margins that we have seen this quarter at about 4.1. I think a little below what your guidance is at 4.5. What is the picture over there? And are you seeing a return to the guided margins?
Tamanna, I'll tell you, which I told before, that we are here to build a franchise and move towards the mid sector in the next decade. So given that, the growth will be the primary focus for us. And eventually, when you have all the four verticals, we won't be just a gold loan bank going to 2030, and hence the margins will mirror where the markets are, where the most of the mid sector or larger sector banks are. So from that perspective, anything around 4% is not a bad margin in my view, provided we are able to sustain the growth. And hence, also we know that last 1 year, especially last 2 quarters, the liquidity challenge has been immense in the system. Good thing is that the liquidity is coming back as we're talking. And from that perspective, I think deposit cost will gradually start coming down. And but for the next 1 or 2 quarters, I think it will be flattish where we are there. And from that perspective, I think anything between 4.2 is not a bad number. Also, this year, what happened is last financial year, actually, there was something, the penal interest got withdrawn, which impacted us upwards of 20 basis points, which is a one-time kind of an adjustment, and it doesn't come back. So from that perspective, we had a little bit of a challenge. But I think anything above 4% is not a bad margin if you're able to grow, which is now we are growing almost double the system, but our guidance is 30 to 50% faster than the system.
Got it. Mr. Mondal, good morning. Neeraj here. Just trying to get this on record again, maybe from you. And by the way, viewers, the pre-open rates have opened. We'll get to them in a moment. But Mr. Mondal, so if you bring gold down, but at the point of time when gold itself is, I'm likely believing, going to grow strong as well, right? Where is it that growth will essentially come from in the other segments for gold to go down to the levels that you're talking about? And therefore, sorry if you already mentioned it, but what's the CAGR growth rate that you envisage for the bank for the next 5 years, sir?
Good morning, Neeraj. Very good and correct questions for us at this stage of our life cycle. So the point is, asset growth is easy for us at this point of time, given the size of the balance sheet. The key focus now is shift towards the liability. And that is where the new ecosystem which you're building on the technology side is very, very important, because what we need is customer acquisition. So suddenly we have now 4 verticals, retail, and retail we are just starting. We will launch 13 products, and eventually, and that will also help our liability in a 360-degree customer view. Wholesale, you will see that last quarter on a year-on-year, we are 4% growth. Currently, we are upwards of 20% year-on-year. So you can understand how we are growing on the wholesale side. SME is close to 30% growth we are having year-on-year basis. Gold has also grown well, and retail will start picking up. Even then, it is more than 20%. So I think the challenge for us and fees is doing extremely well for us. So the real challenge is how do we build a sustainable granular liability franchise, and which will also help us in building a retail asset business, and hence increase in distribution, having more products, more customer acquisition focus, all will be built on the back of the franchise which you are creating and the back of the technology transformation we're doing. So this is a very, very big year for us from execution perspective, and FY27 onwards, you will see that we are firmly on our path towards our SBS 2030 vision, which is 30, 30, 20, 20, 30 wholesale, 30 retail, 20 gold, and 20 SME.
That you reiterated that, Mr. Mondal, because I was going to ask you to do that. Alex here. I'm just wondering, so you've spelled out the fact that you're growing in your other business very strongly, but I'm trying to understand, and also I think your investors would want to understand the kind of margins that you would have in each of these business broadly, because at 44% of gold in your book right now, and with the gold book itself growing at 35%, which is, if I'm not mistaken, faster than any of your other businesses. And at the time when gold is at 90,000+, I would assume that your loan to value for gold would allow you to lend very aggressively going forward. You're likely going to see continued very fast growth in that book. So I'm just trying to understand the margin picture and the texture. I know you said that above 4% is good, but can you break that down for us?
Sure. Thanks, Alex. So let me put it this way. We are firmly committed towards the journey of building a serious universal bank with full franchise, 360-degree franchise, because we have a universal bank license. And from that perspective, we want to have all our verticals performing. Yes, the gold price internationally is above 3,150. As you rightly said, it's more than 90,000. But when price goes up, you can have a view on that price, but we get more and more risk averse when it comes to LTV. So as we're talking, we may be an exception here, but our LTV is below 70% at this point of time, in spite of that fact that we have a large agri book there on the gold loan side. So to that extent, we are taking some risk off the table on the gold pricing. We do not want to play on that. And our growth is coming from, if you see quarter on quarter, actually our gold mix has marginally changed and has come down a little bit because other franchises have started picking up, and the real pickup on the retail will happen next year. So then we won't be only dependent on gold as a business. Every franchise will start delivering. So when that happens, if you go segment by segment, as you know that if you see our overall credit cost is below 20 basis points as we're talking right now, and we want to sustain that kind of a level for some more time. So given that, we won't take risk whether it is in wholesale and SME, and hence the margins will be relatively lower than what we have in gold. Okay. So from that perspective, I think we have a clear roadmap ahead of us.
Got it. Mr. Mondal, just to rewind, so 30-30, 20-20 is great. What does that entail in terms of growth? I know you mentioned that liability franchise is more important than growth, but because the markets will care about growth, is there a target, CAGR target growth rate?
I think we should be able to take a 25% plus at this point of time as we're talking on the asset side, and whatever it means on the liability side, that we will be able to
Quickly, Mr. Mondal, before we let you go, we're expecting largely a 25 basis point rate cut is penciled in next week itself. What is it doing to your credit costs? How are you seeing the impact of that flow in?
It will not impact credit cost as such, but what we'll do is our EBLR book is very low, very small, around 10 to 14%. So the impact on the margins will be limited from that perspective, and liability cost will gradually come down. It will not come down overnight. So margins will sort of not get impacted that much by this. On the credit card side, we are pretty confident that we'll be able to, our long-term guidance is below 40 basis points on the credit cost, but right now we are around 20 basis points. I think we should be able to hold our guidance around that.
Mr. Mondal, before we're thanking you now, but at some point of time, if not this policy, then the next policy, it'll be great to have you on air to try and get your perspective of what the RBI governor's statements are. So do consider that, please.
Yeah, thank you so much, Neeraj. It will be my pleasure. Thank you.
Yeah, great. We'll tell teams to get in touch with you. Look forward to talking to you post-policy.
Thank you. Thank you, Neeraj. Have a good day.
Thank you. You too. And all the best with the plans. That's CSB Bank. Well, pretty interesting. I mean, the stock may do what it does today, but I think the statements were very, very interesting. Chakri, you heard that conversation? Anything that stood out for you?
Clearly the bank is, expanding its vectors of growth. And, gold, while, has done phenomenally well as an asset class, and therefore all gold companies have had that safety margin in loan to value. And now it's building, as he just explained, their deposit growth. And that requires a little bit more spend, and therefore I think it looks like there are enough vectors of growth for the company, for the bank to do well over the next 3 to 4 years.
It's time for the big brokerage call of the day. Chakri, a point made on CSB. Let's talk about what HSBC has to say about Ventive Hospitality. They're positive on this stock. It's opening, let's see how it does, but at least in pre-open, it's just 0.1% higher. Harsh joining in to tell you what HSBC has to say. Harsh?
Well, it's an interesting note. A bet on hospitality, 19% upside from here. I believe Ventive in that sense has been a slower mover. So it's catching up with peers is what they're saying. It owns, as background, owns 11 hotels across India and Maldives, predominantly Pune and Maldives to be absolutely specific. It also has 4 annuity assets in Pune. It has 4 hotels which contribute around 80% of the business. Pune plus Maldives combined is 90% of the business. So concentration there. It operates the JW Marriott as well as the Ritz-Carlton in Pune, the Anantara and the Conrad in the Maldives. Now, in terms of hotels, there's a strong upcycle, highest occupancy and average room rates that we're seeing. Levers is that demand is outstripping supply. Currently, the capacity growth is lagging by around 6 to 8%. Over the next 4 to 5 years, that's the estimate. Conversions of unbranded to branded is the other lever, but that doesn't add capacity per se. Urbanization is the other trigger, improving infra and under-penetration overall. All of those factors leading to positivity on the industry. Is it lagging peers? Most definitely yes. The record occupancy that the industry is seeing of around 78 to 79%, Ventive is at 61%. Only 367 rooms in the pipeline versus peers, that's very, very low. But they're catching up quickly. Pune, Maldives is going to improve occupancy given better infra. Maldives, in fact, airport capacity is expected to rise sharply. Cost structure improvements also will help the company in terms of PAT margins. Strength is a strong balance sheet. EV/EBITDA in terms of valuations, 18.5 times FY27 expected EBITDA for the hotels business is how they're valuing it. 14.5 times for the annuity business. Risks are lack of growth and possibly continued underperformance. Broadly, very, very positive on the sector as well as on the stock, HSBC.
Okay, so I'm just wondering, Kush, anything standing out to you where done with the pre-open and you say repeatedly, don't go by these numbers, and you know, even right now you've been muttering to yourself, don't go by these numbers. So why do you say that, one? And two, anything standing out to you?
Chalawa, that's what I call it. The pre-open, GIFT Nifty, and now even the pre-open. I'll tell you why. Because a lot of times, if you've seen in the recent past, you know, what's happened is the pre-open suggests one thing and the impact is much deeper. So while it's suggesting only 60 points down, I mean, you know, we could open there and then perhaps slip almost immediately. That's my worry. One of the reasons to add to that is that, you know, I was actually shortlisting stocks for a or rather just an opening trade. Now, surprisingly, a lot of names that I had on my list are actually showing a minor but still a downtick, you know, on open. And mind you, most of these are stocks which are actually having good strength for the last week or so. Even yesterday's closing was, you know, fairly strong for these names. So I would actually wait this one out. I'm not going by the 60-point downtick. I want to see for the first 10, maybe 15 minutes as to what does the Nifty do. So just be a little cautious. Don't jump and say that, you know, okay, we are opening 60 points down by this dip. I might just want to wait it out for the first 15-20 minutes and see how it goes.
So then what is your, if this is Chalawa, what is your call on how the markets are going to open and where Nifty will land end of the day?
Sorry, this is Chalawa. What does it mean? Sorry.
This is, you don't know Kush's pet term. He says the GIFT Nifty or the pre-open is Chalawa.
Acha, okay. Sorry, no, I don't. But okay.
What does this
so
mean?
I
Mirage. It means Mirage. Yeah, I would suggest one thing, but not really there.
Okay.
Right? I mean, yesterday.
Misleading.
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 Okay. Yeah. So then what's the call?
Yeah,
so then what's the call?
When you ask me pointed question like this, I always forget my crystal ball at home. And that's what kahan band hoga.
No, I mean, I think viewers right now with 3.5 minutes to the opening, you have to understand that if for the brave hearts, is there a call on the Nifty, Bank Nifty, or this is a TGIAF and you know, just sit it
that
out?
was on a light note. That's a very, very valid question because obviously, you know, everyone wants to trade. My suggestion is let the markets open, let 15-20 minutes settle. So usually I give out Nifty and Bank Nifty calls intraday based on the kind of moves that, you know, that has happened, and you know, we've got some setups which actually give us those indications. Right now what it is suggesting is that there could be some downward pressure after open. Whether we stabilize there and rebound or whether we go down from there, that is something that will happen through the day. So for now, I'll go with the same view. As long as 22,800, 23,000 is protected, there will be an opportunity to buy on dips. Bank Nifty, very similar. As long as 51,000 is protected, there will be a opportunity to buy on dip. From where, what level and exactly where do you buy from? I think that's something that the market will tell us during the day.
Okay, Nilesh Jain has joined in. He's head AVP Technical and Derivatives Research Centrum. We've been putting Kush on the spot this morning in studio. Nilesh, why don't you join in as well? We've seen the pre-open ending not as bad as would have expected. Do you think that we're going to see a recovery today? What is your Nifty outlook?
Good morning, everyone. So outlook is on a positive side, although we may see a negative start, but I think I'm getting a sense we may see a similar move that we saw yesterday as well towards the closing hour. We may see a rebound as well. So Bank Nifty is giving more confidence, similar to what we saw yesterday, and outperformance we are expecting in the Bank Nifty, and the strategy would be to buy on decline. Any dip towards 51,000 is a good buying level for the Bank Nifty. As of now, it's opening somewhere around 51,700. If at all we see any dip towards 51,400, 51,450, that can be a good entry point, and we are expecting a move towards 51,850 to 52,000. So these are the intraday levels, as well as positionally Bank Nifty is looking more attractive given the kind of participation that we have seen in the banking space yesterday. So better to focus on banking names. Nifty, the outlook is still on a positive side, but better to wait for Nifty to settle down, as Kush mentioned. At least for half an hour in the morning, we'll get a better picture which way the Nifty is heading. But as mentioned, I'm getting a sense that we may see Nifty closing about 23,200, and a weekly close about 23,200 will be considered as a positive close for the coming week. So with the stop loss below 23,100, Nifty is also buy.
Nilesh, 30 seconds exactly. Your call is on Bank of Baroda, I understand, and Patanjali. What's the view?
Right. So both the stocks are on buy list. Bank of Baroda, PSU banks as a whole are looking positive. So Bank of Baroda, we are expecting a move towards 245 with a stop loss below 231. It's a buy. Patanjali Food is another stock where we have seen a good breakout from a triangle formation, and Patanjali looks attractive for 1945 target with a stop loss below 1839. Patanjali Food is also a buy.
Okay, so those are some key calls. Well, Chakri Lokpriya, we'll get to you with some of these thoughts on specific pockets, because we haven't discussed IT today. It's just looking as brutal as it was yesterday, or maybe not as brutal. It was down 4% yesterday, but on open and the pre-open down about 1.5% is quite telling for what will happen to IT yet again. Infosys down 2.5%. Some others sulking. KPIT was down 8% yesterday. So I think we'll probably take both a tech and fundamental check on IT stocks as well. 26% now done from December peak is pretty steep. But here's how. We're starting off 0.25%. So really not a bad bet with banks holding out. This is the Q4 update, I would reckon. IT sulking 1.7%. Mid caps and small caps actually pretty well behaved. Not that bad really. In yesterday's session too, small caps were pretty strong. Let's get the heat map up on the screen and let's see the gainers. HDFC Bank, Bajaj Finance, the Q4 update impact, if you will. Nothing dramatic, but in the green. Actually very little green in the markets today, I must say. We're down 0.5%, but a fair degree of red. The quantum of red maybe suggests that the dips could be a bit more. Be that as it may, crude price fall, ONGC sees an impact. Infi amongst the IT names, along with Tech Mahindra and HCL Tech down in the red. Hindalco looking slightly soft as well. Watch out for that. Tata Motors continues to sulk, and with reason, because the downgrades continue there. Larsen is seeing 1.5% downtick. Reliance is seeing a bit of a downtick as well. Tamanna, I'm sure, will mark the oil marketing companies. If BPCL was here, would have shown. But be that as it may, I think watch out for the crude beneficiaries, because the ONGC is sulking essentially because of the crude price fall. So, well, banks on one side, tech on the other, Tamanna.
Yeah, and the banks on the one side are not really enough to lift the Nifty this morning. This is going to be a down day. It's going to be a tough morning. If there is a recovery from the second half, it really will be awaited. Right now, this is a rough day in the markets. There's no doubt about that. Private banks will be holding up. Financials will be in focus. This is why perhaps Bajaj Finance hanging on to the green with the skin of its teeth. Zomato, interesting note out this morning on Zomato, and maybe that's the impact that you're seeing. Let's pull up the broader markets just for a second before we move forward and see if the cut is as deep. Not as deep, one would say, but still about 1% down on the mid cap and about nearly 1% down or 0.75% down on the small cap 250. Let's pull up the sectoral heat map if we may and see what's happening there. PSU banks, we told you this morning, and we've been telling you since the closing trade yesterday as well, that it's going to be banks which is the safe haven, the port of call. Not that this is looking too safe, frankly, but we said this morning as well that PSU banks may be back in focus. Those updates from Bank of Baroda, SBI may just have helped. What is doing the worst? Nifty Metal, Nifty IT, anything with a global face and a global exposure is going to be under pressure next few days as the dust settles on tariffs, as the details are worked out, as those spreadsheets tell us which company is going to be hit to what extent. Nifty Metal actually the big loser this morning, 2% down. But having said that, the losses are nowhere near what we've been seeing on Wall Street, if that is any kind of relief to take forward. Let's go to individual stocks that are on our radar. Mazgaon Docks on our watch list this morning, and OFS announced by the Government of India 8% discount to current market price. Let's see how that has opened, 6% down. We call it a thumbs down. because more supply will hurt the stock. The stock was up yesterday as well. So 6% down on Moscow's docks on opening. The impact of the slide in crude is important to watch. Brent under $70, and anything that is going to be impacted positively is moving up. It's not just Interglobe and SpiceJet. So you see the airlines on one end, you will see all of the refineries on the other end. Typically, as is expected, downstream players are up in the green, while upstream ONGC in the red. As far as the paints space is concerned, Berger doing okay, about 1% up. So that's the whole crude bit of it. Business updates is the other thing that matters, and I'm going to pull up Bandhan. I'm going to pull up UCO and Bank of Baroda. Bank of Baroda strong, about 1.5% up. UCO again, good set of business updates. Bandhan not so much. Optically, the numbers looked okay, but Street seems on the fence when it comes to Bandhan Bank. A tough kind of a morning overall, and difficult to pick some winners. I would say that the clear loser though is IT stocks. Nifty IT again getting hammered.
Tamanna, a few of the conversations that we're having this morning have actually turned out. HDFC Bank, top gainer on the Nifty 50, positive update. Avenue Supermart, I want to point this out, 3.5% lower at this juncture on account of that quarterly update, and in fact losing further ground at this point. I want to take a quick view from Chakri. Chakri, 17% standalone revenue growth in the fourth quarter, and to a certain extent, yes, store addition has been looked at positively, but the negative aspect is that the trajectory of growth was the same as they saw in the third quarter, and so therefore nothing really materially changing on the ground, which is in effect a negative. So how would you look at this business? Do you anticipate the pressure on margins will continue on account of the quick commerce challenge?
Two or three things. One is, there's going to be slightly more income in the hands of the consumer starting April 1st, a couple of days ago. So some amount of addition. Second, there is, as far as e-commerce is concerned, quick commerce is concerned, there are certain restrictions may come in place in terms of the discounts that they can offer. Third, and therefore a combination of this, some amount of the share can shift back to the real stores. So against this backdrop, but Avenue Supermarket is growing really fast, expanding stores that will again impact the margins. So net, I think I'd still kind of be on the sidelines on the Avenue Supermarket.
Because this is an entire pack, and we assumed that this would take place, and it often does. When there's a sharp move on crude, Chakri, on the downside, you have OMCs on one end that react pretty sharply. HPCL, BPCL up 3%, 2%, 2.4% respectively. IOC up about 1.5%. And ONGC on the other end, you have upstream companies that lose ground. But specifically on the downstream companies, Chakri, on the one side, you can expect that their margins, their marketing, their GRNs will improve. But then how do you see the business operating going forward? Inventory losses are a concern, right?
There's likely to be some amount of inventory losses. Second is, there might actually be a cut in fuel prices if the current oil prices sustain at lower levels. So if that happens, then clearly GRMs, the beneficial impact of GRMs is unlikely to be as much as we think it to be. So it depends upon whether oil price will stay low and whether Indian petrol prices, diesel prices will come down or not.
Nifty IT is leading the way lower for the bourses, 2.27% lower now, and that led to nearly 1% fall in the Nifty now, 204 points. So Kush called it. We're circa 23,000 now, 50 points away from it. And now the small cap index too is 1.55% lower. Remember, viewers, while yesterday we may have done okay, we were not facing a US market which had cracked 4-5%. This is India being collateral damage, even if fundamentally the Indian markets and the economy don't get impacted as much as some of the others because of the tariffs. This is collateral damage. Make no mistake, if the US markets and the other world markets are correcting, there is no way that India will not correct. As of now, we do not have exceptional growth. But before we talk about the losers, or maybe I want to talk about two pockets, right? So with Kush, I want to talk about Interglobe Aviation and of course the Nifty call, and then with Nilesh, I do want to talk about IT. So Kush, let me get to you first. A quick call. Do you take any trades on the Nifty right now? And of course, couple that up with a view on Interglobe Aviation, which is bucking the trend.
Sure. First, spot on when you say that, when the world markets won't do well, India obviously will fall in the same camp. We may have slight outperformance in the sense if they fall 4%, we might fall 3.5. But yes, unless the results start to pick up. So perfectly, aligned with what even my reading is, on the Nifty. Now, as far as the call on Nifty goes, just yet, what do? Stay away for now, because the reason is that we did discuss 59 points lower on pre-open, but now we're down close to 200 points. But now we're looking at that 23,000 support kicking in. You've got the convergence of the 50 and the 20-day moving average put support also. So you've got the Nifty closer to the support zone. So you don't want to short sell at this point in time. You might not want to go long as well, because the momentum on the downside right now is pretty heavy. So for me, Nifty is an avoid. Similar for Bank Nifty, because it's given up all the gains. So for now, Nifty, Bank Nifty both are a no trade and avoid at the moment. Now, as far as Indigo goes, there has been negative divergences on the hourly, on the daily charts for a while now. With today's move, some of those are getting negated. However, what's also happening is that there is a very tight range that is building up on Indigo, which is 49.50, and I'm just rounding it off, it's actually 49.65, but 49.50 on the downside and about 5,200 on the upside. This is the range that is acting up on Indigo. We all know that the move on this one for the last 3.5 months has been stellar, and some consolidation is absolutely par for the course. But if I were to take fresh long positions, for me it would be once the 52 threshold is crossed, where the near-term selling will be done, and then the stock could see a fresh up move. So for now, if you've got a long position, continue holding on to it with the stop loss around the 49.50 mark. But for fresh long positions, you might want to wait for the 5,200 resistance to be taken out.
Okay, and Nilesh, a word on information technology. Of course, if you have some opening thoughts on the index, welcome. But I definitely want a view on IT, because it's sinking like there is no tomorrow.
Right, so Nifty IT pack yesterday witnessed a breakdown, and structure-wise, it looks like it is heading towards 30,600 to 33,500 zone. But after such a sharp sell-off that we have seen in last two sessions, there could be possibility of a strong pullback, but this pullback is unlikely to be sustainable, because if you look at the index heavyweight counters like TCS, Infosys, Wipro, SLTech, in fact all these stocks have given a structural breakdown. So pullbacks are likely to get sold into, and we can expect another leg on the lower side. As far as Nifty IT index is concerned, we are expecting it to test 36,800 to 36,600, and a couple of stocks that are looking weak and can be sold. So TCS is a sell on rise with a stop loss below stop loss above 34.20. And downside targets are intact at 3,300 to 3,250. Apart from that, Wipro is another stock where we have seen a big breakdown yesterday. It looks like it is heading towards 240 to 235, and a stop loss can be placed at 255. Now, coming to index, the Nifty index broke below its important support of 23,100. The next support is at 23,000. That's the strike where we have seen huge amount of put writing. The maximum OI concentration is also placed at 23,000. So from intraday point of view, if Nifty sustains about 20,000, there could be possibility of a pullback. But as of now, there is no trade in the index. Better to wait for some more time. Better to get more clarity.
Okay. All right. So that's information that you need to keep in mind. By the way, let's talk about a few stocks that are reacting very negatively at this point. Some understandably so. Mazagon Dock, of course, there is the government stake sale to talk about, and the stock is down about 6% because the price was dramatically lower than yesterday's closing price, and the stock has gone up quite dramatically in the recent past. ONGC now down over 5% on the back of that crude update, and a significant knock being taken. Bharat Forge, probably on account of the impact of expected decline in US business, is down about 5% at this point, taking a bit of a hit. Vedanta down about 4%. Hindalco in the metal pack also losing about 4.3%. Now, interesting thing, Tata Motors, as it continues to get downgraded by brokerages and the negative news keeps trickling in, is down about 4% or so. Kush, you had a sell call on Tata Motors. Targets hit?
Oh, all of them. First target 645, second 635, and then some more. So my suggestion, if you have a short position, on Tata Motors, by all means continue to hold. Yesterday the closing was at the low point of the day, and you're seeing, the stock continue from there on the downside. Now, long-term supports, and by long-term I mean like a decadal-long support, comes in at 600, 610 odd levels. Won't be surprised to see the stock hit those levels. If it breaks those, then you're staring at much deeper fall. But for now, it looks like 615, 610 kind of levels are in place. So if you've got those short positions, continue riding onto them with a trailing stop loss around the 640 mark at the moment.
Chakri, now the question is how much damage can be anticipated to autos? Because one, the business impact not yet quite decided because it's open to negotiations, but the sentiment clearly negative. Assuming that no changes happen in the negotiations, how much downside for some of these because of the multiple derating, auto components in particular?
For the automobile companies, the OEMs, Bajaj Auto, Hero Motors, TVS Motors, there is hardly any impact because the tariff does not really impact the price points, and there are hardly any exports to the US. There is some amount of damage to the auto ancillary companies who have exposure to the US. And cumulatively, it's only about it's a small industry compared to the overall exports. It's about 2.5 billion odd. So I think that, therefore, individual companies is what you need to look at as far as auto ancillaries are concerned. OEMs, no impact.
Okay. A very quick view on a couple of these private sector banks. Kush, I'm looking at something like an IDFC First Bank, IndusInd Bank, even AU Small actually losing ground today. Axis down about 1%. You would avoid getting into any of these, I would assume, or what would you do?
So, Alex, for me, the pecking order is very clear. And I mean, if you will recall, this is the exact discussion we had, which is, for the likes of AU Bank and Bandhan Bank, the move, in the last few sessions has been rather phenomenal. But then, the volatility creeping in again. If I were to pick the bank, something in the banking space, it will be HDFC, ICICI, and Kotak from the private space, and from the PSU space, it will be SBI, Canara Bank, and PNB. Anything outside of these has not really impressed on the price action front, on the technical front, so much so as to instill that confidence that yes, these rallies are here to sustain. The names that I mentioned could also see some sort of consolidation, perhaps some profit booking also, but there is margin of safety there. So that is why I would stick to some of these names. Axis Bank hasn't really done all that much. It's risen quite a bit, but then the short selling is apparent for the last 5-6 sessions. So some more downside could well continue. IDFC Bank, very similar case. So yeah, I'll be very selective within the banking space as well.
Okay. Okay, so by the way, Reliance Industries is also losing ground today, down about 2.3% and proving to be quite the weight on the benchmark. You have only 8 advances on the Nifty 50. Among them, of course, HDFC Bank, which is holding fort and gaining about a percent, 1.6% or thereabouts, and proving to be at least some semblance of balance on the other side of the seesaw, so to speak. Thank you so much, gentlemen, for joining us this morning. Kush, Nilesh, as well as Chakri, pleasure speaking with you as always, and thanks for taking the time. Now, IT companies, of course, in India have borne the most amount of the brunt in the recent past on account of those Trump tariff announcements, not on account of a direct impact, but because of the impact that is likely on the US economy. Mastech is one of those companies which is seeing the impact of tariffs along with the abolition of its key client NHS England. What does this mean for the company and what's the path ahead? Let's bring in Puneet to tell you something more before we speak to the management. Puneet?
Well, thanks for that. So definitely, the Trump tariff impact having an indirect impact essentially on IT companies, and most brokerages have been maintaining that a slower economy or a mild recession as well might impact the decision making for the companies to spend more on IT as a consumer discretionary angle. That's the first key reason that we're speaking to the management. There's just 3 key things that we'd want to know about. The first one's, of course, the US share. Now, for Mastech, it's around 28.3% US exposure. Roughly, the UK and Europe is the biggest exposure for the company at 56%. So, what kind of impact are they anticipating in terms of US revenue going forward, and also on the onshoring as well? The company has roughly about 5,600 odd employees, 5,200 odd employees, and out of that, 3,600 are based in India. Does that mean that because of the tariffs, there'll be a lot of onshoring in the US or in the UK is what they're anticipating? I think that was one key aspect. And on NHS specifically, because, we had brokerages like HDFC come out with notes specifying that, NHS UK has now been merged essentially with a smaller department, which is the Department of Health and Social Care. How does that impact the contracts for something like Mastech? Because healthcare vertical is around 22% for the company's revenue in terms of the split, as well as in the UK, which is the bigger market. That is something that we'd want to know as well going forward. So these two key aspects of both these countries will be something to watch out for from the management in this particular conversation.
Thank you for that setup, Puneet. Ashank Desai, Chairman of Mastech, with us. Ashank, I must say, great pleasure speaking with you after a while, and glad to have you on NDTV Profit.
Great to see you after a long time.
Yeah, no, completely. And I think very important time for this conversation as well. So let me start with, the broad understanding of the panic. Of course, we're seeing panic from investor point of view in IT stocks, a lot of uncertainty out there. How are you viewing it as someone who has seen so many cycles? Is what we're seeing right now as a threat to the sector in terms of what happens to the US economy the biggest yet?
As you rightly said, I have seen these cycles for last 40 years since we started Mastech, and we all started NASCOM also 35 years here. And we have seen these cycles coming up and coming down, and its impact on the IT industry. So if you look at it from that lens, obviously a good economy does help us because there is definitely a good discretionary spending that happens. However, you must know that even in the cases of recession, there has been an increase in the demand for IT industry because of the offshore work that we do, which is a cost saving. So whenever there is a recession, there is a cost cutting in economy. Again, there is a demand which happens more for the offshore kind of work. So the impact of these fluctuations on IT industry has not been some violent and very large. There is a positive impact, there is a negative side, but it gets calibrated because of the opposing forces of doing more work offshore and so on. So if I put it all that together and look at some of the things that are happening in US, I am not kind of over concerned in terms of what would impact on the IT industry. A, because some of the changes that administration is doing also are going to be positive in terms of tax cuts and so on, what they are saying, which they have not done so far. But that would increase the discretionary spend. And come back to tariff, which of course everybody is discussing. To my mind, we don't know what is its impact. Of course, there are administrations saying it is going to be positive, but it may be a little bit in the medium term, and negative may come immediately. So what I'm saying is we need to be cautious about what would happen in terms of...
Unfortunately, the audio line you are on is a little patchy. I know you're joining us from your webcam. May I request you to speak a little louder? I'm so sorry for this. Okay. So that our viewers can actually understand what you're saying.
Okay.
Yeah.
Can you hear me now better?
This is better. This is actually better. Okay, let me come to the follow-up. I get the point that fears of recession lead to lower discretionary spends. Hence, it's looking tough for Indian IT companies. What is the pivot in that case? What is the action plan? Do you just wait for this storm to pass, or what do you do next? I'm just wondering, what are you thinking strategically?
No, let me complete then what I said. Maybe that was not heard. What I said is, if there is a recession or there is an economic pressure, there is a demand for offshore which happens because of cost saving that happens because of offshoring. So there is a countervailing force if there is a recession, and that kind of balances some of the impact and doesn't make it so negative as everybody thinks. So that's the reason I am saying that we should be cautious about it, but let us not get over negative reaction about what will happen in US economy. That is the first point I made. I'm saying it is discretionary spend may have impact, but there will be positive impact in terms of what may happen in terms of cost cutting. And that is good for Indian IT industry. We do that for American economy. So that's the plus point I'm saying. So let's not get over concerned is the point I'm making. The second one that I'm saying is that the whole issue of tax cuts and so on, which are going to happen hopefully over a period of time, would have a positive impact too. that will be a discretionary spend which will increase. Now that has not yet happened. When it will happen, we don't know all of that. So I'm saying if you put all of them together, I don't know whether we should be so over concerned what will happen to Indian IT industry because of US changes. That's the point I'm making.
But Mr. Desai, good morning, Neeraj here. If the idea also is to create jobs in the US, which is Donald Trump's pet theme, would it not in fact hit Indian IT companies, if not in business, then in terms of personnel hiring and therefore costs?
See, Neeraj, the whole issue is if you want to retain jobs in US, it is not as if Indian IT companies are not hiring in US. Let us be clear. All of us have almost 25 to 30% of our employees working in those countries. And we end up hiring local talent, which is Indian citizens and local citizens, if I may call them. And so to that impact, the kind of work that we are doing is not 100% done here. There is sufficient work done offshore, and we do create jobs in all of those countries. So that's point one. Point two is, let us realize that there is a shortage of demand in IT. Let us be absolutely clear. If there is a pressure on doing jobs in the US, there is going to be a pressure from corporations to stop the work. They have to do it somewhere. That's the point I'm making. If there is going to be pressure for the talent, then the work moves offshore because that's where talent is available. So the point I'm making is some of these issues that we make about jobs, about recession, there is a fungibility across this talent and the demand and the work because of our offshore model. And that allows us to be flexible enough and our customers to be flexible enough to work across and see that their work is getting done. That's the point I'm making. We have perfected this model over the last 35, 40 years as an IT industry, and that is why it is giving a stability and growth to all of us. Let's not forget that. There are cycles and cycles that have happened in Europe. We had 2008. Did we get into a lot of difficulty? Yes, we had a little bit of down, obviously, in the industry, but we surged back. We had .com, of course, many years ago, and so on. So the point I'm making is there is a resilient business model that we have built over many years and perfected it. It got tested in COVID area. How even if there was no hiring in onshore, we could deliver to our customer by doing work offshore. And not offshore working at home. You see, that's the point.
So then let me ask you, sir, yes, it may be cyclical. Trying to understand that if we are in a down cycle right now because of slower decision making, etc., how prolonged could this down cycle be? It may pick up later on, but could this last 6, 9 months, 12 months, or 18 months, or is it difficult to say?
You mean down cycle of US economy?
And just the business coming to companies. I mean, the belief right now is that US economy decision making, corporate decision making would be slow, ordering activity would be slow, and therefore Indian companies, the sector growth probably pegged at 3-4% for FY26. How prolonged could this cycle be, according to you?
See, I think we should decouple this 3, 4, 5, 6% growth which has happened over the last 2 years with the recession and economic issues. Then we will get a better perspective. What really happened was during COVID, there was a great demand to go do IT work because nothing was happening physically. So people spent money and Indian industry did well, as all of you know, Neeraj. Because of that, there was an overspend on IT in those 2-3 years, and hence there was a calibration that has happened over the last 2 years. So that's the bigger point as far as the slowness of IT industry over the last 2 years. So it has nothing to do with economy, as you know. Now, if economy doesn't do well, I am repeating that point again. The impact of that is not all negative. It is negative to the extent of discretionary spend, but it is positive in terms of what can be done offshore. So the point I'm making is, let's not get over concerned in terms of negative impact, because it is going to be calibrated with something which happens offshore. And that is what created all this permanency of growth in IT industry over last 25 years. We have never gone negative, right? We have always grown year after year, whatever has happened in US economy or in the global economy.
Okay.
Why? Because there is this, what I would call a
sure.
in terms of
Okay, Mr. Desai, can we come? Sure, sir. Sure, sir. Can we come to Mastech specifically and what that means for you? Would it be seen as a bit of a relief that most of your revenue is coming in from Europe and UK, not so much US? You're relatively less dependent. Or do you see the overspill impacting you as well? I mean, you're 59, close to 60% of your revenue is coming from US and from UK and Europe.
Yes. Yeah, to that extent, we are less impacted if there is going to be any impact. That's absolutely clear. Indian IT industry 65%. We are not that impacted by US. That's a fact, and that's a good side of Mastech specifically. You are right.
Okay, and from the UK perspective specifically, what they have done recently with the NHS, where they want to restructure it and merge it. NHS, if I'm not mistaken, is 22% of your revenue from the region. NHS is a big client for you, the National Health Service there. Just explain to us what impact that has.
I think we don't disclose company-wise market revenue. And 22% that we talked about is healthcare as a sector for Mastech as a company.
Not NHS.
We do work in US also for healthcare with hospitals and payers. And we work in US, as you know, UK. So it's a total number, 22%. That is the sector, not a particular customer. So that's point one. Point two, coming to NHS. See, the whole issue is NHS has been going through restructuring over last 3 or 4 years. There was a time when there was what is called as NHS Digital, which got merged into NHS England. And that did not impact us so greatly because the work and contracts were kept as it is. Only the work was rescheduled and we continued to work. And as you know, we continued our growth in healthcare over last 3-4 years in spite of structural change in NHS. So that's point one. Now that point has gone one level above now, when NHS England and NHS is now moved to, as you said, HSSC. We do not see that as a negative impact because the continuation of the contracts will continue in new organizations. There will be, of course, new decision makers, there will be new people that will be involved in decisions, but the existing contracts and what we have a pipeline, that work doesn't get changed. There is no impact on IT spend because of this change in structure, is what I want to make it clear. And we had a press release given on that, giving the details. So that's the larger point about the NHS that we are talking about. So we have seen this cycle earlier. We have passed through that cycle. This is moving up again, and we will take in stride that.
No, so let me reiterate this. The merging of NHS into health services doesn't make any immediate impact to you because you're expecting those contracts to carry over with the new entity.
Yes.
Okay. In terms of outlook, and I know you're yet to report Q4, but what I have in front of me is, of course, Q3. Do you think that you are going to see another tough quarter because Q3 was also fairly rough?
I think we are so close to the results. I would not like to talk.
No, of course, which is why I'm not asking you about numbers.
We're less than 2 weeks away from the result announcement. So I would not make any comments as such on specific results. Whatever guidance we have given during our investor call, we will continue with that as there is not any change compared to that.
Okay.
We had pressure Q3, but please remember that was on the back of Q2, which was a very good quarter for us. So in some of our businesses, when there is a discretionary spend, you must remember that it is not just an outsourcing contract. We do large mission critical projects. Between some of the project completions, some of these issues can change the revenue over from quarter to quarter. The better way to look at it is year-on-year growth, if you ask me really. And we have done better than industry in terms of year-on-year growth, as we have announced it. In terms of order book, which is more than upper end of teens, and also the revenue year-on-year growth. If you look even at quarter 3.
Okay. Mr. Desai, one final question from my end. 2025 is sieged with worries on AI impact on the IT sector and maybe some of the business being taken away, and now this. Is this a combination of two which brings about a cycle which is in perception, if not in reality, the weakest that you would have seen in the last many years, or is this one of the many that you believe you will sail through?
As I said again, we have
you will sail through. Okay.
We have seen these cycles year after year. There was a cycle of what we call is moving from mainframe to Unix, then Unix from the client to client server, from client server to the whole issue of what has happened in terms of infrastructure and digital movement and so on. So some of these changes, of course, bring some uncertainty. I am not saying, I don't want to completely say there is nothing changes. And AI does bring a discontinuity. I am not denying that, but it is again positive part of it also could be seen. Today, I am getting the applications that I would not have done without AI. As I speak, we work in healthcare and few other industries where AI is used. And if there was no AI, I would not have got that contract.
Okay.
There is this new applications which are getting built.
Sure.
Which is what happens.
Sure. Okay. Okay. We'll catch up again, Mr. Desai. This was a great conversation. Thank you so much. The word coming from a veteran of the industry is that Indian IT is more resilient than it seems right now. What also may boost hopes of a climb down is what President Trump said on board Air Force One when asked about the tariffs and whether there's room for negotiation. Listen in.
It depends. If somebody said that we're going to give you something that's so phenomenal, as long as they're giving us something that's good. For instance, with TikTok as an example, we have a situation with TikTok where China will probably say, we'll approve a deal, but will you do something on the tariff? The tariffs give us great power to negotiate. Always have. I've used them very well in the first administration, as you saw, but now we're taking it to a whole new level because it's a worldwide situation. And it's very exciting to see.
We'll wait and see what happens there. Meanwhile, focus on what's happening in the markets right now. Bharat Forge is in focus. A JP Morgan note with concerns on Bharat Forge is really bringing that stock to some of the lowest levels of the day. Pain point there. I want to pull up what's happening with Zomato though. Zomato has been in focus as well because of this Goldman Sachs note. They've maintained a buy, but they have cut the target price. Talk about 1.5% down. What is Goldman Sachs saying, Mahima?
So, as you rightly mentioned, they've cut the target price a tad bit from 330 to around 310 right now. What they're saying is that the pressure on the stock is because of two reasons. One, there is flat growth where food delivery is concerned. And secondly, with the kind of store expansion that Blinkit is doing, Blinkit's margins will be under pressure. And this is on the back of competition as well. What they're saying is that the pessimism on the stock is overdone and they expect Zomato to remain one of the fastest growing internet companies. They're also saying that the last time when the stock saw a significant pressure was back when again food delivery was under pressure, but the stock did see a recovery in a very short period of time. They're also saying that they see some tailwinds in the near term and the positive impact of tax cuts will start from FY26 and this will benefit the stock position overall. What they're saying is that the quick commerce space is very large and when all the competition is ruled out after some given point of time, Blinkit will have a larger share when it comes to profits in the quick commerce space. They also believe that given the market structure, risk to the food delivery margins are on the upside and they see a 28% adjusted EBITDA CAGR for Zomato food delivery segment over FY25 to 28. So this is the overall view as to what Goldman Sachs is saying about Zomato so far.
Okay, thank you for that, Mahima. But let's get to the big conversation this morning. Sandeep Tandon, founder and CIO of Quant Capital, is with us. Sandeep, great to have you back on NDTV Profit. Always a pleasure to speak with you here. And, at an important time when there is so much uncertainty out there. Now, between all the variety of views that it will get better, there will be negotiations on tariffs, India will be relatively better off, wondering which end of the spectrum you are on, because one end is also saying this is just gloom, doom, and more doom.
Yeah, I tell you, the way I look at this thing, this is a more of a negotiating tactics which Trump is playing, and we have to understand that there is no point getting paranoid about it and unnecessarily getting capitulated at the bottom of the cycle. So we are not that negative the way prices sometimes indicate. So we have to understand the difference between narrative and the reality. Okay. Now, the way I will read it, obviously the one round of announcement is done. So worst is behind us. Now, if you really sit down and analyze the statement or foresee what it talks about very clearly, this is the announcement. Once you start talking about bilateral thing, it can come down. So there are certain conditions. And if I can also say that India is one country who has already taken the lead. Okay, India was the first country to visit to US. Okay, and last week, if I'm not wrong, their delegation was very much in Delhi, and we are in advanced stage of negotiation. So I think as a country, we think we have taken right steps. Okay, and ultimately, US is a large economy, and we have to sort out whatever the challenges we are facing. I think I'm optimistic. This is the worst case scenario outcome we have seen. From here. It can only improve. So no point getting capitulated at this point in time. In fact, India actually behaved quite well as compared to global market yesterday. It showcased that India could be a hiding space as compared to what the turmoil you are seeing in the global market. And we also don't have to forget that India is a very large domestic driven economy. So our impact will be relatively less. And I always say, look at not only an absolute basis, absolutes are important, but relatives are more important. So relative to other markets, the tariff differential, we are beneficiaries. So I think it's a great buying opportunity in a sector which you like, rather than getting too nervous about it at this point of time.
You've led me beautifully to the next point, the sector which you like. Sandeep, to hear from you that this is a time to go out and buy, this is a buying opportunity, heartening when there's so much gloom and doom out there. Would you stick to the tried and tested financials, or you see more space than sectors like auto consumption?
See, I think obviously consumption broadly is a very broad sector, is the biggest beneficiary in the budget. So consumption theme should play out very well from a longer term perspective. Then in the current environment, our focus is more from a domestic economy, large infrastructure space. Okay, if you really look at even the NBFC, given the interest rate pressure which can come down. So I think the way you look at the domestic company, insurance sectors, so in the hospitality space, even we like pharma, despite some narrative is floating around today. I think is a great sector because cost of production of generic drugs in the US will be few times what you do it out here. So far exemption we have seen, but even some tariff comes, I think Indian companies are in the position to pass immediately. So I think we have to wait and watch rather than just reacting on some interviews or some noise which is floating in the market. I think it's a great opportunity. As long you have earning visibility, whether it's from the domestic perspective or from global perspective, I think, and valuations are attractive, I'll be all in such names.
Sandeep, good morning, Neeraj here. Now,
yeah, Neeraj.
Could it well happen, Sandeep, that the index stays in a consolidation period because of the uncertainty and not necessarily actual moves happening? There could be negotiations, etc. And therefore, individual pockets of strength and weakness would arise. The way IT is correcting so much, despite the fact that the Nifty is largely well behaved, as you said.
So I'm not ruling out that also, but what I'm saying this year is obviously we said that second half will be better than first half, and within first quarter will be worse and second quarter will be slightly better. So with that background, I will say yes, we have seen last 4 years has been extraordinary, and we have been saying that easy phase of bull run is over. But we are still in bull run, but we are in difficult phase of bull run. And to tackle a difficult phase of world bull run, your strategy has to be different. It has to be significantly different than what we all did in last 4 years. So that I think the first thing, the mindset has to change. This I have been highlighting for last many quarters now, saying that the biggest risk in India is that our own expectation risk, because we have built so much expectation in last few years. The benchmark has changed. Once you bring down your expectation, then you will find opportunity. When you go back and look for 12-15% opportunity, you will get. The problem is that when you have 40-50-80% expectation and you are unable to fulfill, the frustration comes in, and there's the same markets are not performing. But from the current level, I will look for a buying opportunity in select name, and there are enough opportunity available. We have to just be slightly patient and bring down our expectation. I think end of the day, you will be very happy.
Got it. Sandeep, the other question is, I mean, and I think, if I'm not wrong, I heard you say that you will probably prefer domestic cyclicals as opposed to globally exposed firms. Now, the thing is, I mean, just trying to understand, if there is a very large dip that comes into some of these globally exposed firms at a point of time when we are saying that there are going to be negotiations, Donald Trump himself has said that he's open for negotiations if there are out there, right? Could some of the way the dip in the last 4 months gave an opportunity in the month of March, right? Could some of these give an opportunity? There is some incessant punishment being meted out to autos, to IT, etc. Or would you rather not veer down that path right now?
No, the Dheeraj is that if clarity emerges, let's say in 6 months' time, 2 weeks' time, 3 weeks' time, we don't know the timeline,
Sure,
but I
okay.
expect that in next 1 quarter, it has to settle. So, okay, this cannot go for a long period of time. So you have to look at from Trump perspective, his term has just started. He will also like to settle everything in 1 or 2 quarters so that remaining 3.5 years will be better for him in terms of managing everything. And that's the way I read it. So if we do get a clarity that this sort of tariff has going to come down, or these are sector will be exempt, or these are the new revised tariff downwards, I think we will get opportunity, and by the time you will see capitulative move. Like we were very early to talk about in the month of January that we have cut down our auto exposure, or even we don't have IT exposure with very hardly any names we have. So the background was very clear. We were looking at the US market correction. I had said very openly that we expect 15-20% correction in the NASDAQ. Okay, if that is the case, then how you play? Better to move out from such names. But now they have corrected meaningfully. I'm not saying they are close to a bottoming characteristic, which we typically look at. But one day, if it emerges, I think I will buy it. We don't have any love or hate relationship with any stocks. Okay, when we felt it was not appropriate time, we moved out. And if some buying opportunity come and we really see the capitulative move happening in auto or IT, I will be the first buyer.
What about pharma? I'm just going to, Sandeep, what President Trump has said. Trump has said pharma will come at a level you haven't seen before. I'm quoting here. He says pharma is a separate category. We'll announce tariffs on pharma sometime in the near future. Pharma tariffs are under review right now. So now 2 things with this, Sandeep. One is the unpredictability of this whole situation. As of yesterday, pharma was the relief sector, right? Because it had been skipped for tariffs. Now you have Trump coming and saying that pharma is under review and you'll see tariffs like never before. And you're seeing, of course, the stocks also react quite sharply. This is the problem with picking sectors. Would it be safer to choose companies which are domestic facing?
No, I agree. But see, we also have to understand the Trump's compulsion also. Okay, making statement is very easy. Okay, do they have resources? Look at the COVID time, what happened. Special emphasis was given on the pharma side. Where is the competition when it comes to pharma from India perspective? Hardly anybody. They will not take anything from China. Is there anywhere else for generic apart from Europe where they do have some formulation and certain specific thing? But apart from Europe, nothing is there. So I think US is heavily dependent on India as far as generic is concerned. And we have to keep in mind, you cannot just ignore. And they have their own insurance bills will go. See, ultimately, if prices moves away, tariff come, let's say hypothetical example, I expect at least 10% because that's the way sectoral thing and reciprocal tariff is around 10%. The 10% can be reality. But can this 10% can be passed by the domestic guys? Answer is yes. Okay. They can easily pass it. Now the challenge will come for US because ultimately neither US company will absorb, not even the insurance company will absorb these costs. So ultimately it will pass to the consumer, and that will pain a lot to the American citizen. And I think Mr. Trump is aware of these are, I will still say these are all techniques to settle down the matter. It's a tough bargainer. He will shake you so much that you will come on the table and settle something. So I think it's a part of a narrative. I will not read too much into it unless it happens.
Would you buy Pharma then? Because the point you made was interesting, Sandeep. That what will they do? What is the alternative? Even if you want to start manufacturing in America, it's going to take some time. You can't disrupt supply chains for something like for Pharma.
A, it will take 3-4 years to manufacture, and B, it will 3 to 4 times the cost what you get from India. So it does not make sense, and nobody will set up a plant for 4 years his term, because we don't know what will happen in the next tenure, or who will come and change it. So I don't think talking about setting up plant, manufacturing in America is a great thesis, but it is not pragmatic to implement these imagination.
You buy then? I mean, no stock specific, but I'm just in a directional sense.
Answer is yes. Answer is yes, because earnings are there, so it's not like we have to worry about it, So we have seen, if you recollect now, something similar is getting like COVID sort of scenario happen. There was a steep vertical fall, and then we have seen in subsequent month a sharp rally, and people were not able to participate in that. So when opportunity comes, people become skeptical. And as a house, we think this is a great opportunity. Wherever you have earning visibility and valuations are cheap, I don't think we need to worry too much about it. The problem will only start when your valuations are very much stretched. They're grossly overowned stocks, and earning visibility is in the question mark. Those are the companies or the stocks which we have to avoid.
Filter, very clear filter to look at, and that's an important guideline there coming from Sandeep Tandon. Thank you so much for your time, Sandeep. Always a pleasure.
Yeah, thank you.
Yeah, we'll take a very short break. Meanwhile, Nifty below 23,000 is looking like a rough ride. I mean, buckle in because it could get worse. What has come in on Pharma is highlighting that, which is why you're seeing the likes of an Aurobindo nearly 7% down at this point. Pharma, auto, metals, really the only spot to hide would be banks. But we'll take a very short break. On the other side, bits of that conversation that Neeraj, you've had with Pidilite, and especially on tariffs. That'll be interesting to hear.
Yeah, we hear one of the key dons of India Inc. speak about the impact on tariffs on India Inc. So look, watch out for that conversation coming up.
Whenever a film sank in 2000s, it was always flop actor. मेरी तरफ नहीं देख रहा देखो तो सही. I compare an actor's career like the stock market. Sometimes your stocks are low, right? And when your stocks are low, no one's buying. Sometimes your movies do well and your stocks are on the rise, and everyone's suddenly buying that stock.
What point do you think that the film career perhaps is not going the way that you thought?
Itch of wanting to be an entrepreneur started itching a little more, and I wanted to scratch it.
One of the most important lessons is to know when to pivot.
The burn was far more than the earn. We were burning, and I was watching my money just go out, and like, oh my God, what's going on here?
He sold most of his stock, 80%, as on that date.
We have requested the management to come and speak to us. They asked us, what questions will you ask? We've sent it to them. They don't want to answer it, so then let's put it to our viewers as well.
7 key questions, right? How is it that 2,000 crore goes unnoticed by all of these auditors?
Is seeking more information on the trades and the all the transaction which has happened from the exchanges, both NSE and BSE.
The Reserve Bank of India.
welcome back. Losses deepening across the board. I just want to pull up the advanced decline ratio because even the bank nifty has now dipped into the red, relatively doing better, but of course all across you're seeing a sea of red. The nifty below the 23,000 mark, advanced decline ratio decidedly bearish and skewed as we speak. Pharma is the latest casualty to the Trump tornado, with these statements coming up which you're seeing on your screen as well, with Trump saying there will be a separate category of tariffs for pharma, almost seeming to say that don't worry, we didn't forget about tariffs on pharma, even though it was in the exceptions list. All right, let's get to the next leg of our conversation. We're joined by Ashish Gupta, Chief Investment Officer at Axis AMC. Ashish, very good morning to you and great to speak with you.
Good morning.
It's an unenviable position for anyone who has to take investment calls on large sums of money right now. So just with that, I understand how this must be for you right now, because we have the relatively easier question to ask the relatively easier job to ask the question. So let me start by doing that. How really do you navigate this time when you're looking at where to invest?
No, Tamanna, I think it's very important at times like these to keep a long-term perspective and not react to every news flow that is going to come through. As material as announcements yesterday were on the Trump tariffs, we have to recognize that this is only the Act 1, right? There is going to be multiple cascading impacts of this, and even if we assume that there is no pullback in these tariffs, which of course is a very, very big assumption, so most likely there will be some changes to these announcements in the coming days. There will be bilateral treaties that will be drawn. So it is very early to make conclusive decisions based on this information. But even leaving that aside, there is going to be second and third order impacts of this that will be in the realm of not just economics, but in geopolitics. Countries will look to realign themselves. And there will be impact not just on equity markets. I think currency market impacts is probably the biggest area to watch out for, because historically, if there are big changes to trade patterns, there is big changes on the currency side, and we have not seen any of that yet. So I think the only thing we can be certain is that markets will be very choppy over the coming months. It is going to be a high period of uncertainty. I don't think the right strategy to follow at this point of time is going to be just pick out winners or losers from any announcement that is going to come in. So you have to really have a very balanced, diversified portfolios in times like these, and try to manage the volatility through that.
Okay. Ashish, good morning. Neeraj here. I'm just trying to understand. Either swapping the portfolio for themes or putting in new money to work, is it getting skewed towards, let's say, the domestic predictable plays versus the global cyclicals? Whereas the global cyclicals like IT, for example, down 25% since the December peak. So in some sense, there has been a serious value erosion there.
No, certainly. But unfortunately, even the domestic plays are not going to be completely immune to it, right? You look at the IT sector pullback, but you look at the pullback in the real estate sector in India, right? It's a completely domestic play, but it has pulled back because there's a concern on what's going to be the wealth effect in India because of what's happening in the financial market. So I think the correlations are going to run deep. And many of the correlations are going to break the patterns that have historically followed. So even if you look overnight, so typically when there is a risk-off trade globally, there's a flight to safety, you see the dollar strengthening. right? People take dollar trade as a safe haven trade, but if you see the dollar index is down below 102 now. So I think we have to be very careful of trying to have a very skewed portfolio in times like these. And I think top-down theme-based investing is going to be difficult. I think theme-based investing worked in the last 3-4 years, but in the coming 12 months, I don't think it will be theme-based top-down investing that will work.
Got it. Okay. Ashish, so, okay, you don't do top-down, you do bottom-up. Still, I'm just trying to understand. And a pertinent point, yes. Right? I mean, yes. you kind of ignore real estate. Maybe some people can ignore real estate, but the price deduction is there. Where yes. within this price, when the prices have gotten pummeled, do you see opportunity with of course, I mean, a hypothesis that you may have around it, that maybe the wealth effect doesn't get impacted too much. Even the capital marketplace, some of them have come back, right? Yes. So where is it that you find some conviction?
So again, to be honest, we have actually also suffered because we were positioned in some of the funds. We were overweight real estate, and it has hurt us as well. But we actually are optimistic that the medium to long term outlook of the sector is good. There's been huge consolidation in the sector since 2018. But my point was that it does not absolve us of the pain that will be. So it's not that the purely domestic place will necessarily be immune to the pain that will be there. It's just that it is in names like these, we have the conviction to hold them through this period of volatility, right? I think if we look at other segments of the market, financials is clearly one area where the balance sheets are very, very healthy. Some of the concerns that were coming on the retail asset quality have also started receding, and the regulatory outlook has improved significantly, both in terms of the kind of sanctions that were being put on various lenders, as well as the aggressive liquidity infusion that has happened. So that is one space we like. We are selectively looking at some of the consumption names. Power is a sector we like. I think both the energy transition as well as really the demand supply dynamics mean that this sector will have favorable tailwinds.
Got it. Okay. Well, I'm guessing it's a difficult set of questions per se at this point of time, considering that there are no clear answers. But Ashish, thank you for being candid enough on a lot of things, and wish all of us all the best in navigating through the next few weeks.
Thank you so much.
The pleasure was ours. Well, that was a slew of market opinion, but we started the 9:30 segment with a corporate opinion on IT. We ending this with a corporate opinion from one of the tallest leaders of India Inc., talking about the impact of US tariffs, maybe seen for the next 4 to 6 months, but nothing too dramatic. In a special conversation with me, he spoke about how tariffs will impact India Inc.'s and his company's plans as they all wade through the global volatility. Listen.
Till before COVID, you always took globalization, geopolitics for granted. It was never a factor in your plans. Today, every CEO has to keep looking at geopolitics. The thing is the utter unpredictability of it. So, if you ask me what's going to be the impact of Trump's tariffs, firstly, you don't know what are going to be the real tariffs, how much time will they settle down in, what will happen, how will people... Now, this is, we are now in this world where in the good old days, we would be told, look before you leap. Now it is look while you leap, because everything is changing as you are leaping. So I think, it's interesting in one way, but also challenging.
It is certainly challenging, but what do you make of all that's happening? I mean, because in some sense, and as a captain, I would want to understand from you, as somebody who runs such large business or has done it all through his life, the people in the market or people who look at markets and economics think of this in two ways. There is a worldview that everybody is getting impacted and therefore there is no one clear loser because everybody's been slapped with tariffs, per se. And there are others who say that, well, this will have ramifications. People compare it to the 1930 impact that had in the US and how it, people sleepwalked into a global recession then, and we might be doing the same thing right now as well. Maybe it's too far out, but just trying to think about, as a business leader, how do you think of this?
See, as a business leader, you have to be prepared. Fortunately for us, the good thing is, I do believe India in a large way is insulated, at least in industries like ours, companies like mine. We don't have a direct impact. I mean, we have very little export or import to the US outside our pigments business. It's not substantial. That doesn't mean we will not be impacted, because obviously these are ripples that are going to be felt right across. But I think, in today's day and age, you can't commit big. You have to play every ball on its merit. And what you have to do is focus on what's within your control, because otherwise you will keep doing various scenarios, and there are far many greater economists and astrologers than I am who will predict this. I think the key is keep looking at what's right for your organization, for your country, and do it one step at a time. Don't commit big. Don't do things that you're going to regret later.
Do you fear a synchronized global slowdown, Mr. Puri?
See, I think now, I was just reading a report where they say now from 20% the chance of a, minor or major, I don't know how it's defined, global slowdown stroke recession is like, my simple answer is I don't know. I hope definitely not. I don't think the world needs it at this point of time. But it's clear as a watcher, and by no means am I an expert, there is a global reset taking place as we speak. Well, people spoke much earlier about the onset of Asia. It was Europe, and then it's the US, and now it's Asia, and there's a reset. You're seeing that in motion, and maybe historians many years later will come back and say these were inflection points. But I think we're in the midst of fairly, what I would say, is transformational change rather than incremental change.
Okay. And therefore difficult to kind of predict the extent of the impact?
Very difficult. Very difficult, because who's going to get impacted where, how, and where's the extent of impact? I think it will, by the time the mist clears, in my view, it will be 4 to 6 months. It won't even be weeks.
Okay. The other thing is, a lot of people also are of the opinion that India was never a large exporting economy. You spoke about pretty light that way, but for India as well, it's never been a very large exporting economy, and therefore a hit to global trade will impact India relatively lesser than some of the export-driven economies. Fair assessment, or is it too simplistic?
I think it's a fair assessment. It will have an impact, but yes, we're a consumption-based economy, and therefore a lot of that is domestic consumption. While we are not insulated from the rest of the world, I think we're probably a little more resistant than a lot of other nations.
Okay, well, and therefore we may not have to fix it.
I think we'll have to fix it, but maybe it's, the leakages will be small.
Okay. Maybe some waterproofing will do it. Fair call. A word on consumption within India as well. There is a pivot of sorts that us commentators thought of when we saw the budget this time around, maybe much needed as well. And the early signals from corporates who've given their quarterly updates for Q4 are not necessarily very enthusing about the consumption revival as well. Maybe it happens from April, who knows. I would love to understand your view, sir. Do you reckon that the Indian consumer is ailing, or was it a temporary dip or a blip which might get corrected as the time comes, or has already been corrected, not just for your business, but maybe for the businesses within your landscape and for India Inc. at large?
See, our belief is it was or is temporary, definitely in nature. I don't think anybody can take away from the medium-term optimism of the India growth story and the India consumption story. I think you will have some bumps along the route. But when we look at it, my belief is on a broader consumption. Fortunately, it's also the advantage of being in what I call a little more advantaged sector. We've had a fair amount of tailwinds, and we as an organization have also worked on our portfolio to, in a sense, make it more growth oriented. But having said all of that, I think the measures taken in the budget, putting more money in the hands of the consumer, a better monsoon, I think possibly by the second quarter or the end of the second quarter, I think this year, in this financial year, the second half should really be a much better second half.
And this is despite what Donald Trump has done. Yeah,
I think so. Yes, there may be some specific sectors that get impacted, but I think from an India consumption point of view and money in the hands of the Indian consumer, and I think India has done a commendable job of managing inflation, because frankly the biggest tax that an emerging economy, especially the lower middle classes pay is inflation. I think that's being managed fairly well.
Okay. I was talking to a very large money manager yesterday who said that Neeraj, you guys worry too much about growth, because we've trended circa 6% for a really long time. When it goes to 5%, people suddenly feel that it's doomsday. Goes to 7%, the optimism rises around 8-9% and stuff like that. But it's always been around this. So it will continue to chug along, and some policy measures sometime hopefully will do this. Do you think, in your long tenure, right, in the consumer business, and maybe you've catered in your previous, even in the previous roles, it's been mass consumption all through, right? Have you had to incessantly worry for a long period of time around growth, or you don't?
No, you don't. Frankly, I think in India you have to be ready for growth. It will come. It will, by definition, emerging economies will never form the steady, straight pattern of a developed economy. You will have bumps along the way. You'll have these little peaks and troughs. But when you average it out, you look at the Indian elephant trudges on. In bad years, we are at 5%. In good years, we are at 8%. But we don't, we remain in that range. And I see no reason why that's going to change.
Okay. And would this, Mr. Puri, be a consumption-driven economy per se? Because we were a consumer-driven economy for a long time, probably still are, but services took center stage. Now there is a serious attempt to make manufacturing really shine. I would love to understand from you, how do you think, as you foresee the economy, and maybe Pidilite's role within it, but for now, let's think the economy for the next 5, 7, 10 years, or maybe the better part of this decade. How do you see the economy chugging along? What contributes the most? How do you see the policy framework contributing to each of these facets?
See, if you look at the targets itself that the government has taken for itself via the Viksit Bharat program, we have to step up growth, right? We have to continue growing, and to reach those targets, we need to step it up. Frankly, I think one of the lowest hanging fruit is manufacturing. There is no reason why India, and I don't say China +1, etc. I just say India has the right to be a strong manufacturing base for large parts of the world. I think as long as we have that intention and we are going along that path, clearly it is stated, but we have a long way to go. I think that has to be a driver of growth, because, with hopefully a boom in manufacturing and services which continues, things like tourism or education, come jobs. With jobs comes money, with money comes consumption.
Okay.
Whenever a film sank in 2000s, it was always flop actor. मेरी तरफ नहीं देख रहा है, देखो तो सही. I compare an actor's career like the stock market. Sometimes your stocks are low, right? And when your stocks are low, no one's buying. Sometimes your movies do well and your stocks are on the rise and everyone's suddenly buying that stock.
What point do you think that the film career perhaps is not going the way that you thought?
Itch of wanting to be an entrepreneur started itching a little more and I wanted to scratch it.
One of the most important lessons is to know when to pivot.
The burn was far more than the earn. We were burning and I was watching my money just go out and like, oh my God, what's going on here?
He sold most of his stock, 80%, as on that date.
We have requested the management to come and speak to us. They asked us, what questions will you ask? We've sent it to them. They don't want to answer it, so then let's put it to our viewers as well.
7 key questions, right? How is it that 2,000 crore goes unnoticed by all of these auditors?
Is seeking more information on the trades and the all the transaction which has happened from the exchanges, both NSE and BSE.
The Reserve Bank of India's supervisory officers, they are seeking compliance reports on their foreign currency borrowings by these banks.
The DSS is actively engaging with the Reserve Bank of India to sort of ensure the thorough examination of the matter. And
Hi, thanks so much for joining in. You're watching Ask Profit on NDTV Profit. My name is Alex Matthew and with me is Mahima Vajrajani. First, stop, pause, take a deep breath because the markets are slipping and sliding as things stand right now, and understandably so, because uncertainty is the name of the game. And it's all the uncertainty that is emanating from the West, which is from the United States of America. Donald Trump on board Air Force One making pronouncements that are impacting global markets, and that is the case this morning. You have the Nifty 50 that's trading very close to the low point of the day. The broader markets are bearing the brunt of it. In fact, you have the mid-cap index that's down 3%. You have the small cap index that's also down about 3% or thereabouts, 3.3%. And it was short-lived yesterday, the relative outperformance of the Indian equity markets, and some have suggested also to a certain extent that was on account of the end to the derivative week and those contracts expiring that had to do with yesterday's move. But what is the latest update? It is to do with a comment that was made by President Donald Trump about pharmaceutical companies and tariffs on pharma. And there are no specifics here, but the stocks are taking a battering in trade today. Let's listen in to what Donald Trump had to say about possible incoming pharma tariffs.
Chips and pharma tariffs are not on the table. Starting very soon. The chips are starting very soon. The pharma is going to be starting to come in, I think, at a level that you haven't really seen before. We are looking at pharma right now, pharmaceuticals as a separate category. And we'll be announcing that sometime in the near future, not too distant future. That's under review right now.
Okay, so yesterday, very clearly in the document that was looked at across the globe, it was clearly mentioned that pharmaceuticals would be one of the exceptions, along with copper, along with oil products, as a result of which in trade yesterday you had pharmaceuticals that was a top performer. Today though, you have pharma as a pack that is losing everything from an oro pharma down about 10%, severe pain there. Laurus Labs 8.5%, you have Lupin that's close to 8% lower. remember, as things stand right now, the conversation that we had just yesterday, barely 24 hours back, with a pharmaceutical analyst, they're saying that supply chains cannot move very quickly. And so even companies that currently supply to the United States, it's not going to be very quick where they will shift production or shift supplies. And so it will take as much as a few years at the very least, even if they have to shift those supplies. And it's not easy to shift manufacturing as compared to certain other sectors. And as a result of which, pharmaceuticals was expected to be a little more insulated than the other sectors. Clearly, at this juncture, the mood of the market seems to be sell first and think later about the implications, and that is evident from the screen as well. Another pack that is under pressure, and we'll talk about individual names as well, but another pack that is under pressure is the metals pack. And all commodities under pressure over the course of the last 12 hours or so. And so the likes of Hind Copper, Vedanta, Nalco, even the steel companies, Tata Steel. And remember, a lot of these companies have focus on the Indian market. But despite that, and despite the likelihood that to a certain extent demand is protected because of the global headwinds for growth, all of these companies are bearing the brunt. There are a few more stocks, of course, and oil in focus as well. Oil prices dropping quite precipitously overnight. And you have upstream oil companies that are taking a hit, but downstream, at least earlier in the session, was doing reasonably well. What else are you spotting?
Right, something like Mazagon Dock is also under pressure. This is on the back of OFS sale by the government. We'd seen a similar trajectory in Cochin Shipyard when the OFS had taken place. The stock is under pressure, down by about 7-odd%. Something like HDFC Bank, let's pull up that on the back of its Q4 business update. The stock is up. Despite the kind of pressure in markets, it's up around 1.7%. Avenue Supermarts is another counter which is under pressure. It's on the back of its Q4 business update. Well, Street was expecting a better earnings this quarter, but that has not taken place and has disappointed the Street, and the stock is down by about 2.3-odd%. Let's also pull up something like L&T Finance, Thermax, Ami Organics, all of these counters under pressure. Something like Jupiter Wagons is also under pressure. Let's also pull up something like Geo Finance, again under pressure. Alcargo Logistics, Zomato. Even after Goldman Sachs is saying that they are positive where Blinkit growth is concerned, but overall picture right now near term looks a little bleak to them, and they've cut the target price by a tad bit. The stock is under pressure, down by about 1-odd%. Let's also quickly pull up the BSE 500 and see what are the top gainers and losers there. Mostly the losers will be from the metal and the pharma pack, and there you go. It's Laurus Lab, Aurobindo Pharma. Bharat Forge is also down. This is on the back of an MS note, Morgan Stanley note that has downgraded the stock. Coforge again seeing pressure today, down by about 6-odd%, but something that's doing well, Rainbow Children Hospital, Interglobe on the back of the fuel prices going down, oil prices going down, is doing well. Castrol India again doing well on the back of that. Tata Consumer seeing good gains today as well. Indus Towers down by about up by about 1-odd%. PNB Housing up by about 1-odd%. But that the advanced decline ratio that we were talking about, the gains are hardly about 2-odd%, but the pressure in the stocks which are really down is about 8-odd%. So that difference is very large.
Very stark, very, very stark. And perhaps to a certain extent, we finally caught the cold, if you can call it that, because yesterday you saw global markets really take it on the chin, and you had the Indian equity markets that were relatively insulated. Of course, IT as a pack losing as much as 4%, but that is now spread to various other sectors. IT down as much as 3% today, so 26+%. More than 26% since the December high for the IT index as a whole. In fact, let's look at the year-to-date chart for IT as a pack, and you will notice that it has dropped quite precipitously from those levels. Let's get our expert. There you go. So 22-odd% just in 2025 for a pack that is very, very key and is looked at very closely. Jatin Gedia, technical research analyst at Sharekhan by Mirae Asset, is joining us this morning. Sameer Dalal, Nafarlal and Sons joining us as well. Happy Friday for what it's worth, gentlemen. Thank you so much for joining in. Let me first get a quick view, Sameer, with you on pharmaceuticals, particularly because we're seeing such a precipitous fall for a lot of these companies that just yesterday we were saying would be relatively insulated. How do you approach this?
Yeah, so good morning, Alex, but not such a good morning at the end of the day. You're right, Pharma's taken it on the chin today because of the statement that they would be putting some sort of tariffs on the pharma sector as well, and that will come soon. But you got to remember that tariffs is, yes, it does hurt some amount of consumption there, but pharma is a segment where you cannot affect consumption to a large extent unless it's discretionary pharma purchases, maybe, some creams for beautification and things like that. If it's medicine for health reasons, they're still going to have to continue to consume them, and any of these companies that are selling that drug in the US is probably not going to bear the brunt of the cost increase, but the end customer is. And in general, the end customer out there has the insurance in place, so the insurance is going to bear the brunt of it. So I wouldn't look at it as negatively for pharma. Some companies like Sun Pharma, who are specializing in certain, products which are not necessarily essential, but more, I would rather do it for my personal health reasons. Those kind of products may get affected. So I wouldn't look at it too negatively. Markets probably overreacting also in the near term. But then because of the noise and because of what is happening globally, I think people are trying to prejudge or take a call way earlier than actually the impacts are going to happen. I would not be jumping around as much to make calls right away, because at the end of the day, there's going to be a lot of negotiation. Rates are going to change over a period of time. There is something, if he puts pharma tariffs on everyone, how much he puts on Indian pharma versus he puts on maybe Chinese pharma or Israeli pharma, all needs to be seen as a complete total. But yes, markets are probably reacting ahead because of panic.
Okay, so markets are reacting ahead of panic is the view coming in from Samir. Jatin, Dheeraj, we know that you're waiting on the line. We just a quick check on the markets before we come to you. Jatin, how do you take a trade in these kind of volatile markets right now is one part of my question. And secondly, what are your views with respect to the Nifty Pharma right now?
Yeah, see, in terms of trade, what you take, definitely the trend is negative, so we'll go look at going short. But considering that we are already around 300 points down from the opening, it makes shorting at current levels little difficult. We need a pullback, intraday pullback towards 23,000, 23,025, and then go short on the Nifty. So we'll wait out for a pullback and then go short. That is how you should take a trade in the case of Nifty. Now, looking at the Nifty Pharma Index. So, Pharma Index, yesterday's price action was also not very decisive at the end of the day, because we did open on a positive note. However, by the end of the day, we were down from the opening level. So that indicated a negative price action yesterday itself. You can say that on account of the gap up, it was a positive close, but the price action from the highs suggested profit booking at higher levels. So yes, today the news is out. So now I think on the pharma index, the crucial support level is coming around 19,600. So I believe that there is a decent downside even from current levels in the case of Nifty Pharma.
Bear that in mind and trade accordingly. By the way, banking is the relative pocket of calm at this juncture. The Nifty Bank trading just about flat at this juncture and holding out. And I would hazard a guess to say HDFC Bank is perhaps one of the reasons why that is happening. Pull up HDFC Bank and see where it is, because after the quarterly update, it is one of the top gainers, if not the top gainer on the Nifty 50 at this juncture, holding on with gains of 1.5%. And you know what the weightage on the benchmark Nifty 50 is, and indeed on the Nifty Bank. We've got the first caller of the day. Dheeraj is calling us from Hyderabad. Dheeraj, thanks so much for holding the line. How can we help you today?
Yeah, my query is regarding Sona Comstar, Sona BLW.
Yes.
Yes, I bought it yesterday actually. I am holding 400 shares of Sona Comstar at 450 rupees a piece. So for the next 1.5 months or 2 months, should I hold this company or should I shift to any other auto auxiliary like Motherson or Sansera Engineering? And one more small query I have. Can I invest fresh money of rupees 5 lakhs like in the next week in frontline stocks like L&T and IT pack like HCL or any other pharma pack?
Okay.
Is my query.
You're looking to catch the bottom, is that right?
Yes.
You're looking
Absolutely.
to catch the bottom. Okay, so
for the next 1 year.
I'm glad that you asked that question for the next 1 year. Okay, I'm glad that you asked that question because I think a lot of people are going to be tempted by the kind of declines that you're seeing across the board. But the question's for you, Jatin, because it's a relatively shorter term question for Sona Comstar, or rather Sona BLW as it's called right now. Sona Comstar is a brand. What would you do with this? Because you bought yesterday at 450, the stock is down 5% in trade today for a 1.5 month target. What are the levels that you would watch for? And would you venture out? Would you be brave enough to venture out and deploy 5 lakhs of rupees next week in the markets, or would you hold your horses and wait for the dust to settle?
See, first of all, my advice here would be to take the loss and exit. And if he wants to continue to hold, then the next crucial support comes in at around 400. So if he wants to add in for a 1 to 2 month kind of a perspective, then 400 is a level around which we have the swing low that was touched around December 2023, around Jan-December. So that is the next crucial support level for Sona Comms. So as of now, my suggestion would be to exit at a loss at current market price. And if he has the risk appetite to hold, then 400 is the level around which he can wait out or consider to buy.
Okay.
No, and the second question was obviously on deploying of funds. What's your opinion?
See, as of now, I don't suggest to deploy funds because we need a positive close, a minimum thing that I would require technically to consider that the market has formed some or has found some support. So technically, I would wait for a daily positive close and then only start to look at stock specific ideas or even at an index level to start deploying my funds. So as of now, things are negative. So I will wait out for a couple of days and then take a call.
Okay, so that's the view with respect to Sona BLW, as well as what Jatin is saying is to wait and watch out for and see at least some positive momentum to get into these pharma and IT pack stocks. All right, our next query is from Manish Gandhi, who's writing in from Mumbai. He's holding 5,000 shares of Suzlon Energy at an average price of 30 rupees. So he's sitting on a profit of around 1.3 lakhs right now, and he wants a long-term view with regards to this stock. He wants to know whether to add, sell or hold. Sameer, what's the view like on Suzlon Energy?
So, given the fact that he already has quite a decent lot and he's making good money, I'll say hold on, I wouldn't say add. However, if somebody doesn't have the stock, I would definitely recommend someone buying into it because we still believe the renewable energy space in India is good to grow. The company is trading at yes, a little expensive valuations, but the operating leverages that will pay through as the utilization goes up, we will see that the valuations are not as expensive. And then once that new capacity, which is already set up, starts ramping up further, you'll see that there's good upside and profit growth that will come through for Suzlon. So for your caller, I'll say hold on, don't add. I think there are other stocks you could have. You have a decent lot here. I mean, I don't know your portfolio, but you have a decent amount. For someone who doesn't have, please go ahead and you can buy the stock.
You can actually go ahead and buy. Interesting. Because I know for a fact, Sameer, that you had said when it was 70 plus, if I'm not mistaken, that you were uncomfortable with the valuations at the time, or closer to 75, right? All right.
Correct.
Yeah. So, all right. So that's the view on Suzlon. We've got our next caller. Ganesh is calling us from Chennai. Hi, Ganesh. Good morning. And how can we help you today?
Hi. Good morning. I want to check the Kalyan Jewellers. Is it a time to enter? And I would like to hold it for a long term,
Okay.
And it fell down from 800 to 400 in last month. Now it is slowly, it's coming up actually. Since the gold price are increasing, my thing is whether this is the right time to invest in Kalyan and wait for a couple of years.
Okay. Have you considered any of the other jewelry companies, Ganesh? And I'm assuming...
No.
Yeah.
No, this is the first one.
Yeah, but I'm saying, have you looked at Titan, for example, or have you looked at some of the other companies?
Other companies are good, but this is a kind of price range is 400 around,
Okay.
So others are a bit on the higher side. So I thought of invest in more shares here and then hold it for some time.
It's interesting you say that, Ganesh, because this is a common mistake that people make. By looking at the price, you are determining whether or not the stock is expensive, and that's not necessarily the right approach. Look up something to do with valuations, okay? And I'm going to ask Samir to perhaps explain this to you. We could do a masterclass, and I guess we can talk about this the whole day. But Samir, when we're talking about multiples, Kalyan, if I'm not mistaken, is still comparable to a Titan in terms of multiples, right? At the level that it is right now. Earlier, when it was much higher, as he's pointed out, it was actually costlier than Titan. So from that perspective, and given that gold prices are where they are, volumes are perhaps going to be a bit of a question mark for jewelry companies. Would you venture out and buy Kalyan or any other jewelry company for that matter?
Yes, so I would buy Kalyan, first up, to answer that question. And why? Yes, there's one thing. You gotta look at the fact that Kalyan looks expensive when you look at trailing earnings, because they set up a lot of their stores, their franchisee stores in the last financial year, which are scaling up. Once the operating leverage of those come through, that is going to lead to a great jump in profitability. And you got to realize, when a company goes from 200 stores or 150 stores to 300 stores, that's a 100% increase. But that's not going to happen in the case of Titan, right? So when Titan trades at 90 times earnings and they scale up maybe 100 stores on their 600, 700 stores that they have, I mean, that growth is about 15 to 20%. So the operating leverage is not as strong. So yes, they look on historical basis, the valuations look comparable, but given the fact that Kalyan has fallen from where it has fallen, and given the expansion plans that they have, given the smaller base that they have, and given the growth opportunity given from the unorganized to the organized sector that will continue to happen, we feel Kalyan will be one of the beneficiaries. We believe the jewelry industry in India has a huge opportunity to grow. We ourselves are invested in Titan and Kalyan Jewelers. Titan is more of a stable long-term. I mean, when you buy it at the historical prices, you don't think twice about whether you should sell it or not, because we know the growth is great. But Kalyan, given its correction, I would say yes, one can go out and buy. If you have a pick between the two, I would obviously pick Titan from the stability point of view. But if you want to have returns, Kalyan is also a good buy.
Okay, Ganesh, forgive me for adding a question of my own. And Samir, this is an extremely interesting conversation from my perspective as well, because if I look at the trailing earnings, or I look at the trailing multiples, it's at what, 76 times or thereabouts, very close. What is the base case assumption for earnings growth that you are penciling in for Kalyan is the question that I have.
So for this current financial year, we have an EPS target of about 9 rupees on Kalyan. That would give me about 50 times. But given that the fact that the operating leverage that I talked about, let's talk about 100 stores barely making any margins, right? Because these are new stores, they need more customers to start coming in, the traction to pick up. Once the operating leverage of that starts coming through, we feel they could do closer to 12 to 13 rupees EPS maybe in the next financial year with these existing stores. We are not even considering the fact that more stores will be coming up. And if more stores do come up over a period of time and they go closer to about 14 and 15 rupee EPS, say, next year, I'm not saying it'll happen, I'm saying close to 13 will be fair, but if you project 1 year forward and you go to maybe 16 or 17, on 17 rupees earnings at 400 rupees, the stock is rather inexpensive when you look at what Titan is trading at, or what Setco was trading at, or what some of these other jewelry companies are trading at. And given the fact that this is a company that has taken all the necessary steps. They used to have assets like aeroplanes and helicopters on their balance sheet, which they've sold off. They used to have a lot of land bank, which they're slowly selling off and creating that as liquidity for the cash. They're working on a low-cost business model because they're working on FOCO, which is franchisee owned but company operated. So the investment is done by the franchisee. They give them an X amount of return, and the balance profitability comes to Kalyan. So that, without expanding the capital base, the ROE is moving up. That is where we feel that even though on a trailing basis it looks expensive, if I take 13 rupees next year, it's about closer to, I would say, what, about 40 something, a little under 40. And If I take 16 or 17 in the year following, and we are talking of maybe about 25, 26 times, which is not expensive.
2 years down the line, 25, 26 times.
Yeah. Yeah.
Okay. Okay. Interesting take on Kalyan Jewellers. All right. The next counter is that we're talking about is Zomato. Ajit from Hyderabad wants to know as to how the shares will perform in the next few months. He's holding 1,000 shares at 288 and he's bought this in Jan mid. So he's bought it at elevated levels because the stock has seen a significant amount of tanking since then. And he's sitting on a loss of 78,000 right now. Jatin, I'll come to you. Goldman Sachs had an interesting report otherwise today, which was based on the fundamentals, and it said that last time that Zomato had tanked was when the food delivery growth had gone stagnant, but the bounce back from that was very quick. And they're expecting the same thing to pan out as well for quick commerce. The quick commerce, once it becomes profitable, it will bounce back very quickly, and Zomato will have a large share in the entire pool. But what's your view with respect to where charts are concerned for Zomato?
Yeah, so the price action is not very encouraging. What we see on the daily charts is that the 40-day moving average is acting as a very strong resistance, and since December last year, when it rolled over below the 40-day average, it has not been able to surpass that since the last 4 to 5 months. So now, having said that, the price action of last 3 to 4 weeks is holding on to the level of around 199, 200 odd levels. But I feel that it's a matter of time. Zomato breaks down and goes towards 174, 179 odd levels, where we have the next crucial support. So the chart pattern is not very encouraging at this point of time. Our view on the stock is negative, and we should wait for levels of around 180, 175 to venture out and buy.
All right, so that's the view coming in on Zomato. Our next caller is calling in from Pune. Vikas, a very good morning to you. How can we help you? Hi Vikas, I can hear you. Go ahead with your query. Okay, I think we've lost him.
Yeah,
can you hear me, Vikas? Okay, we've lost him. But we have his query. He's holding 100 shares of IRCTC bought at 740 a piece, and he wishes to add 200 to 300 shares more. Samir, I'll come to you on this one. He's sitting on a loss of around 2,000 rupees right now. But do you think IRCTC is a good counter to invest in right now?
Yeah, so fundamentally, yes, I think it's interesting. It's come down a bit. And I'll tell you what, look, it's got a monopoly kind of business when it comes to ticketing. And that business, though they've captured already 85% of the market share for tickets sold in India, as the number of trains keep adding and as more ticketing, cancellations, all these things happen, IRCTC's revenue stream from that will see an uptick, but it will be a marginal uptick of maybe 5 to 7% annually. But they've gotten into this other business of tourism, right? They create these packages, travel packages, which they're selling on their portal. And that is beginning to see some traction. So if the traction in that continues to increase, what will happen is you will see this is a very low cost kind of operating margin business like a travel agency, but the profitability that can come through that is quite high. Even in the food services, they've got all these tie-ups with various companies which are now slowly starting to scale up. And as the orders on these trains keep increasing, you'll see that part of the revenue stream also starting to increase. Of course, they are much smaller part of the revenue stream, but as they start growing in size, the ROEs will keep remaining healthy. Investments required are almost none in this company. Strong cash flows will keep happening. Dividend payouts will keep happening. We believe this is a good investment over a 3 to 5 year period. Stock is a little expensive on valuation. I'm not denying that fact. But we believe given it is a kind of monopoly and kind of the reach that they have, they will be able to maintain these higher valuations over a longer period. And as the growth and profits increase, so will the stock price.
Okay, all right. So that's a comprehensive view on IRCTC. Gentlemen, do stay with us. We have to slip into a very quick break. Viewers, I know that we've been spending a lot of time on the markets, but it's that kind of a day. We'll take more of your questions on the other side, but we also have a conversation lined up to help you understand the implications for the pharma stocks that are taking a battering today. So do stay tuned.
Whenever a film sank in 2000s, it was always flop actor. मेरी तरफ नहीं देख रहा देखो तो सही. I compare an actor's career like the stock market. Sometimes your stocks are low, right? And when your stocks are low, no one's buying. Sometimes your movies do well and your stocks are on the rise, and everyone's suddenly buying that stock.
What point do you think that the film career perhaps is not going the way that you thought?
Itch of wanting to be an entrepreneur started itching a little more, and I wanted to scratch it.
One of the most important lessons is to know when to pivot.
The burn was far more than the earn. We were burning out. I was watching my money just go out and like, oh my God, what's going on here?
He sold most of his stock, 80%, as on that date.
We have requested the management to come and speak to us. They asked us, what questions will you ask? We've sent it to them. They don't want to answer it, so then let's put it to our viewers as well.
7 key questions, right? How is it that 2,000 crore goes unnoticed by all of these auditors?
Is seeking more information on the trades and the all the transaction which has happened from the exchanges, both NSE and BSE.
The Reserve Bank of India's supervisory officers, they are
Welcome back. You're watching Ask Profit, and we're joined on this side of the break by Sneha Sheth, who's Senior Analyst at Angel One. She'll be helping you with your technical calls. And on this side of the break, the first question that we're taking is, in fact, on Adani Power. And we've got Koti Reddy who's writing in, who's asking about the outlook for the stock. He's bought at an average price of 562, which is not too far away from the current market price. He's got 6,000 shares and he's wondering what to do. Sneha, what's the outlook? Should he hold?
If you look at the chart structure for this counter, I believe it has made a strong base around 465, 460 zone. And from there, the index, this counter has been, showing some strength. In fact, last two sessions, we have seen addition of long position in the future segment. So I believe there are chances that we can see an up move beyond the buying rate of the clients. So I would suggest keep holding it, keep a strict stop loss around 510 for now. And the first target would be at least towards 570, and then the possibility is that the counter can head towards 600 plus levels even.
Okay, so that's the view with regards to Adani Power. Our next caller, and standard disclaimer, Adani Power is also a part of the Adani group of companies, and NDTV is also a part of the Adani group of companies. Moving on to our next caller, Rajan is calling in from Mumbai. Rajan, a very good morning to you. How can we help you?
Good morning, madam. Really very glad to talk to you again. And your program reached to such a popularity that even on WhatsApp also I don't get my chance. So luckily I get to speak to you.
Yeah, thank you so much. I've made our day.
Yeah, my query is on Pfizer. I have 10 shares of Pfizer at an average price of 4,900 purchased in March 2024.
Okay.
Somehow under this tariff trauma and tariff climate, I am undecided whether I am a long-term investor, but somehow I feel that you should switch on to a good script like ITC, hotels or Sagility. Can Samir? I like Samir sir's reply because he gives very sharp and to the mark, and which touches my heart. So I would like him to please answer my query.
I agree to that, Rajan. That Sameer's answers are always very to the point and very detailed. Sameer, he's given you a compliment and he wants to have a view on Pfizer, as well as he wants to know whether he should shift to something like ITC Hotels or Sagility India.
Okay, so first of all, on Pfizer, we don't have active coverage, but what I can tell you is they will not be as affected negatively on the Trump tariffs on pharma in any which way because they are predominantly for the India operations, right? So they don't do too much of the exports to the US market, so they don't get affected. Obviously, the Indian market is still a growing market, but like I said, I haven't studied the company, so I don't want to say more than that on it. Coming to ITC hotels, yes, we think that's a great buying opportunity. And one of the reasons we say that is they are also growing the book quite handsomely. I mean, in the sense that properties are going to keep increasing. It's a newly formed company. The actual company's financials are not totally available. And once people start seeing that coming through, I think there's a discount that it is trading to Indian hotels. Now, the discount obviously sustains to Indian hotels for the reason that Indian hotels has a brand name which is very strong and they are also growing. But we believe the gap is quite large. So either Indian hotels needs to correct down a little bit or ITC hotels needs to move up. And we think the second is more probable that ITC hotels will probably get valued better. Plus the growth opportunity, like we said, for India tourism is still very strong. Their portfolio of properties is great. They're signing up more every day, which will allow them to also grow their top line and profits. Through the low cost investment model, which is the management contracts. So we think ITC hotels is a good investment. Sagility, unfortunately, is a new listing. The stock has run up a lot, and I don't have a view on that, so I don't want to comment again.
Rajan, I'm told that you held the phone for half an hour, and I really, really appreciate that you've given us that time. And really, thank you. No, thank you so much, and we really appreciate the time that you're spending with us. The next question is from Niva, writing in from Chennai, and Zydus Life Sciences is the name of the counter. Can she add more at this juncture, and what is the target for a period of a year? Sneha, on the charts, what's the view? She's bought at levels of 902.
If you look at the chart structure, we have seen last two sessions, we have seen decent selling pressure coming in. Looking at the overall chart structure, wherein we have seen decent consolidation and which has been, at the higher levels, certainly we are seeing some fresh selling coming in, which is not a very healthy sign for now. I believe there is a support around 830, 835 zone. And if someone is holding, keep a stop around those levels. In case it corrects below that, exit it. That would be a better strategy for now, but don't keep holding for long. Keep a strict stop loss around 830 and hold it for now. In case of any bounce back, I believe it is very important, at least it manages to surpass today's high, that is around 905, or it manages to close at least above whatever losses we have seen. If it in the later half, if we see some recovery from the lower levels, that would be a very interesting thing. And certainly if it closes above 500 and 905, 910, that would be very interesting. And for an overall chart structure to improve, I think 1000 is the level one should be watching if someone is stuck in this counter. Any move above 1000 would be very interesting for this counter, which can, bring some momentum coming in back in the counter, which we have not seen in last couple of months now. So 1000 is the level to watch. On the lower side, keep a stop around 830 for now and keep holding it.
Okay. All right. Madhu is calling us from Hyderabad next, and the question is on Tata Elxsi, I believe. Madhu, good morning, and how can we help you today?
Thank you. I bought this share in 2021 at around, the price was around 2,890 rupees, around 4 shares. So now there is a, after the monthly support has been broken. So I just want to know whether should I hold it or sell it off.
Okay, so you've been looking at the charts, and so, but I'm just curious, you've been holding for so long, I'm guessing you bought based on the fundamentals, but you're also looking at the technical charts. Do you need to sell at this juncture?
I'm sorry?
Do you need to sell? Do you need the money, or are you willing to hold for the long term?
No, I can hold it, no problem. But I just want to know because the monthly support was around 5,500 or something like that. The monthly chart now looks weaker to me. So I just want an expert opinion on this.
Okay, got it. All right. So Sneha, I'll come back to you on the charts then, because she's looking at the charts very closely. What do the longer term charts suggest for Tata Elxsi?
If we look at the monthly chart structure, I believe this counter is hovering around the 89 EMA. which is placed around 4,800 zone. So at this point in time, 4,800 followed by 4,400. These are the major support zone. Because if you see the monthly chart, there is 61.8% retracement level coming around 4,400. So this zone is very important. If it manages to sustain above this, I think someone who's holding a long can continue to hold it for a medium to short long-term perspective. So 4,400 is the main important support zone. Around 4,400, 4,600, that is the support zone. In case of any move, looking at the chart structure, there are chances that it can correct further. But yes, in case of any pullback move, at least towards 5,500, 600 zone, that would be very interesting for this counter. And then only we may see some, buying interest coming in. Otherwise, there are chances it can be choppy and it can be trading in a range where it can head towards the support zones.
All right, so that's the view for Tata Elxsi with respect to charts. Sneha, I'll stick with you for the next question as well. Neha from Bengaluru is holding Manappuram Finance and she wants to know the target for the next 3 months. She's sitting on a profit of 20% is what she's saying right now. What are the charts indicating? Should she book profits right now or should she wait for a further upside?
So here, after a very strong move, which we have seen on March 21st, the counter has been consolidating. But overall, after such a strong one-day move, the consolidation is very much likely. I think if someone is holding a long position, they can continue to hold, keeping a stop around 220, 222. That is the support zone for now. And there are chances that counter can head again towards 240 to 45 zone. So, and beyond that is also possible looking at the overall chart structure and the volumes. So I would suggest keep a strict stop loss around 224 for now and keep holding it for the target of 250 for the would be the first level, and there are chances that it can head towards 265 to 70 zone even.
Okay, so that's the view with regards to Manappuram Finance. Our next caller, Mahadev, is calling in from Bengaluru. A very good morning to you, Mahadev. How can we help you?
I have Tata Steel. I have SpiceJet, madam.
Okay.
1700. I bought at 44 rupees.
Okay.
Should I hold or sell out, ma'am? Please tell me.
Okay, and you want to hold this from a longer term perspective, right?
Only.
Okay. Samir, I'll come to you. He wants a view on SpiceJet. And, I'll club this with Interglobe as well. The stock is doing well in trade today. And this is because crude oil prices have gone down. What's your view with regards to both of these airlines and which one would you pick?
So if you have to pick, obviously you pick Indigo because of the fact that they are profitable and, the market leader, the kind of number of planes that they'll be adding in the current financial year will probably be equal to what SpiceJet will have, I think, at the end of next year. That's the kind of scale that Indigo has built. So if I had to pick, I would pick that. But since the question was related to SpiceJet, what I can tell you is that, look, the pain point for SpiceJet for the time being is over. In the sense that they've raised the capital, they've taken the money that they needed for their expansions. They will be adding more planes continuously, which will allow them to have more routes, and more routes means more operating leverage. So we believe that SpiceJet, since you bought it and holding it, could move up to a probable price of 60 in a 1 year kind of view. And if you have maybe a 2 year kind of view, it would probably be closer to 75 because it is a turnaround story. But you got to realize when it comes to turnaround, you got to be able to get your act right. Of course, he's proved it in the past. When Ajay Singh has proved it in the past that he can do it, so we think he should be able to pull it off. So maybe if you have a 2 year view, you could probably get 75, 80, which is good returns. But if you are a long term and want to hold on to any aviation stock, I think Indigo is the way to go, given the fact that the leader. But in a nutshell, I'm not a fan of aviation. I believe aviation is a place to lose money. It's known as the industry that turns billionaires to millionaires. But yes, at this point of time, SpiceJet has a turnaround and you can make a 2 year kind of view and make some money off it.
Turns billionaires into millionaires, barons into fugitives. There are several things that have happened in the aviation space. The future prospects of Bank of Maharashtra being sought by Karan this morning, and since it's a 1 year question that is being asked. The stock is currently under a little bit of pressure, 2% lower at 47 or thereabouts. Sneha, on the charts, would you venture out and buy Bank of Maharashtra right now?
For now, I would avoid. If you look at the chart structure, this counter has been under pressure, although it is consolidating, wherein on the higher side, I believe 50 is a resistance zone and the support is placed around 42, 43 zone. Unless and until we don't see a strong up move above 50, 52, I would avoid for now. And so from those levels, we would review the counter, because there are chances that the consolidation may continue for at least for 2-3 couple of weeks more from here on.
All right, so consolidation might continue for Bank of Maharashtra. Anit is calling us from Mumbai. Hi, good morning. How can we help you today?
Yeah, hi, good morning.
Yes. Please go.
Actually, I've bought 3,000 shares of Equinox at 142.
Okay.
So I'd like a long-term view on the share, please.
Okay. Can you help me with when you bought this and what the thesis was? What was your thinking?
So actually, the initial buy was at the rate of around 67. And then I booked my profits and again re-entered at 142.
Okay. All right.
And I've been holding it for the past 2 years now.
Okay. And as a play on the real estate space, correct?
Yes, please.
Got it. All right. So, Samir, what's the view specifically on Equinox? Of course, some people might not know this was formerly known as Indiabulls Real Estate. And so, therefore, you would essentially be giving a view on the Mumbai real estate space as well. What's your opinion?
So Equinox has actually again gone through a lot of the difficult period, right? Indiabulls, had its problems with the real estate arm, which then they eventually sold out. Now Equinox, which has been taken over, which will be merged soon into the Prestige Estate, and I forget the name of the company. They'll be merging into the arm of the property management company of Prestige Estate. So once the Embassy is the name. So once they merge into that, then you will get an entire total play of the real estate basket of property management plus development. Now Equinox in particular has a land parcel which they will be developing in Worli. So the 5th tower of the Indiabulls is soon going to be launched. Once that gets launched, what you will see is the revenue traction going up because the pre-sales of that will happen. Unfortunately, Equinox also has a lot of other land bank, but at the moment, nothing major has been announced. So probably a sideways movement, but once it merges with Embassy, and then you get the entire total of Embassy Group plus the Indiabulls Group working together, I think there is upside. So I would say hold on to it. Probably can move back higher, closer to your buy levels in the next 6 months, and you can probably make money over maybe a 2-year period.
Okay, so hold is the view with regards to where Equinox is concerned. Our next caller is calling in from Bengaluru. Anand, a very good morning to you. How can we help you?
Good morning, Mahima. I was holding Signity Technologies 40 shares.
Okay.
At the rate 17.15.
Okay.
The results were good. However, after this, they announced the share merger with Coforge. It is, it's a free fall.
Right.
I was, worried. Like what I can do now? Should I average or should I not average or should I book the loss?
Okay. Okay, got your query, Anand. I'll take this up with Sneha. Sneha, what are the charts indicating for something like a Signity Tech, and what should Anand do?
Here, if you look at the chart structure, the correction is quite high. Like overall, the counter has corrected nearly 14 to 15% this week itself, and it is trading around the support zone. But it has, certainly the chances of counter reaching the support is quite high on the weekly chart structure, even because if you see, there is a support around 1240, 1235 zone, which I think it is very much likely that it can correct further, looking at the volumes in last 2 sessions especially. So I think someone who's holding better exit it, because the chances of correction is quite high. If it corrects below say 1230, 1235, there are chances this counter head towards 1,000, 1,100, 1,050. That is the zone which is possible. So for now, I would suggest exit this counter for now.
Okay. A quick view on SJVN is being sought. Govind is asking, he's bought at levels of 160 and He's seen significant erosion in capital. Relatively quick answer. If you have a view, Samir, what's the view here?
So I think given the fact that he's bought it so high, it's going to be difficult for him to recoup his capital. We have a positive view on SJVN over a 3-year view, a 3-year target price. So we feel it could go up to 130, 140. But given he's bought at 160 for him, it's going to take a while to make some money. I would think if it goes lower, maybe average or take a loss and find something that you can recover your money, because it's not going to be a fast mover if you're expecting that.
All right, I'm just going to check, Sneha, if you have let me slow down a little bit. Sneha, I'm going to check if you have a view on ChemFab Alkali. And this is a stock that is 1,000 crore market capitalization company, and Shankar wants to know about this. He's called us. Do you have a view?
I actually don't track this.
Okay, unfortunately, Shankar, it's unlikely that we're going to be able to take this. So I'm going to take another question from WhatsApp because of the paucity of time. And this question is on metal counters and specifically on Vedanta. Would you buy at the current market price? The question, if you have a view. Samir, on metals, Dinesh wants to know.
So, we are entering a period where if we see a global slowdown happening because of these tariff barriers and things like that, commodity stocks can face a bit of heat because commodity prices can come down when we have a slowdown, and especially a slowdown in consumption. And then it'll take a while for the commodity cycle to turn. Now, Vedanta per se as a group, I'm never always in favor of, for the simple reason that the corporate governance has always been questionable. So if you want to play the metal space, I think better opportunities to play it or better ways to play it. One is Hindalco for the aluminium and copper side. And if you want to play on the steel side, you could probably play a Tata Steel or a JSW Steel, better managements. Tata Steel fully vertically integrated, and if there is an upside in metal prices, steel prices, and the slowdown doesn't happen, Tata Steel will be the biggest beneficiary because he gets the iron ore from the mine to selling the final product entirely. So any upside in the prices is positive for them, but JSW has a slight benefit that if the prices go down, so do the raw material prices, so they don't get hit as badly on the downside. Operating leverage is not as negative on the downside. So that would be the better way to play it. I would avoid a Vedanta if possible, given they have the demerger happening, they have the oil which will split up, they have all of these other things, and of course the parent has its own debt and its own legacy problems.
Okay, Samir and Sneha, thanks so much for joining us today. We are ending this program a little early, or this, at least the Ask Profit part of this, because we want to talk about pharmaceuticals. Thanks so much for joining in and for answering all the questions you did. Vishal Manchanda, Senior Vice President, Institutional Research at Systematics Shares and Stocks, is joining us on the phone line. Vishal, thanks so much for joining in. I'm sure that you've got a lot to think about today, and we spoke just yesterday. And pharmaceuticals was an exception in the list that we were discussing yesterday, but things have changed quite dramatically. The index as a whole down about 4% or so. What do you make of the latest development?
Yeah, so I think there have been comments that we'll see the pharma sector coming under tariffs very soon. So basically that review should not take long, and we'll have tariffs on the sector, and probably at levels not seen before. So that's the comments. Those are the comments that we are hearing on the sector. But I think I'll kind of reiterate my view on this. So I think even if tariffs are imposed on the sector, they will be inflationary, and so I would divide this space, pharma space, into three categories. One is the commodity generics, wherein I think tariffs will be passed to the consumer because there is no space for Indian companies to absorb. Neither is there are capacities in the US to replace the Indian demand that's coming, Indian supplies that is coming. So broadly, that's where I am on the commodity generics. Then there is a second part to the business, which is high value generics, like those of drugs like Revlimid and others. So I think on those we might see some impact, but the dependence is not very large as of now. So I don't think that will create, that is something we need to worry about in terms of the numbers that can basically dent. It will not dent the numbers basically too much. And the third is the NCE portfolio. I think the only company there is Sun Pharma, which I think even there the impact should not be more than 1 to 2% of their overall net profits.
Okay,
so broadly, I'm not worried about this.
You're not worried. So therefore, the kind of drawdowns that we're seeing right now are overdone in your opinion. And in this scenario, considering that you're not too worried, what would you be looking at and saying this looks very attractive right now?
So I think I was the prices, some of the prices in the large cap spaces, I think they were on an elevated level. Now probably they are at a more comfortable level to look at these stocks.
Can you name a few stocks that you were looking at specifically, Vishal?
So I think among the names, I prefer Sun Pharma and Cipla. So those are the names I would recommend investors to look at.
Okay. When it comes to CDMO companies though, considering the valuation picture and considering what you told us about the three segments that you're looking at and the implications of potential tariffs and considering valuations, what would be your opinion? Would you still be bullish?
Yes, so I'll remain positive on the sector because of the strong fundamentals in terms of the large USFD approved infrastructure we have to cater to the global markets. Then the capabilities around pharmaceuticals, and we are also kind of slowly getting into NCEs. So fundamentally, we are poised well. There might be some temporary disruptions in account of the tariffs because of the transition. That's the only thing we need to be prepared for, the transition of tariffs coming in. So that's where there will be some disruption, but I think post that things should be smooth.
Sure, considering a temporary disruption as well, do you think then for a shorter term perspective, domestic players will be a better bet right now? That is one part of my question. And secondly, then would you also kind of diversify into hospitals and diagnostics, if not these pharma CDMO companies?
I think these are safe havens. The valuations pretty much account for these being safe havens. But I think if you want to kind of get that alpha, probably we'll need to figure out something from these names which have corrected.
Is there a potential, Vishal, in your opinion, of carve-outs within this space? I know you broke it up into three buckets, but possibility of a CDMO and biosimilar being exempted from the tariff list?
Unlikely. I don't think so at least for biosimilars, I think that's a category where probably US would have capacities and a lot of capacities to take care of their demand. So probably that's a sector I would be worried about rather than be positive about.
Understood. Thanks so much for joining me, joining us this morning, and for your insight. Absolutely vital having you this morning. Thanks so much.
Thank you. Thank you.
All right, that brings us, and hopefully that has given you some perspective on how to treat your investments as well. Of course, we'll be talking about this in a lot more detail over the course of the day, and we'll keep you posted on any developments that we hear from the United States and specifically from the office of President Trump. That's all we have for you on this edition of Ask Profit. It's been a pleasure bringing it to you. Happy Friday for what it's worth. Do stay tuned. This is NDTV Profit.
Whenever a film sank in 2000s, it was always flop actor. मेरी तरफ नहीं देख रहा है देखो तो सही I compare an actor's career like the stock market. Sometimes your stocks are low, right? And when your stocks are low, no one's buying. Sometimes your movies do well and your stocks are on the rise and everyone's suddenly buying that stock.
What point do you think that the film career perhaps is not going the way that you thought?
Itch of wanting to be an entrepreneur started itching a little more and I wanted to scratch it.
One of the most important lessons is to know when to pivot.
The burn was far more than the earn. We were burning and I was watching my money just go out and like, oh my God, what's going on here?
He sold most of his stock, 80%, as on that date.
We have requested the management to come and speak to us. They asked us, what questions will you ask? We've sent it to them. They don't want to answer it, so then let's put it to our viewers as well.
7 key questions, right? How is it that 2,000 crore goes unnoticed by all of these auditors?
Is seeking more information on the trades and the all the transaction which has happened from the exchanges, both NSE and BSE.
The Reserve Bank of India's supervisory officers, they are seeking compliance reports on their foreign currency borrowings by these banks.
The DSS is actively engaging with the Reserve Bank of India to sort of ensure the thorough examination of the matter. And
Hello and welcome to this very special edition of KYC, Know Your Company. Today we're going to break down, analyze Bajaj Auto. We're going to start off with obviously trying to understand exactly what Bajaj Auto does. I'm going to start off by telling you all that it's of course the flagship company of the Bajaj Group, manufactures two-wheelers, three-wheelers, and it does both passenger vehicles within that two-wheeler pack to consumers, as well as in the CV space, it does three-wheelers as well. So, so wide variety in terms of product suite. You're looking at some of the brands that it operates. KTM through its ownership of the KTM brand, through the Austrian brand, which is KTM. But outside of that, pretty much all brands are in-house and developed in-house. Chetak, of course, EV being one of the newest brands that they've launched within the EV space, and quickly gaining market share, that one. This is how the overall sales have stacked up for FY24 versus FY25 full year. Of course, now we have full year numbers in terms of sales. Looking at 7% overall, but look at domestic, it's just 3%. And that's where some of the softness in terms of the numbers have crept in terms of the company as a whole. The two-wheeler export market on a low base has done around 13 to 14%, which is okay. It's a low base and therefore you would expect something better from it. But at least FY25 numbers, okay. This is the place where it's been slightly soft, the operating metrics, where Bajaj Auto is concerned. But I want to try and highlight some of the verticals and the pillars of Bajaj Auto. One, it has a 100 to 110 cc segment where it runs the Bajaj CT and the Platina brands. 125 cc and above, it has Pulsar, KTM, Avenger, among others. And then it has Pro Biking as well as Triumph. So those are some of the other brands that it runs, Bajaj Auto. It also does three-wheelers where it has a 75% plus market share. Exports as well is fairly large for it. It does exports in 80 countries worldwide. Mexico, Peru, Ethiopia, Turkey, Saudi Arabia are just some of them. You also have a Bangladesh and a Myanmar and an Afghanistan as part of that pact. It's also ventured into Latin America. So Africa, Latin America now being the big focus areas. And we will also have a conversation with the management, Mr. Rakesh Sharma, Executive Director, to talk to us about what the outlook is like going forward with regard to a Bajaj Auto. But let's quickly look at what are the metrics that we'll be tracking for this particular company. We're going to start off, of course, with the four basic ones: income statement, balance sheet, cash flows, shareholding and return ratios. Those are the five basic ones. Thereafter, we look at street cred, street coverage, and we'll also look at the valuation picture. And joining me today to break this one down is Puneet Javeri. Welcome, Puneet. Let me allow you to start off with the income statement. This is home turf for you.
Yeah, well, definitely, and it's a very strong income statement. The company has, over the last 5 years, we've definitely seen post-COVID the strong recovery in financials after that blip in 2020. So, revenues of FY24 was about 44,000 crores for the company. It's grown at a strong CAGR of 17% over the last 3 years. EBITDA has also kept up pace, much higher, 21% growth for the company, while on a profitability basis, it's more than 7,400 crores of profits generated in the last year. That momentum has continued in this particular year as well, and profits have grown at a CAGR of about 18%, Harsh, overall. So definitely it's a flagship brand, much known about the company, but definitely a very big financial gain for the company, essentially very positive on that aspect.
Yeah, they've done well on profitability as well, right, Puneet? Clearly a thumbs up, 2,000 crore plus of PAT. They also do 20% plus of margins, which is very, very healthy for an auto two-wheeler and three-wheeler maker. And they've also, to some extent, signaled the larger focus on profitability versus going only for top line and volume growths. That's basically what they've signaled. And therefore, compared to peers, this one is doing something slightly more differentiated in that sense. So something to be kept in mind. Let's quickly look at the balance sheet as well. No concerns here whatsoever, frankly. It's a net debt-free company. It's got nearly 2 lakh crore plus of market capitalization, and thereafter being net debt free and generating strong free cash flows means that debt is not a concern, at least at this point, and therefore clearly a thumbs up on this count. No concerns. Puneet, cash flow.
Well, cash flows also kept up pace very strongly. The cash flow from operations for FY24 was roughly at 6,500 odd crores. And when you compare it over the last 3 years as well, it's been very well at 28% CAGR. This is despite, the new EV brand of Chetak launched in the two-wheelers. They've also launched the electric three-wheelers as well. And while on an EBITDA margin basis, it's not helped growth because the two-wheeler business has been growing, but they've maintained the EBITDA margin at 20%, and that has flown to the cash flow as well. The net cash flow number as a whole is coming at 319 odd crores. It's 11% CAGR, Harsh, on that aspect. But overall, both income statement and balance sheet doing very well, and that's flown into the cash of the company as well.
Absolutely. I'll quickly take you through shareholding as well. Thereafter, we'll also look at return ratios. But in terms of shareholding, you're looking at promoter holding at 55% currently cumulative. Mind you, there's been a buyback as well, and therefore actually promoter holding has only gotten better. And that's one key positive. Bajaj Holding is the key promoter, of course, promoter entity. 34% is what Bajaj Holding holds. It's been this way for the last at least 7 to 8 years, and therefore what you're seeing is good, strong promoter ownership continuing, and intent of the promoter as well to continue to hold. You have then Jamnalal Sons Private Limited, which is one of the other entities, which holds around 9.3%, and a Maharashtra Scooters, which is also a listed entity, holds around 2.5% of the company at this point. And then there are, of course, smaller shareholders within the promoter group. But overall, it's a very, very strong promoter holding, and it's a well-held, closely held company in that sense, of course, of the Bajaj group. So unlikely that this will change significantly. A clear thumbs up on this one. Return ratios, Puneet.
Well, definitely. We've seen very strong return ratios for the company. Return on equity more than 30% for the company in FY24. And, that's reflective of the strong profitability that's flown into return ratios as well. return on capital employed, and that's very key for this company, more than 28.8%, and that's actually improved to 30% in the 9 months of FY25, Harish. So no complaints here as well. It's a big thumbs up on this aspect as well.
Okay, let's go across to street coverage then, Puneet. So that's how it really stacks up in terms of street coverage. Is fairly healthy coverage in that sense. But just in terms of upside, there are analysts on the street, Puneet, which believe that a TVS, an Eicher, and other auto stocks look far more attractive than this one. And yes, therefore we call this a neutral, even though it's very, very well covered. It being a Nifty 50 stock, in that sense, it's very, very well covered. But nonetheless, we'll call it a neutral, 66% buys, and of course the upside being 20%ish. But there are much better opportunities out there as per what analysts seem to suggest in this segment. But you want to take us through street cred?
Yeah, and definitely, just one comment, because Eicher as well as TVS, they both have, so TVS has a scooter portfolio, and that segment has been growing very well. And I think hence it is much overvalued, and we get to valuation there. And Eicher specifically, it's tapped the export market for the first time this year. They've crossed 10 lakh, and hence I think the growth aspect there is much higher. Hence, your specific point of 66% buy calls, and that's why it's still a neutral. The street coverage, though, we've seen a strong return potential, 277% has grown in the last 5 years specifically. Compared to the Nifty, it's at 180%, and dividend yield has also been 1%. But I think we were speaking about this before as well, because if you remove the March first part of the March, if you take it from March 1st, I think the return hasn't been as high as expected.
Yeah, I mean, when you pull it back a couple of months, because of course 5 years exactly will mean the lowest of lows of COVID.
Yes.
Therefore, is that fair to look at returns from the lowest of lows of COVID? Maybe not.
Yeah.
But if we were to look at it, say from 1st of February, the returns it's been a 2.5 bagger in the last 5 years, which is fairly satisfactory. But what we've seen is that it's underperformed the index marginally. And therefore, what you would therefore believe is that maybe a better performance. And the second piece, Puneet, which you kind of highlighted to me, is that some of the other players, like a TVS, have done phenomenally well in the same period of time.
Yeah, I think TVS has grown 8x in terms of share price performance in the last 8 years, and right now around 2,400 is where TVS is. That's fallen from 3,200, so it was much higher there. Similar with Eicher, if you just count on this metric, it's around 320%, so 3.2x bagger in that aspect. So,
but even this one's fallen nearly 30%.
Nearly 30%,
right? So,
yes, definitely. And
so that is to match
TVS, yes. So, but on this particular metric, we've seen the other two Eicher as well as something. And while they have outperformed Hero MotoCorp definitely in terms of growth and share price performance, I think that is one key thing to highlight as well.
Fair point. And what about valuations, Puneet? You're the best to drive that.
Well, valuations was tricky to say the least, Harsh, essentially for this in the two-wheeler space, because we've seen TVS being a key outperformer with 37x of FY26 price to earnings.
And Puneet, sorry, but each of these cater to a very different market. Each of them have very different priorities in terms of how management looks at the market as well. So sorry, yes, please go ahead.
Definitely, because for Eicher specifically, we've seen the export market growing very well in this year, and it's 350cc and above, so it's catering to the premium market, and growth has been there in this year, and hence visibly there. For Hero MotoCorp, largely caters with the 100cc segment of the company. The growth has been largely absent, and now there are reports also that there is a lot of discounting happening, so might affect margins, and that's why it's trading at roughly half the, like more than 150% below something like TVS. And TVS is a complete product portfolio, multiple brands. They have 3 separate scooter brands, unlike Bajaj Auto, which has the Chetak already. But with Jupiter, with Ntorq, that market is growing very rapidly. Apart from what they have in Apache in the motorcycle segment, and now they've added Norton as well in the ultra premium segment. So I think that's where the valuation comfort is there, specifically for TVS. When you look at Bajaj, it has fallen from its, we've seen the 30% correction, and hence it's become more favorable. And now the Chetak brand has been doing very well in the EV segment, sales of about 2.3 lakhs. But we've given it a neutral basis on the higher growth prospects of TVS as well as Eicher Motors.
Right. If I can just ask you, and this is completely off the bat, FY27, Would you have visibility on how these PE ratios move, especially for the first two?
I think currently most analysts are penciling in, and are waiting for the management commentary in Q4, because the domestic market has fallen for 6 consecutive months for for Bajaj Auto, and I think that's why the comparison is not available for FY27 specifically. But definitely, I think in that aspect as well, Bajaj might offer a very interesting opportunity going forward, because the company has a lot of cash. We've spoken about that. So I think eventually, once there's visibility on growth in over the next year or so in terms of sales, I think those valuations become more attractive for Bajaj Auto.
And we've asked the management exactly that. So maybe we'll wait for that. But let's quickly look at how the rating parameters stack up in that sense. There you go. So income statement, balance sheet, cash flow, shareholding is a clean thumbs up on all 4. Also, in terms of street coverage, okay, a neutral there. Street cred valuation, a neutral, but return ratios again very, very healthy, anything between 28 and 30%. That's how the KYC rating stacks up for a Bajaj Auto. Mind you, we do factor in that this is a Nifty 50 company, and therefore we factor that into the ratings that we give, and therefore you might see that compared to a benchmark, you will see a slight bit of more rigor with regard to how we give a rating on a Nifty 50 stock. You would have higher expectations from it as well. But let's look at SWOT, Puneet. The strengths being, there's very strong brand visibility. Chetak has been a brand for Bajaj Auto since the time me and you were born, and continues to be a very strong brand. So and Bajaj Auto therefore has had a very strong brand. I remember when I was a kid, Hamara Bajaj was the big ad, and that continues to be the case. But what they've done, and what really stands out for me here, is that they've been able to hold on to margins. A 20% margin for an auto company, which is also doing EV. Is commendable in that sense. And we've asked him the outlook with regard to that as well. So listen in. But in terms of weakness, two-wheeler market is seeing a slowdown. They're letting growth go. We spoke about the operational metrics. We gave that one a thumbs down. Remember, even though that's not part of the metrics in the KYC rating, but we did give it a thumbs down. And there's also slowdown in the export market. It's starting to pick up. But what's the visibility like for FY26 is something which will hold the key. That's currently the weakness. But what are the opportunities and threats, Puneet?
Well, definitely, the new EV segment, the two-wheeler Chetak brand has been doing very well. It will look to build on to that growth. And we've spoken to the management about the growth aspect of the EV segment. They've also added the three-wheeler EV. Now they've relaunched a brand called GoGo, which will host essentially the three-wheeler business of the commercial vehicle side. That is a very interesting opportunity. And valuation versus peers, we discussed in detail. Currently, there's less visibility on the growth aspect of the domestic two-wheeler business. I think the export growth was absent this year, and hence we've seen that correction in the stock price as well. But overall, for the next year, they will have Africa come back, which is a big export market. They've added Latin America, Brazil capacity has been increased now. So overall, it'll be very interesting to see in Q4 the company's commentary on growth for the next year.
Puneet, let me pause you there. So after this, once we're done with this, I want to also look at the graphic of the March numbers and probably try and break that down before we go across and speak on the interview, because that's what you're talking about. Sorry, please go ahead.
No, definitely. And that's the key aspect, because currently they had penciled in 6 to 8% growth for this year. It's coming at 7%. So definitely meeting guidance, but it's still slower than something what TVS has done. And the threat is, of course, the slower two-wheeler growth. We've spoken about that as well with the management in terms of how next year is shaping up. And export market, that is currently, we've mentioned that as an opportunity as well. But we've seen increased competition from the likes of TVS. TVS now exports roughly 1 lakh units a month in terms of exports. And that's very close to what Bajaj does. Bajaj is at 1,50,000, and that it doesn't take too much time for the brand like TVS to increase that aspect as well. So definitely could be a threat, but the opportunity as well as the strength of the brand is something to talk about here.
Right. Can we have that graphic, please, with regard to how the March numbers have panned out for Bajaj Auto? And what we'll try to do is maybe we'll just try to speak about that. Puneet, so overall sales was just 7% this year. Domestic was 3%. That's where the main concern is. In fact, for March, it was just 1%. Export in terms of two-wheeler was roughly 14%, 13 to 14 odd percent. And three-wheeler, again, in the domestic space, just 3%. So Domestic is where it's hurting.
Yeah.
And that's what we've even gone to management with. What we've gone ahead and asked them, and let's hear it from the management. We spoke with Bajaj Auto's Executive Director Rakesh Sharma, I beg your pardon. Here's what he had to say on the potential challenges for the company going forward. Listen in to a slice of that conversation.
Well, yes, over the last 5-6 months, and if you see, in fact, the entire year, we've sort of come out flattish when you look at volumetric growth. Our approach has constantly been in the market to optimize the top line, bottom line, and our. So therefore, you will see that this year we have achieved a milestone of 50,000 crores at an overall level. And at least in the first 3 quarters, as you know, our EBITDA margins were 20% plus. The final quarter, the financial results are still in the making and will be declared very soon. So that sort of indicates to you that it's not a one-sided approach which Bajaj Auto takes. We have to constantly look at optimizing the bottom line and the top line, as I said. And there have been periods of high demand, but there have been categories where it's been like, almost a red ocean kind of a situation over there, and we have not participated. So yes, in terms of being flattish, it's absolutely correct. In the domestic motorcycles, we have been a little bit flattish, but that's the outcome of balancing the top line and the bottom line.
Fair point, Mr. Sharma, because while I look at the last 6 quarters, your standalone EBITDA margins have been over 20%, so that's commendable. The only aspect for an investor, of course, you mentioned 6 to 8% growth at the start of the year, and you've achieved that as well because of a stronger export market growth, revival in second half of last year. But how should investors look at your share of domestic market growth, because that's been, as you rightly mentioned, it's been a negative for the last 6 months or so. So even the 125cc segment and above, because I think your 100cc segment is 8 to 9% of sales, so the rest 90% is also not growing in the domestic market. So I just want to understand, as a company and as an approach, what is, if you can guide us also, anything to watch out for FY26 also. Do you see the growth being in that 6 to 8% range, or do you see it at the lower end of that range as well?
Well, the 6 to 8%, which I mentioned earlier, and which I would say around 6% is what we would take the industry to be growing at. And we believe that we have, at least over the last 6 to 9 months, put in place a portfolio which should deliver us in the coming months, in the coming year, and a performance which will be higher than that of the industry. FY25 was also a period where the EV business was scaling up. And towards the end of FY25 is when we achieved, we got rid of the negative margins which we were getting in the EV business. And that then allows us a greater degree of freedom to actually balance out growth and profitability. With the substantial EV portfolio being now in the green zone, 25% of our domestic revenues come from the EV vehicle sales, and all that is now in green zone, and that gives us a certain flexibility. So therefore, we feel that given the kind of product portfolio which we have put in, whether it is a CNG-based bike or it is the sub-segmented Pulsar variants targeted at sub-segments, almost 8 or 9 of them over the last 6 months, they should be able to drive growth. And of course, there are more new products in the pipeline in the coming months.
Point taken, Mr. Sharma. Harsh also joining in. Want to quickly check with regard to where the margin trajectory goes with regard to EV. You mentioned that it's now turned green in terms of EBITDA positive. Talk to us about how quickly does it go and scale the 20% number, because that's the number you're looking at an overall level.
Well, that's quite some time. If you understand the cost architecture and the dynamics, the EV, I'm sure you will understand that for a 20% EBITDA at the EV is
but sir, that journey, how does it go? So talk to us about FY26. Will it continue to go up in this year as well as in the next year? Is that how you see it?
You see, these things are outcomes of greater growth forces. I cannot sort of bet on it going. Of course, our endeavor is we were in the negative territory. We have now come into the green area, and we will continuously try to increase profitability over there. Like I mentioned earlier, we are optimizing top line, bottom line, and competitive position. All that is being done in the context of a very volatile international environment. To just, give you a number and say that this is exactly what is going to happen is not, it's not correct on my part. I can alert you to the various forces and our intent, but to be definitive about it, I won't sort of go up to that thing. Our intent is, of course, to keep improving the profitability, maintain our leadership, and balance the top line and the bottom line.
Point taken. And sir, PAT positive on both of these individually as well as combined. Again, the outlook there also, my guess is that you'll be non-committal. You're more skewed towards, or rather you're more focused on growth. Is that the right way to think of it?
If I've understood your question correctly, I'm saying that we are balancing growth and profitability with competitive position, and we don't calculate PAT at a business unit level.
Okay. So, a quick question with regard to export. You've had a soft month in the month of March. FY26, does growth come back significantly? Of course, FY25 also you've grown decently, let me give you that. But so overall, FY26, what's the growth outlook like? Because each geography has its own set of issues.
Yeah, you're right. And, growth, the structure of growth, whether it is domestic or international, it's such that it is not linear or secular. It is not a straight line. It's more like a snake in the tunnel. We have to be, some quarters will be high double digit and some quarters will be, low single digits. That's just the nature of the markets right now. That's the nature of the construct of it. We have grown by 13-14%. And I would say that unless there is a major disruption, and always we have to put out that caveat when it comes to international markets, we should be clocking a similar kind of a growth rate in FY26.
Mr. Sharma, I just want to talk about the EV segment, because you had a very strong year in terms of the two-wheeler, and that's been highest compared to all your peers. And you are about at 230,000 units sold in FY25. For next year, what is the growth outlook? Because now you have a sizable base as well. I think you're number 3 in terms of overall sales for this year. In FY26, should we expect, firstly, on in terms of performance, any kind of growth? While if you can give anything quantification in that aspect, and on EV profitability, 2 electric 3-wheelers were already profitable a couple of quarters ago on EBITDA. The electric 2-wheeler business is also EBITDA profitable. On PAT profitability of electric 3-wheeler, can we expect that in FY26?
I just said that we don't calculate PAT at a business unit level. The PAT is done at a corporate level, which is a combination of all the 6 business units which we have. The growth prospects for electric vehicles are promising. The industry is growing at about now 20% or so. The subsidies, as you know, have been halved in two-wheelers. We have to see what the impact is, but we think that it will certainly be still at a 15 to 20% growth. Q4, Chetak became number 1, and therefore we've got the momentum. We've launched a new platform, which is our 3.5 series. A few more products are in the anvil. The bottom line has turned positive. So things have lined up very well. New products, positive bottom line, industry growing at 15-20%, which is quite decent. So I think we should be able to outpace the industry again in this segment as well.
That's unfortunately all the time we have on this edition of KYC. From Puneet, myself, everyone who puts this show together, thanks so much for watching. Hope this was productive. And stay tuned to NDTV Profit. More action on the other side.
Whenever a film sank in 2000s, it was always flop actor. मेरी तरफ नहीं देख रहे देखो तो सही. I compare an actor's career like the stock market. Sometimes your stocks are low, right? And when your stocks are low, no one's buying. Sometimes your movies do well and your stocks are on the rise and everyone's suddenly buying that stock.
What point do you think that the film career perhaps is not going the way that you thought?
Itch of wanting to be an entrepreneur started itching a little more and I wanted to scratch it.
One of the most important lessons is to know when to pivot.
The burn was far more than the earn. We were burning and I was watching my money just go out and like, oh my God, what's going on here?
He sold most of his stock, 80%, as on that date.
We have requested the management to come and speak to us. They asked us, what questions will you ask? We've sent it to them. They don't want to answer it, so then let's put it to our viewers as well.
7 key questions, right? How is it that 2,000 crore goes unnoticed by all of these auditors?
Is seeking more information on the trades and the all the transaction which has happened from the exchanges, both NSE and BSE.
The Reserve Bank of India's supervisory officers, they are seeking compliance reports on
Hello and welcome. This is Malika Mishra and you're watching Markets at 12. Indian markets are currently dilapidating with the benchmark indices such as the Nifty 50 and the 30-pack Sensex experiencing deeper cuts on grounds of global uncertainty fueled by Trump's reciprocal tariffs that just came out yesterday. And apart from the stock markets, other important commodities like gold, crude oil and the dollar index is fuming with different reactions. To understand what's happening with these globally traded commodities, I'm being joined by Peter McQuarrie, the Chief Executive Officer at Trading.com. And to participate in this conversation with me is my colleague Mehika. Thank you so much for joining us this afternoon, Peter. Thank you. Firstly, I'd like to know, how are you gauging the implications of these tariffs on global trade, especially given how uncertain their nature has been? For example, yesterday we were of the view that pharmaceuticals would be exempted from these tariffs, but today the case has been sort of appended. Give us your thoughts on these tariffs and how do you see it changing international trade?
Well, good afternoon, Malika. I mean, a couple of things. We've got to look through the commentary coming from President Trump and how that's interpreted to the marketplace. First step is what we've seen as far as market correction. We've seen equities punch down. We've seen silver down the best part of 8%. Crude oil's had a very solid move to the downside. You've had US dollar being pressured immensely to the downside. And a lot of those other currencies have had a big push up. And how that's going to be interpreted in the sense of the tariff and the policy and whether there's any room for negotiation from countries, for example, like India, with a 26% tariff. Is there room to negotiate and how is all this going to be, I think, unwrapped over the next couple of weeks?
Good afternoon, Peter. Mika joining this side. Welcome to the show. I want to talk about oil prices. I mean, you've seen a 7% downtick in April itself. We've seen bearish trajectory on the most parts in terms of oil this year. Where do you expect prices to go from here? And are there any key factors that we need to watch out for?
Well, I think so. I think it's been, and good afternoon, I think a couple of things. First off, it just seems very coincidental, doesn't it, that OPEC does a similar, on the same day, it looks at increasing production. It's conscious as far as what's going on with the big picture. and we've seen crude oil prices down nearly 7 or 7.5%. And where we're looking as far as an increase in production, and I think you're going to see softer prices over the next couple of months, there is no doubt that possibly $60 is the new handle that you've got to look at. The consideration where it also sits with crude oil, if you're going to see further moves to the upside as far as more production coming online from OPEC Plus, this is all going to impact, and this is going to be a good sense as far as inflation and very strong for the consumer.
So are you confident that OPEC will finally increase its production? I mean, historically they want prices to be higher. Increasing production in a scenario where demand is very uncertain, whether it's from China and now US in the mix. What do you expect them to do post the meeting?
Well, I do think that they will look at increasing production. I think that the other side, of course, is that they're conscious where this could roll as far as the tariff policy. Is there going to be a general slowdown as consumption? And I think they're getting on the front foot and they're taking the necessary action as far as strategy. And I think that with President Trump's also mantra of drill, baby, drill, this is going to also impact crude production globally. So I think that you're going to see softer prices leading into the rest of Q2 and maybe even into Q3 for global crude prices.
Softer crude prices going forward. But speaking of gold prices, Peter, they recently touched record highs but then retreated after these tariff announcements came to play. However, despite the volatility that we've seen with regards to these, this particular commodity, do you think gold would continue being the safe haven asset it is widely called? And how should an investor, like a common man like me, look at gold in such times?
Well, and like me, I think you've got to look at, and that I put us both in the same category. India's had such an exposure to gold for not only centuries, but probably millennium. And the man and woman in the street are very conscious all across Asia as far as gold. And it's a flight to safety. And this has been very much the part of what we've seen this year has been tremendous move to the upside for gold. Silver was sold off yesterday, but look, I just think that that's probably just the paper market. The physical market is very, very strong. And there it is on the screen, 31.67. That's a record. I feel as though that 3,250, 3,250 is the next line in the sand. If it takes that number out, I really do think that you'll see a significant push to the upside. But that's where it's looking at. So many traders are saying, is the market oversold? Is it undersold? Where is the opportunity? But I still believe that gold has got its best time ahead of it over the rest of 2025.
Are you saying that the rally in gold is not over yet and there's much more to come despite what's happening globally?
Yes, I don't know whether there's much more to come, and that's hard to put, in more or less into words. I mean, we've got to be conscious. Where we were 18 months ago, we had a low of 1,800. We're now at 3,100. I'm not suggesting you're going to see that sort of performance over the next 18 months. But I do believe that there is still further room to run for the price of gold in 2025. Investment banks were saying you're going to see 3,000 to 3,200. We're already there and we're 3 months in. So I think that there will be further upside for gold, and I won't be surprised where it could be by Christmas.
It's interesting that you say that there's further room to go with regards to these gold prices rising in the future, because gold as a commodity is used across different sectors and in different ways, actually, whether it's central banks keeping gold in their reserves or whether it is being used in the jewelry market or anything else you say. So we will keep a track on that. But how do you see the current trade dynamics affecting the value of US dollar as dollar index that tracks the strength of the dollar against a basket of major currencies, sank against major currencies? And of course, globally, trade happens in dollar. With respect to dollar, how do you see this changing global trade dynamics? And do you think there could be a shift from the dollar to any other currency globally going ahead in the future?
Well, I'll answer that one first, and then I'll go back in time as far as the question. President Trump has said that the US dollar will remain the key currency or the number one currency of the world. And I'm not here to suggest any different to what President Trump's saying. So I agree with him. So I think that that's the first part. The second part is the US dollar has been absolutely savaged over the last couple of trading sessions. And now we're at 101 for that US dollar index, and it's had a massive sell-off. Is there a chance that you're going to see lower? I won't be surprised. We've also got, which is interesting, the bond yield, the 10-year is now at 4%. Now, are we going to see that take a further down leg? And that could mean that if it comes down and you see inflation come down as well, these are all factors that are going to impact a Fed rate policy decision. And what does that do to US dollar? So I think we're into a very exciting over this next 3 months for Q2 is going to be a very dynamic time for markets, equities, and of course, commodities and currencies and bond yields.
Peter, lastly, I was reading your mail from early this morning, and, you've spoken about how the dollar index was mainly hit by the, wars and risks around US entering the recession. Do you think that's a likelihood? Because there's a lot of talk on how these worldwide tariffs and whether negotiations take place or not, it could have, could do more damage to US and its consumers itself. What do you think?
Well, yes, and I'm conscious also as far as JP Morgan and their risk assessment as far as a recession, they're saying it's probably around that 60% number. So, that's their forecast, and I've just got it written down here. So that is one to consider. I want to see tonight what's happening with non-farm payrolls. That's going to be a big number to drop. Now, these are all big factors that are coming into play. So, again, we've had a most incredible couple of days of trading. And I don't suggest it's going to end right this second. It's going to continue for the rest of Friday, and it's going to be a very dynamic market to look at from a US perspective when that opens tonight.
Got it. Peter, thank you so much for coming onto the show. It's evening where you are, and thank you for giving your insights.
Thank you very much.
Yeah. Okay. Well, look on how, oil prices, gold prices, and even the US dollar index would turn to as amid various concerns across the globe. But let's shift our focus back to Indian markets, and I want to talk about the Nifty Metal. It's the, top losing sector of the day. The Nifty Metal is down over 5% and, intraday low of almost 6%. Even if you look at the constituents of the Nifty Metal, all 15 of them are in the red right now. Top losers are Hindustan Copper, Vedanta, Nalco, all seeing cuts of almost 8%. Even the best gainer on the Nifty Metal, Ratnamani, is down about 2%. So, let's talk about what's causing the uncertainty and why metals are feeling the heat. It's key to know that metals is one of the large contributors to the FY26 Nifty EPS. And now the sector could be vulnerable. There are new capacities coming in from various companies, but there's a chance of lower prices. Now, US tariffs, 26% on India. On a direct basis, there's no impact on the Indian metal sector because we have very limited exports in terms of steel and aluminium to the US. However, there is a possibility of an indirect impact which has a greater implications, and the higher possibility of a severe US recession or slowdown can impact commodity prices, especially metals, significantly. I want to focus on the aluminium stocks which have plunged in trade. Nalco, Vedanta, Hindalco down almost 8% in trade today, and this has an impact. In terms of MK, they're stating that the US global slowdown could first impact aluminium prices as well as earnings and valuations of companies. Now, they've given various scenarios on which how deep the aluminium prices can fall. In a scenario of a US or global slowdown, aluminium prices could fall to around $2,300 per ton. In a scenario for recession, it could fall $1,900 per ton. And currently, it's key to note that aluminium prices are trading around $2,420. So this has an impact on Indian companies. And if you have to look at how the three companies have an EBITDA sensitivity in a scenario of prices falling down to $2,300 per ton, which is a scenario where there's a US or global slowdown. Hindalco has a 20% EBITDA sensitivity to this, Vedanta at 25% and Nalco at 28%. And if you had to look at how much the stocks could fall, well, as per MK, it could lead to a fall of anywhere between 26 to 39% for these three counters. And, Malika, that's why the metal sector is feeling the pain today.
Yeah, so basically, while Indian metals may not have direct exposure to the US market, but the indirect impact is so solid that we could see some kind of downside.
It's all fueled by uncertainty because that's the nature of the year.
Yeah, and viewers, another sector, so to say, that is heavily reacting and it has had a short-lived joy is the pharmaceutical sector. Stocks have sunk after US President Donald Trump remarked about the upcoming tariffs on the sector. But before we get my colleague Varsha to tell us the possible implication of this on the pharmaceutical space, let's hear the President Trump himself.
Chips and pharma tariffs are not on the table. Starting very soon. The chips are starting very soon. The pharma is going to be starting to come in, I think, at a level that you haven't really seen before. We are looking at pharma right now, pharmaceuticals as a separate category, and we'll be announcing that sometime in the near future, not too distant future. That's under review right now.
And now I am being joined by my colleague Varsha to analyze the quantum of the impact of these tariffs on pharmaceutical space and why are we seeing the spookiness.
So yes, Nifty pharma index is actually down now. Why? Because Trump says that pharma tariffs are coming soon in near future, and he clearly said that pharma tariffs will be at level which we haven't seen, and pharma will be a separate category. Now the important point over here, so if you see a lot of every stock, you take a name, Gland Pharma, Aurobindo Pharma, Dr. Reddy's, Supply, and all the pharma stocks are actually down on the back of this news. Now the important point is, would it be rational to impose tariffs on pharma and generics? Let's see, the value of US drug imports was almost $170 billion in 2023. India exports pharmaceutical goods worth $10 billion to US, which contributes 6% of the US pharma imports. If I want to talk about generics provides more than $400 billion in annual savings to US healthcare sector. So clearly this seems that it's actually not possible or not rational to put tariffs on India when US is so much dependent on India when it comes and even on other countries when it comes to pharmaceutical products. Even for China, PII data shows that there was exports of $2 billion from China to US in 2023. Now, why? The important point is why tariffs on pharma will actually not work. One is healthcare is actually not a discretionary spending, and supply chain is quite elongated and complex. Even if Trump says that come to US and put up facilities, it would take 4 to 5 years to put a facility and start running. So that's not viable to do that. Large capacity building can actually take decade or longer. Now let's talk about which are the top pharma products exporting countries to US. Starting with Ireland, in 2023 it exported almost 28%. If you see, Germany exported 21% of pharmaceutical products to US. India exported 11%, and the other categories fall at around 50%.
Right, Varsha. Thank you so much for explaining us the possible implications of these tariffs on the pharma space. And viewers, just to remind you that at the NDTV Profit conclave that took place just a few months back in February, chairman and founder of Wockhardt, Habib Khurakiwala, said that reciprocal tariffs by the US would not hurt the Indian industry. Here's why. Let's listen into him.
Basically, to make a change in formulation, for example, takes roughly 3 to 5 years. So from that context, there is, unlike steel or cement, you can switch suppliers at a day's notice. You can't do this in our industry. So the view I have is short term. Any tariff coming on Indian goods will be passed on to American consumers and Indian companies will not be affected. Okay. But long term, one doesn't know what happens after 3 to 5 years.
Yeah.
And just to get you another perspective, we spoke to Vishal Manchanda earlier in the day. He's a senior VP Institutional Research at Systematic Shares and Stocks. And we asked him if hospitals currently are safe bets or not, given the kind of turmoil that pharma stocks are seeing. Let's listen in to what he had to say.
Yeah, so I think there have been comments that we'll see the pharma sector coming under tariffs very soon. So basically that review should not take long and we'll have tariffs on the sector and probably at levels not seen before. So that's the comments. Those are the comments that we are hearing on the sector. But I think I'll kind of reiterate my view on this. So I think even if tariffs are imposed on the sector, they will be inflationary and so I would divide this space, pharma space, into three categories. One is the commodity generics, wherein I think tariffs will be passed to the consumer because there is no space for Indian companies to absorb. Neither is there are capacities in the US to replace the Indian demand that's coming, Indian supplies that is coming. So broadly, that's where I am on the commodity generics. Then there is a second part to the business, which is high value generics, like those of drugs like Revlimid and others. So I think on those, we might see some impact, but the dependence is not very large as of now. So I don't think that will create, that is something we need to worry about in terms of the numbers that can basically it will not dent the numbers basically too much. And the third is the NCE portfolio. I think the only company there is Sun Pharma, which I think even there the impact should not be more than 1 to 2% of their overall net profits. So broadly, I'm not worried about this. So I think I was the prices, some of the prices in the large cap spaces, I think they were on an elevated level. Now probably they are at a more comfortable level to look at these stocks.
Can you name a few stocks that you were looking at specifically, Vishal?
So I think among the names, I prefer Sun Pharma and Cipla. So those are the names I would recommend investors to look at.
And earlier in the day, we also spoke to Sandeep Tandon. He's the founder and CIO at Quant Capital. And he said that instead of fearing the current atmosphere, one must buy because he thinks that it's a great time to buy whatever you feel may be right for your portfolio at this given point of time. Let's listen into that bite and see what his rationale actually talks about.
Yeah, I tell you, the way I look at this thing, this is a more of a negotiating tactics which Trump is playing, and we have to understand that there is no point getting paranoid about it and unnecessarily getting capitulated at the bottom of the cycle, So we are not that negative the way prices sometimes indicate. So we have to understand the difference between narrative and the reality. Okay. Now the way I will read it, obviously the one round of announcement is done. So worst is behind us. Now, if you really sit down and analyze the statement or foresee what it talks about very clearly, this is the announcement. Once you start talking about bilateral thing, it can come down. So there are certain conditions. And if I can also say that India is one country who has already taken the lead. Okay, India was the first country to visit to US. Okay, and last week, if I'm not wrong, their delegation was very much in Delhi, and we are in advanced stage of negotiation. So I think as a country, we think we have taken right steps. Okay, and ultimately, US is a large economy, and we have to sort out whatever the challenges we are facing. I think I'm optimistic. This is the worst case scenario outcome we have seen. From here, it can only improve. So no point getting capitulated at this point in time. In fact, India actually behaved quite well as compared to global market yesterday. It showcased that India could be a hiding space as compared to what the turmoil you are seeing in the global market. And we also don't have to forget that India is a very large domestic driven economy. So our impact will be relatively less. And I always say, look at not only an absolute basis, absolutes are important, but relatives are more important. So relative to other markets, the tariff differential, we are beneficiaries. So I think it's a great buying opportunity in a sector which you like, rather than getting too nervous about it at this point of time.
You've led me beautifully to the next point, the sector which you like. Sandeep, to hear from you that this is a time to go out and buy, this is a buying opportunity, heartening when there's so much gloom and doom out there. Would you stick to the tried and tested financials, or you see more space than sectors like auto consumption?
See, I think obviously consumption broadly is a very broad sector, is the biggest beneficiary in the budget. So consumption theme should play out very well from a longer term perspective. Then in the current environment, our focus is more from a domestic economy, large infrastructure space. Okay, if you really look at even the NBFC, given the interest rate pressure which can come down. So I think the way you look at the domestic company, insurance sectors, so in the hospitality space, even we like pharma, despite some narrative is floating around today, I think is a great sector because cost of production of generic drugs in the US will be few times what you do it out here. So far exemption we have seen, but even some tariff comes, I think Indian companies are in the position to pass immediately. So I think we have to wait and watch rather than just reacting on some interviews or some noise which is floating in the market. I think it's a great opportunity. As long you have earning visibility, whether it's from the domestic perspective or from global perspective, I think, and valuations are attractive, I'll be all in such names.
Sandeep, good morning, Neeraj here. Could it well happen, Sandeep, that the index stays in a consolidation period because of the uncertainty and not necessarily actual moves happening? There could be negotiations, etc. And therefore, individual pockets of strength and weakness would arise. The way IT is correcting so much, despite the fact that the Nifty is largely well behaved, as you said.
So I'm not ruling out that also, but what I'm saying this year is obviously we said that second half will be better than first half, and within first quarter will be worse and second quarter will be slightly better. So with that background, I will say yes, we have seen last 4 years has been extraordinary, and we have been saying that easy phase of bull run is over. But we are still in bull run, but we are in a difficult phase of bull run. And to tackle a difficult phase of bull run, your strategy has to be different. It has to be significantly different than what we all did in last 4 years. So that I think the first thing, the mindset has to change. This I have been highlighting for last many quarters now, saying that the biggest risk in India is that our own expectation risk, because we have built so much expectation in last few years, the benchmark has changed. Once you bring down your expectation, then you will find opportunity. When you go back and look for 12-15% opportunity, you will get. The problem is that when you have 40, 50, 80% expectation and you are unable to fulfill, the frustration comes in, and they will say markets are not performing. But from the current level, I will look for a buying opportunity in select name, and there are enough opportunity available. We have to just be slightly patient and bring down our expectation. I think end of the day, you will be very happy.
So according to Sandeep Tandon, it's a good time to buy. India is in a relatively better space. He likes pharma, and he also says that we are in a bull run, but we're also in a difficult phase of bull run. And with that, it's an end at markets at 12, but do stay tuned to NDTV Profit for more news and updates.
Whenever a film sank in 2000s, it was always flop actor. मेरी तरफ नहीं देख रहे, देखो तो सही. I compare an actor's career like the stock market. Sometimes your stocks are low, right? And when your stocks are low, no one's buying. Sometimes your movies do well and your stocks are on the rise, and everyone's suddenly buying that stock.
At what point do you think that the film career perhaps is not going the way that you thought?
Itch of wanting to be an entrepreneur started itching a little more, and I wanted to scratch it.
One of the most important lessons is to know when to pivot.
The burn was far more than the earn. We were burning out. I was watching my money just go out and like, oh my God, what's going on here?
He sold most of his stock, 80%, as on that date.
We have requested the management to come and speak to us. They asked us, what questions will you ask? We've sent it to them. They don't want to answer it, so then let's put it to our viewers as well.
7 key questions, right? How is it that 2,000 crore goes unnoticed by all of these auditors?
Is seeking more information on the trades and the all the transaction which has happened from the exchanges, both NSE and BSE.
The Reserve Bank of India's supervisory officers, they are seeking compliance reports on their foreign currency borrowings by these banks.
The DSS is actively engaging with the Reserve Bank of India to sort of ensure the thorough examination of the matter. And
IndusInd Bank, as part of its internal review, had found that certain aspects of its derivatives portfolio was not meeting the standard that was set by the Reserve Bank of India.
Hello and welcome to Profit Buzzers at NDTV Profit. A very good afternoon to all the viewers. I'm Hiral Tatya and with me is Puneet Javeri. Puneet, I mean, we thought that the Trump impact was kind of just weaving off and probably a few sectors that we spoke about, but it's pharma which has been in the spotlight now. But first up, let's quickly take a look at the top headlines at this hour. Trump's tariff trauma pushes Indian benchmarks down in trade. Nifty and Sensex both lose at least 1%. Broader markets underperform frontline indices.
All sectors barring the financials in red. Tariff tremors are felt in metals as well as the pharma sector. The most, FMCG largely trades flat.
Nifty metal emerges as the top sectoral loser. US recession fears, oversupply concerns some metal stocks as much as 6% in today's session. We tell you more on the show.
And in an exclusive conversation with NDTV Profit, Rakesh Sharma of Bajaj Auto explains why did the automaker see flattish growth in this particular month. The domestic market has been affected in the last 6 months as well.
And on the show today, a special ground report from world's largest renewable energy project. We visit Adani Green's Khavda plant in Gujarat. Stay tuned. Let's quickly take a look at what's happening with the markets. Clear pressure building in. You have Nifty 50 as well, which is below that 23,000 mark. 22,960 is where Nifty 50 is trading at, with cuts of almost 1.3% coming in there. Let's quickly look at a sectoral heat map instead of only looking at Bank Nifty, because the major pressure is coming in with regards to where pharma, metals and oil and gas go. The only sector which is trading in the positive is Nifty Bank with marginal gains of around 0.2%, but the private banking space is pretty much on the tender hooks. But metals, 5.5% downtick. Nifty Pharma on the additional commentary that's coming from Donald Trump is what is putting pressure. We don't have timelines, but the near future is what Donald Trump is looking at with regards to additional tariffs. Oil and gas has been trading under pressure as well. But what's interesting is though oil has moved below that $70 per barrel mark, still you're seeing pressure because this would have been a positive step towards the marketing margins. But we will get in Somit to get us further details as to why this kind of a reaction that is coming in from the oil and gas companies. Energy, healthcare trading under pressure. IT2 consecutive session of downtick that's coming in as well. In fact, next week is when TCS starts to report numbers. So ahead of that, quite a bit of pressure that's building up as well. Real estate and defense, which was one of the sectors which was seeing an uptick, is seeing some bit of pressure. Let's quickly look at the Nifty 50 heat map and see which are the stocks that are trading under pressure and where is the pressure building up. Bajaj Finance seeing some gains today, Tata Consumers in the positive, HDFC Bank. So both of these are reacting to the quarterly update, I beg your pardon. But apart from that, Hindalco under pressure, ONGC is again down, Tata Motors, Cipla, L&T, Reliance Industries, Dr. Reddy's, these are a few of the top losers in trade today as well. So clearly, Puneet, I mean, it's mainly the Trump tariff fear that is gripping the Indian markets as well. What's going to be interesting from here on is how the Dow futures open up, because if there is a reversal that happens in terms of Dow futures, there is a possibility that the Indian markets could bounce back as well. So the key is to watch out for how the Dow futures are performing in trade.
Well, definitely. And, you know, we've seen a lot of pressure in the mid caps and the small cap names as well today. If you can pull up the mid cap 150 as well as the small cap 250, definitely, underperforming the benchmark indices today. Very less exposure to the financials for both these indexes, and hence we've seen them underperform the benchmark indices. Let's also look at, the advance and decline ratio as well. Let's pull that up and see where the market breadth is on an overall basis. To see if the advances growth has largely been, it's been a one-way traffic on the downside, to say the least. While we opened, somewhere we could see that kind of around the 9:30, 10 o'clock mark, some greens getting there, but overall it's been a largely negative day, 1900 stocks on the downside. Let's also look at finally the Nifty 500 and its key winners and losers. Will we be seeing a lot of stocks under pressure today? And all the pharma names, Loris Lab being the biggest one, down almost 8%. Vedanta also, bowing the brunt, and Bharat Forge is the other one, down 7% now, and we'll discuss Bharat Forge also during the show. Copper, Nalco, Samvardhana Motherson also reeling under pressure today, continuing its downward momentum from yesterday as well. On the upside, seeing some positives on Rainbow Childcare, largely a hospital, not too much impacted from the tariffs. Essentially, Imami and Marico. Marico is buzzing on the back of its quarter 4 update as well, so that's come in positive, definitely. And HDFC Bank also showing some gains, but we have been talking about the pharma aspect, and it's a short-lived joy which is ending for the pharma space as a whole. Stocks have sunk after US President Donald Trump said that tariffs are coming soon for the pharma sector as well. Let's listen into that slice of the conversation, that bite as well.
Chips and pharma tariffs are not on the table. Starting very soon. The chips are starting very soon. The pharma is going to be starting to come in, I think, at a level that you haven't really seen before. We are looking at pharma right now, pharmaceuticals as a separate category, and we'll be announcing that sometime in the near future, not too distant future. That's under review right now.
Pharma tariffs to be announced in the near future, not in the distant future. That's the timeline that Donald Trump is giving the counterparts. But let me actually go across to my colleague Varsha. Varsha, pharma companies have been under pressure after US President Donald Trump remarked about the upcoming tariffs on the sector. Clearly, yesterday was a day when all of us were cheering that pharma is a sector which has been untouched. But I think he's changed and just turn over the cards for the sector as well. But firstly, if you could help us understand, why will it be difficult to levy these tariffs? Because in spite of the stocks being under pressure, this has happened in the past as well.
So yes, Nifty pharma index is actually down now. Why? Because Trump says that pharma tariffs are coming soon in near future, and he clearly said that pharma tariffs will be at level which we haven't seen, and pharma will be a separate category. Now the important point over here. So if you see a lot of every stock, you take a name, you Gland Pharma, Aurobindo Pharma, Dr. Reddy's, Cipla, and all the pharma stocks are actually down on the back of this news. Now the important point is, would it be rational to impose tariffs on pharma and generics? Let's see, the value of US drug imports was almost $170 billion in 2023. India exports pharmaceutical goods worth $10 billion to US, which contributes 6% of the US pharma imports. If I want to talk about generics provides more than $400 billion in annual savings to US healthcare sector. So clearly this seems that it's actually not possible or not rational to put tariffs on India when US is so much dependent on India when it comes, and even on other countries when it comes to pharmaceutical products. Even for China, PII data shows that there was exports of $2 billion from China to US in 2023. Now, why? The important point is why tariffs on pharma will actually not work. One is healthcare is actually not a discretionary spending, and supply chain is quite elongated and complex. Even if Trump says that come to US and put up facilities, it would take 4 to 5 years to put a facility and start running. So that's not viable to do that. Large capacity building can actually take a decade or longer. Now let's talk about which are the top pharma products exporting countries to US. Starting with Ireland, in 2023 it exported almost 28%. If you see, Germany exported 21% of pharmaceutical products to US. India exported 11%, and the other categories fall at around 50%.
Well, Varsha, do stay on though, because we have seen such tariff threats essentially before as well. But what are the brokerages making of these tariff possibilities going forward?
Have we seen any tariff threats before? So previous tariff threats in first term of administration led to promises of US manufacturing. Now companies pledged capex and facility shifts, but nothing materialized. Also US scientists and manufacturing costs are actually 5 to 10x higher, and this leads to lower ROC and longer break-even times for US drug manufacturing. Lastly, let's talk about what ICICI Securities or what brokerage firms are saying. So ICICI Securities says that a 20% of tariff increase will lead to a product cost 120 rupees from 100 rupees. Now pharma companies may stop selling low margin products in the US, and increased cost will actually be passed on to insurance companies, pharmacies or consumers, and insurance companies will likely not cover branded drugs, and CDMO companies are likely to be unlikely to be impacted as they are hard to replace. So these are the views coming from ICICI Securities, and their investment recommendation is the current pharma stock dip is a buying opportunity, and long-term earnings are not expected to be significantly affected as per ICICI Securities.
Thanks, Varsha, to get us the details. And in fact, let's also listen into what Chairman Founder of WOCAD, that's Habil Kharakiwala, had to say about the reciprocal tariffs on pharma. He did speak to NDTV Profit exclusively on our maiden Profit conclave. Let's listen into a bite of that conversation, and then we will get you live as well in the coming weeks.
Basically, to make a change in formulation, for example, takes roughly 3 to 5 years. So from that context, there is, unlike steel or cement, you can switch suppliers at a day's notice. You can't do this in our industry. So the view I have is short term. Any tariff coming on Indian goods will be passed on to American consumers and Indian companies will not be affected. Okay. But long term, one doesn't know what happens after 3 to 5 years.
Yeah.
But what essentially may be seen as a respite, my colleague Rishabh is now learning from his sources that the Commerce Ministry may be engaging with the pharma exporters over these particular tariffs. Rishabh, what are you picking up on this?
Right. What we're hearing from Commerce Ministry sources is that they are in constant touch for support for these pharma exporters for any sort of boost or export guidance that is required. There is a dedicated joint secretary for all matters related to pharma. Remember, India is known as the pharmacy of the world. There is a lot of generics that go out and are manufactured right here in India and go out to the US as well as parts of Europe. About as much as about 40% of all generic drugs in the US are actually made in India and exported to the US. Anywhere between $8 and $9 billion is the current worth of pharmaceutical exports that go to the US currently. What we're picking up from major industry voices of the pharma sector is that the margins are extremely tight given the sort of very high regulations that the US FDA also has, a very high level of regulations that they require, a very high level of maintenance of plants, of standards is required, which is very, very capital intensive. So already a sector that is a bit shy on margins, and if additional tariffs come in, then it's sort of a death blow for a lot of these pharma exporters. What we're also seeing is that a tariff imposition by the US would actually hurt US consumers themselves, given how life-saving drugs can be, how important drugs can be. Any sort of a tariff that might come in on India might be very detrimental to US consumers itself. We will continue to track this situation very, very closely.
Right. Thank you, Rishabh, for getting us the details. So this is going to be an interesting aspect of it as to what happens with in terms of the exports and as soon as the tariffs kick in. Let me also welcome in Prashant Apse, Senior VP Research from Mehta Equities. Prashant, good afternoon and welcome to NDTV Profit. I'm sure you've heard the entire conversation in and around what's happening with pharma, with Donald Trump coming the next day and saying that we will be looking at tariffs on pharma. How are you looking at it, and what are the positives and negatives, and how badly could our industry be hit?
So I am not surprised, because when I see 2017 and 2021, pharma was the only sector which was down by 20%, despite in equity markets were up by 70% in those times. So it was surprising to see why Mr. Trump did not mention pharma as a sector to have some lot of tariffs. So, but surprisingly, next day he is out with respect to his volatile statements. He is changing a lot of things. One day he said with respect to keeping it aside and then taking care of this very soon. So for me, it's a negative aspect very soon. I think government of India has to intervene between the US government and Indian pharma industry experts. So there should be some medium tariff which can come into Indian markets. We cannot see more than even the way how their 26% has been levied. But for me, if it is compared with any other countries, again, if we are lowered in terms of taxes, that can be an advantage again, where Indian generic products or any other farm products can be a beneficiary for the US economic. Overall, it's a negative for a very short period of time. I think 1 or 2 quarters, these companies will face a lot of heat with respect to order books, with respect to supply chain, with respect to even margins also. So overall, short-term period, it's very negative for the industry.
So that's with regards to where the pharma pack is concerned. But the other segment that is in focus in today's day of trade are the oil marketing companies. Now, what's happened is that the stocks have fallen, and this is in spite crude has slipped below that $70 per barrel mark, and this is for the second time that's happened. Let me welcome in my colleague Somit to help us understand what's going on. Somit, I mean, when we started off the day, the conversation we had was that this is going to be a positive with regards to oil marketing companies taking into consideration the marketing margins, right? But what has gone wrong? In spite of oil slipping below that $70 per barrel mark, you are seeing pressure that is being built up.
Well, yes, generally oil marketing companies would benefit because of lower crude oil prices, because yes, lower crude oil prices and stable retail fuel prices means higher marketing margins for the oil marketing companies. Now, crude prices have slipped below the $70 per barrel mark. Yet again, in fact, in the last 1 month, we have seen crude prices going below the $70 per barrel mark for the second time. And this time, the reasons are firstly, the recession fears because of the tariffs that has been imposed by Trump on all the nations. And the second reason is the fact that OPEC is looking, in fact, OPEC Plus is looking to increase their outputs despite the fact that there are recession fears in the market. So both of these factors have led crude slip below the $70 per barrel mark. Now what does this mean for the oil marketing companies? Now lower crude oil prices means higher gross marketing margins, and because fuel margins have continued to trend at higher level, in fact at below $70 per barrel, crude marketing margin on petrol increases to around 13 rupees per litre as against 9 rupees per litre that was there a month back, while on diesel the margins have increased to around 10 rupees per litre from 7 rupees per litre that we had seen a month back. And generally every 0.5 rupees per litre increase in the marketing margin for petrol and diesel benefits Indian Oil Corporation, BPCL and HPCL's EBITDA by around 7 to 11%. But what is the reason why oil marketing companies have actually fallen in trade? Firstly, if you look at inventory losses, now generally whenever we see a sharp reversal or a sharp change in crude oil prices, there are inventory losses that is incurred by the oil marketing companies, because they usually maintain a 15 to 20 days of crude inventory, and crude that was bought earlier at a higher price needs to be pushed by them in the markets at the lower rate, because of which there could be some inventory losses for the oil marketing companies. And the second and the most important fear on the street is the fact that because of lower crude oil prices, there could be a potential cut that the government might do or might ask the oil marketing companies to do when it comes to retail fuels like petrol and diesel. Now, a few days back, the oil minister clearly said that if current trend in international crude prices continue, then there could be a cut in fuel prices going forward. Now, last fuel prices were cut back in March 2024 by around 2 rupees per litre on petrol and diesel, and if another cut is imposed, then there could be a cap on the marketing margins that the oil marketing companies earn, and hence that was the major reason why we had seen a fall in the share prices of oil marketing companies like HPCL, BPCL and IOCL.
Right. Prashant, what would you have to say to this? Because, as we were talking with Somit as well, we were discussing about how positive this would be in terms of oil below the $70 per barrel mark, but clearly the reaction is absolutely different, taking into consideration the other concerns. What would your call be on OMCs, and what would you advise investors to do?
I think Sumit has highlighted the point very well with respect to the inventory losses, which will be the major reason for the stocks to come down today. But I think going forward, again, if the oil prices come down drastically for another $2 to $5, that will have a lot of inventory losses booked for the companies for this first quarter of this financial year. That will be adding a lot of pressure, despite having some kind of advantage because of the fall in the price. But indirectly, a fall in the crude price will have effect to the economy in a very medium to longer term perspective, which will help Indian inflation to be under control, and that will help government to not to cut or anything in terms of interest rate. But overall, I think government is going to have some kind of pressure in the on the oil marketing companies to cut 2 to 3 rupees kind of petrol or diesel very soon in the coming few months. So that would be one reason why the investors are looking at some kind of risk and then selling the stock right now. So overall, if you see, HPCL is the only best stock right now because of this advantage of the fall in the crude price and benefiting more on the EBITDA margin. So I think if anybody want to have some kind of exposure, HPCL should be the one stock one should focus on.
Got the view, Prashant. But the other one stock that's tanking in trade today is Bharat Forge. Now, if you can just pull up Bharat Forge as well as the 3 to 6 month chart as well, it's been under pressure constantly, basis on the demand as well. And there are two key factors here today that's affecting the stock. One is a brokerage note from Morgan Stanley. They've downgraded the stock to an equal weight from an overweight rating earlier. Target price has now been cut to 1170 rupees per share. And it was around 1366 rupees per share earlier. Now, there are three key points that I'm making in this particular report. The first one is that the challenges in the US market is, offsetting some of the gains that Bharat Forge had made in the defense segment. They got a roughly about 6,900 crore order for the ATAC systems from the government of India, and that has gotten a cabinet approval now. But despite that, the company is, while it's scaling its non-auto business very well, the challenges in the US market and the 25 to 27% tariff specifically for the Class 8 trucks that they supply there is having an impact on the stock. And Morgan Stanley's view that valuations are 37 times price to earnings for FY26 is appearing full and pricing in some of those positives of the defense segment that they're making. The other key aspect that they're saying is they're lowering the EPS by 15% for FY26 and roughly 11% for FY27 as well. The other second key update is on the Class 8 truck market. Now, we do get the preliminary numbers for the month of March in the first week of the next month. So April, we've seen that number come in. It's totaling coming up for 15,700 units, and that's down 14% from the previous month and almost 22%. On a year-on-year basis as well, and that's significantly lower. The 7-year average of March is around 24,000 odd units here. So definitely it's a key negative there.
But on Class 8 truck orders, usually you see the Bharat Forge as well as the Ramakrishna Forgings that reacts. If you pull up a Ramakrishna Forgings on the screen, you're not seeing that deeper reaction as what a Bharat Forge is seeing. Now, is it that the market share that a Bharat Forge has versus a Ramakrishna Forgings is way higher versus a RK Forging? So what's the reason? Because, it's at the day's low, but the cuts are only 1.5% on RK Forgings. Bharat Forge is going to be key. In fact, viewers, you should be watching out for a bull and bear on a Bharat Forge that Puneet will be doing in India market close today as well, because that will tell you the positives and the negatives. But, both these stocks should be on our radar. Let's also hear out, staying with the auto pack, let's also hear out what Rakesh Sharma has to say with regards to the sales numbers that have come in for the company. That stock is also trading under pressure as we speak.
Over the last 5-6 months, and if you see, in fact, the entire year, we've sort of come out flattish when you look at volumetric growth. Our approach has constantly been in the market to optimize the top line, bottom line, and our competitive position. So therefore, you will see that this year we have achieved a milestone of 50,000 crores at an overall level. And at least in the first 3 quarters, as you know, our EBITDA margins were 20% plus. The final quarter, the financial results are still in the making and will be declared very soon. So that sort of indicates to you that it's not a one-sided approach which Bajaj Auto takes. We have to constantly look at optimizing the bottom line and the top line, as I said. And there have been periods of high demand, but there have been categories where it's been like, almost a red ocean kind of a situation over there, and we have not participated. So yes, in terms of being flattish, it's absolutely correct. In the domestic motorcycles, we have been a little bit flattish, but that's the outcome of balancing the top line and the bottom line.
Well, that was the management of Bajaj Auto as well, and we did do a very deep dive KYC on it, so do check it out on YouTube as well as our other mediums as well. But Prashant, let me come across to you on Bharat Forge first. We've seen US tariff impact. US is roughly around 30% of their standalone revenue. Do you see this as a buying opportunity, or do you see more pressure on it? And any views on Bajaj Auto as well? Domestic sales has been slowing in. The valuation differential with TVS is now getting larger and larger. So how are you seeing both these auto stocks?
Bharat Forge, obviously, we all know the stocks have a lot of dependency on the US market. But again, with respect to order book, there is some kind of uncomfortable visibility with respect to the new order book, which they are going to get for next 1 month to 3 months. So because of that reason, I think the stock will continue to be under the pressure. And even on the valuation side, a 34 forward P is still not so comfortable as of now because of a very gloomy or blur visibility with respect to new orders as well as from the US. So that will keep the stock under pressure. The stock may head towards 900, 930 on a technical basis, but I think the investor should wait and watch before taking a long-term bet on this stock. With respect to Bajaj Auto, obviously, yes, with high competition from the EV segment, two-wheeler, and a lot of new entrants with respect to the EV segment, which is keeping a lot of volume pressure for Bajaj Auto as well. But two-wheeler segment will see some kind of very positive momentum from this month as well. I think the consumption story, the tax-free of 12 lakhs from the budget. So I think that will lot of consumption will flow through two-wheelers, because I think four-wheelers and the petrol prices will not be so affordable for a four-wheeler car. So I think two-wheeler segment will see some kind of volume growth from this month as well, April, May, June. So I think Bajaj Auto as well as TVS, obviously, yes, the valuation comfort level is more towards TVS for me right now, but Bajaj Auto, because of its pan-India strong presence and the EV part, which is into the business, which is growing very fast. 6 months back, I think Bajaj Auto was not on top 5, but I think now Bajaj Auto EV segment sales are number one right now. So I think that will also drive a lot of volume. So overall, very positive for medium to long term.
Medium to long term, a positive call coming in with regards to where Bajaj Auto goes. But let me revisit the pharma pack. You have CLSA, which has come out with a note on pharma. What's interesting that they're saying is that the risk to Indian pharma is very low because the custom duty that is charged on US pharma imports into India is in that range of around 5 to 10%. So if there is a possibility of a reciprocal tariff that should be coming in, it should be up to 10% for the Indian pharma companies. Now, India receives less than $50 million from customs duty on US imports, and there is a likelihood that India could go ahead and remove the custom duty on US pharma imports, to which the US may reciprocate. Overall, 46% of generic savings to the US healthcare system comes in from Indian companies. And even if a tariff is imposed, they believe the Indian companies will pass it on due to their dominant share. So generic products have very low margins. Thus, if they are unable to increase prices, they may stop manufacturing some of these, which may lead to drug shortage in the US, and that will increase prices as well. So all in all, a positive to that extent for India versus the quantum of negativity it will lead to in the US markets as well. In fact, let's quickly slip into a short break. We have lots more lined up on the other side. In fact, we will have a chat in terms of what's happening in the metal sector. Experts will also be joining in. Please stay tuned to NDTV Profit.
Whenever a film sank in 2000s, it was always flop actor. मेरी तरफ नहीं देख रहा, देखो तो सही. I compare an actor's career like the stock market. Sometimes your stocks are low, right? And when your stocks are low, no one's buying. Sometimes your movies do well and your stocks are on the rise, and everyone's suddenly buying that stock.
What point do you think that the film career perhaps is not going the way that you thought?
Itch of wanting to be an entrepreneur started itching a little more, and I wanted to scratch it.
One of the most important lessons is to know when to pivot.
The burn was far more than the earn. We were burning and I was watching my money just go out and like, oh my God, what's going on here?
He sold most of his stock, 80%, as on that date.
We have requested the management to come and speak to us. They asked us, what questions will you ask? We've sent it to them. They don't want to answer it, so then let's put it to our viewers as well.
7 key questions, right? How is it that 2,000 crore goes unnoticed by all of these auditors?
Is seeking more information on the trades and the all the transaction which has happened from the exchanges, both NSE and BSE.
The Reserve Bank of India's supervisory officers, they are seeking compliance reports on their foreign currency borrowings by these banks.
The DSS is actively engaging with the Reserve Bank of India to sort of ensure the thorough examination of the matter. And
IndusInd Bank, as part of its internal review, had found that certain aspects of its derivatives portfolio was not meeting the standard that was set by the Reserve Bank of India.
you really know the company you invest in?
Welcome back to NDTV Profit. Now, after the IT companies, it's the metal stocks that are feeling the heat of Trump's tariffs. The index has actually fallen over 4% in intraday trade. Mika joins us to tell us how the tariffs will impact the Indian metal companies' pricing, earnings, and valuations. Mika, over to you.
Thank you for that, Hiral. So yes, the Nifty Metal is one of the top losing indices in trade today. It's fallen over 5.5% on an intraday basis. So most of the stocks have lost almost 8% in trade today. Now, it's key to know that metal is one of a large contributor to the Nifty's FY26 EPS. And now the sector is vulnerable with new capacities coming in amid chances of lower prices. Now, in terms of the direct impact of US tariffs on metals, there is no direct impact of the 26% tariffs on steel and aluminium, and this is mainly because of our low exports to the US. In terms of the indirect impact of US tariffs on metals, there's a high possibility of severe US recession, and the risk around the US slowdown can impact commodity prices significantly. Now, in terms of aluminium stocks, some of the top losers on the on the index is Nalco, Vedanta, and Hindalco, and this is because of the potential drop in aluminium prices. Now, in scenario 1, as per MK, in a chance of a US or global slowdown, the prices of aluminium could fall down to $2,300 per ton. In a scenario of a recession, it could fall down to $1,900 per ton. And it's key to note, prices are currently trading around the $2,420 mark, which is negative for the aluminium companies. Lastly, in terms of the EBITDA sensitivity, if prices fall to the $2,300 per ton mark, as per MK, Hindalco has a EBITDA sensitivity of 20%, Vedanta at 25%, and Nalco at 28%.
Thank you, Mika, for getting us the details. But stay with us. We have Aditya Velekar, Senior Research Analyst, Metals at Axis Securities, also joining in. Aditya, good afternoon and welcome to the show. From what Mika was talking to us about the indirect impact that the metal sector could see in terms of the tariffs, what is your read and what's the major impact that you're seeing?
Yeah, good afternoon. So yes, that's correct. There is a large risk of sentiment in the market post these reciprocal tariffs. So what essentially is happening is post the announcement of tariffs by Donald Trump in February 12, there was a window of arbitrage which has opened up because in US that they will go for a blanket tariff of 25% on steel and aluminium. So that arbitrage was open post this announcement, and that now has closed. So there was initially, just after the announcement, there was a rush from exporters to ship the metal from ex-US market to US. And because of that, the Midwest premium in US was high. Now that arbitrage is now kind of closing down. So there is no momentum or incentive for producers or exporters to ship the metal to US. And also because of these reciprocal tariffs, the overall question mark on the midterm demand visibility for the base metals and to a certain extent even steel is arising. And the kind of demand indicators from US, they are also they are not generating any confidence. So recently, if you see the February manufacturing PMI has fell by 2.5 points to 50.2, and March consumer index in US has also declined by 7.2 points to 92.9. So this indicates that the demand in US could take a hit, and if that happens, if the overall US dollar weakness and Fed trajectory will be also under question. So apart from that, because of these reciprocal tariffs, the Southeast Asian countries which were the major exporting nations for aluminium and other base metals, that that metal will also have to redirect it to some other locations. So all these things are supply chain disruptive, and the kind of overall risk of sentiment has led to the reaction in the metal stocks which we are seeing today.
Aditya, Amika joining this side. So, do you expect, base metals as well as steel prices globally to, be on the downside for the short term? And if yes, what is the kind of correction we could see in commodity metal prices?
I can't quantify the exact quantum of correction, but yes, we can see definitely a downside from the current levels, especially for the base metals, means the kind of rally which we have seen for aluminium, copper, zinc. So already the prices were at a high level, and in last couple of days the prices have corrected, and they may correct further. Ultimately, everything boils down to the demand dynamics, and if all these reciprocal tariffs leads to demand destruction, then yes, that kind of scenario can be developed where the aluminium prices and all other base metal prices can go further down, maybe up to a level of, for aluminium, for example, it can go down to 2,200 or below that. But that is slightly speculative at this point of time. So we have to wait and watch. Near term, the noise is there, and overall how the picture emerges in the medium term, that trigger we have to see whether there are any further negotiations or how the entire supply chain reacts to this. How especially China fits into this equation, and how China will ship its metal, what kind of actions it takes with regard to its domestic consumption, and all those things we will have to wait and watch. So as of now, speculative, but yes, downside risk for the entire metal complex persists.
Got it. Aditya, last two questions. One, so you've seen a steep correction in metal counters today. Do you think this is an opportunity to buy? And if you had to, what would you prefer, ferrous or non-ferrous space?
Yeah, I mean, it's slightly premature as of today to invoke a buy call, but valuations are not very lucrative at this level also. Maybe at a mid-cycle level. So if the stocks correct further, we can think of taking a position. But overall, it's better to be at a risk-off side rather than taking aggressive positions and going long, because as I just described, the medium-term scenario, we have to wait and watch whether the demand destruction happens. And as compared, if we have to take a preference, then yes, steel is looks better placed in this scenario. There are a couple of reasons. Number one is coking coal prices have corrected and are in the range of $170 to $177 per ton, which is good, and the spot spreads are bottoming out. And also steel is slightly localized commodity. It's not largely, it depends upon the localized regional trade dynamics. So as compared to aluminium and other base metals which have rallied and are in a correction phase, the steel prices, if you have seen, steel mills have taken steel price hikes to the tune of 2,000 rupees per ton recently. So the safeguard duty of 12%, which have been announced by the government, that also protects to some extent the impact of dumping from other countries on the domestic steel mills. But the risk persists, especially from China and other Southeast Asian nations for steel also. So if you take a comparison as compared to base metals, steel looks slightly okay. But we are not in a hurry to generate a buy call at this point of time.
Right. So that's with regards to no buy calls. So Aditya, are you saying that no buy calls in terms of the metal sector at the moment, no top picks?
We have top picks, but what I'm saying is that we will not initiate a fresh long position at this point of time.
Got it.
So whoever are long, they can stay long. Otherwise, no.
Absolutely. No fresh position should be taken in terms of the metal sector as a whole. Thank you so much for joining us on the show and sharing the views. So clear answer coming in over here is no metal stocks to be taken in terms of fresh positions. In fact, let me also get in Gaurav Sharma, Associate VP and Head of Research, coming in from Globe Capital. Gaurav, my question to you is with regards to the metal pack. From a fundamental metal analyst perspective, no fresh positions to be taken. What are charts indicating?
Charts are clearly saying that in the immediate near term, some more profit taking is there, and it is possible. So if we specifically look at some of the larger names within the metal space like Tata Steel, JSW Steel for that matter, so another 5 to 7, 8 odd % downside is pretty much possible.
But a series of banking and NBFCs have come up with their quarterly business updates. Let's bring in my colleague Harsh to give us a detailed breakdown of the same. Harsh.
Let me start off first with an HDFC Bank. You know, in the sense, in terms of growth, it's a decent kind of growth number, 4% on a QOQ basis, given the size and given the constraints at this point. But deposit growth, slight disappointment in that sense, 6% QOQ, but you'd want something higher with regard to the deposit growth number. At least the street was anticipating something better. Overall, it's a solid number with regard to growth, as well as both loan growth as well as deposit growth. Let's talk about Bajaj Finance. That's the other one. 4.7% QOQ, 26% YOY, largely in line with the guidance it's given of 26 to 28% on the AUM growth front. So on that count, it's met its guidance and it's done fairly well. Mind you, it's a slightly softer quarter overall for Bajaj Finance, but it's also a seasonally weaker quarter for Bajaj Finance. So that to be kept in perspective. And L&T Finance, again, a 3% QOQ growth, decent-ish in that sense, but slightly on the lower side. Collection efficiency continues to improve, and that's the one big positive that I take away from this one. Bandhan Bank, good growth on both sides, nearly 5% on loans, nearly 7+% on deposits. CASA also up 6%, and all of these numbers QOQ, and that's why it's strong. But when you look at the year-on-year numbers, slightly softer in that sense, 11% on loans, 12% on deposits. The case in point being, is this kind of QOQ growth sustainable, or is this just a single quarter and year-end kind of phenomenon? Last off is an RBL Bank, 2.5% on a sequential basis where advances is concerned, around 4% in terms of deposits. Growth is slightly on the weaker side, given that it should be a seasonally strong quarter. Yes Bank, even more tepid, 1% QOQ on the advances front, and deposits up 2.6%. Last one I want to cover is a UCO Bank. Very strong numbers, impressive show, 5% plus both on advances, deposits up nearly 5%, 4.64% on a sequential basis. So very, very strong numbers posted by a UCO Bank as well.
Well, thanks for that, Harsh. Prashant, let me come across to you. Any of the banking updates that have come through, what's your view on the PSB banks, as well as, anything on Bajaj Finance, Yes Bank? What's your pick here?
I think PSU banks and the sector will perform well. The way how Q4 business updates have been shown now, I think we can see a lot of credit growth or even deposit growth going forward. One reason which I am very much bullish on PSU banks would be because of the consumption story, which will drive a lot of credit growth going forward for a smaller PSU as well as larger PSU. But HDFC Bank or ICICI Bank will also be performing very well, because in this market, housing sector will see a lot of growth going forward in next 1 or 2 years. With respect to valuations, again, I think HDFC Bank is still trading better than Kotak Mahindra at this point of time. So I think that can be one kind of trade-off for any traders who would like to have HDFC Bank now at this point of time. So overall, banking sector, even NDFC, I think NDFC will see a lot of growth going forward with respect to AUM growth as well as their credit quality growth. So all in all this stock, PSU, private as well as NBFCs will see a lot of good growth, good decent growth from next quarters.
Got the view, Prashant. But time for the big brokerage call of the day. HSBC has released a note on Ventive Hospitality and are positive on the stock as a whole. Varsha joins us with more details on the same. Varsha.
Right. So, in fact, with Ventive Hospitality, what's interesting is, what the point Varsha was making is that within the healthcare space, does hospitals and pathologies become a better bet as compared to the pharma pack? And that's been an interesting aspect that we should be looking at. In fact, HSBC has gone ahead and initiated coverage with a buy rating on this counter. They have a target price of 854. The stock is currently trading at levels of around 700. There is, pressure that's built in today as well. What the brokerage is indicating is that the company has been catching up quickly with regards to where peers go. They have 4 annuity assets in Pune. There was an underperformance from this company, which was a concern. However, it seems that the company has been catching up with regards to its performance. The balance sheet is absolutely strong, and the cash flow is something which is a positive with the company as well. Now, the lack of growth as well as the underperformance are the two downside risks that one should be watching out for with regards to where Ventive Hospitality goes. In fact, let me come to you with regards to Ventive. Gaurav, what are charts indicating? Gaurav,
the data is less. I guess it is a new listing and we haven't tracked it off late also. So I won't be able to comment on that.
Okay. Prashant, any quick view with regards to Ventive Hospitality as well as, how are you looking at it?
I think with respect to valuation, still not comfortable to have a very bullish view on the stock. Overall, the hospitality sector will be very much positive for us on a long-term basis. But when Ventive Hospitality is a very recently listed IPO, so we need to wait and watch for Q4 earnings as well as Q1 earnings to have some kind of comfort level with respect to their growth margins as well as their outlook. But if you want to look at in a hospitality space, I think Lemon Tree can be a better space one can look at to have a long-term growth.
Lemon Tree is Prashant's pick, but another sector that's been in focus, but on the downside, that's the IT sector as a whole. Now, we've got a note from JP Morgan today speaking and actually putting out some of the key thoughts that they mention, specifically that they're seeing a complete washout and chances of that in FY26 are rising further. Now, they've said that while the top tier IT companies, TCS, Infosys and CL Tech pay out most of their free cash flow as to PAT ratio, which that equity ratio to its shareholders, they are mentioning that the dividend yield suggests that the bottom multiples are more closer and 6 to 14% away from those bottom prices as well. So while they are mentioning that the index as a whole has seen correction in the top tier large cap IT names are still a little away from the bottom, but still you can see the bottom now going into that aspect as well. They're mentioning that leading mid caps like Persistent as well as Coforge are still 25 to 13% respectively away from bottoming out. So might see some pressure on these stocks continuing. And Persistent, it was down almost 9 to 10% yesterday, another 5% fall in trade today as well. The other key aspect is that they're mentioning that they would still prefer to be lighter in positioning of the IT sector in their portfolio. And it's interesting because they had a note again in the last week on Wednesday as well on this, and they went on to mention about in that aspect that they had cut target prices of 10 IT stocks in that report. And had downgraded HCL Tech, a stock that's actually seen a lot of positive street coverage on that aspect as well. But Gaurav, let me come to you first on the charts for IT. Any of the stocks in the large cap or the mid cap space that you like currently?
Currently, they have deteriorated too very much. It's a completely downtrend that they are indicating, and the charts when we look at whether it is the large cap space or the mid cap, many of the stocks you have already quoted here, the likes of Coforge, Persistent, Infosys, maybe it be Infosys, TCS for that matter, all of them are indicating some more profit taking from the current levels. They can be in the range of 8 to 10% as well from these levels.
Right, so that's with regards to where IT as a sector goes as well. But let's move on to IndusInd Bank. That has been in the news over the last couple of trading sessions as well. And now we have a UBS which has gone ahead and maintained a sell call on the counter. If you talk about a UBS overall as well, clearly in terms of the performance, the stock, if you pull up a long-term chart, 3.5% is the kind of downtick that you're seeing. We have a sell rating. The target price has been cut as well. In fact, Harsh is with us to tell us more. Harsh, over to you.
Well, UBS has really cut the target price of IndusInd Bank. They've cut the target price from 770 rupees to 600 rupees. In that sense, there's actually a downside now to UBS's estimate. And what they are saying is there's just very weak visibility that IndusInd is showing at this point. It's going to be a challenging year. There are going to be rate cuts as well. So macro doesn't look too good. Plus, IndusInd has its own set of challenges. And therefore, there are multiple overhangs which is going to drive a de-rating on the stock is what they feel. In terms of what are they looking at, the key monitorables. One is deposit flow, whether there's a change there, the new CEO and the external auditor report. These are the three key signposts that they talk about. They've cut earnings estimates by 14 to 15% for FY26 and FY27. And they believe that margins will be under pressure and credit costs too will continue to pressure the numbers for IndusInd Bank. So keep your eye out on this one. Of course, UBS not so positive, but has some monitorables to look for. So read into some of those signposts as well.
Thank you for that, Harsh. Interesting one on that one. Prashant, how are you looking at IndusInd Bank?
I think yes, near term there will be a lot of triggers for the stock. One would be the internal report, which will be coming out very soon in this week or next week. That will give us a lot of actual value of loss which they have derived from the derivative portfolio, which was assumed to be around 1,500 crores to 2,000 crores. So anything in this case, in this around this value, that will be very positive for the stock. But again, deposit growth will also be one major concern. One should wait and watch again for the month on month as well as on quarter. So that will also help the investors to understand what actually the confidence is with the customers, with the bank. So I think downside is limited. I'm not going to have a very big negative outlook on IndusInd Bank. Overall, the bank is very strong in terms of their assets and all. So, but this was the one of its historically good presence. If this gets away and the report comes with a very decent numbers in the range which we discussed right now, so then I think with a limited risk of almost 600 from the downside, I think a conservative investor for a long term can think of buying more on the dips.
Right, so that's with regards to IndusInd Bank. Gaurav, what are charts indicating? Would you advise a person who's holding an IndusInd Bank to hold on, sell, or accumulate?
See, for a long-term perspective, my friend has already suggested to hold on to it. But from a trading perspective, a short-term trading perspective, this is nowhere something that I would even consider at this point of time. We have reported in our previous shows as well. To the likes of Kotak's, I would prefer to switch to the likes of HDFC Bank, which have reporting good numbers. Good asset quality, good growth. So I would prefer to and recommend clients to switch over to these stocks rather than sticking it with IndusInd Bank at the moment.
Right, so that's with regards to IndusInd Bank and the HDFC, which is seeing gains of nearly a little over 1% as we speak. But thank you, Prashant and Gaurav, so much for joining us on the show. We're running slightly out of time. So these are a few stocks that we should be watching out for as well in terms of the commentary that has come in. But Puneet, clearly, from the quick commerce space and from the consumption space, if you have to look at Adani Wilmar, Avenue Supermarts, both of these counters have been in focus in today's day of trade. Avenue Supermarts has been absolutely mixed because initially our read was that it will be a positive on the back of the store counts that it saw, but the double-digit growth is not something that has enthused the street. The stock is seeing cuts of nearly 3%. And simultaneously, if you talk about the other one, which is Adani Wilmar, a 10% volume growth is what Adani Wilmar has seen. If you pull up that one on the screens, 2.5% is the kind of cuts. And lastly, our SH Kelkar, 15% is what they are indicating in terms of the top line growth. They're expecting margin recovery to come in terms of FY26. That stock is also trading under pressure. And apart from these three names, one more stock which is in focus is a Mazagon Dock on the back of the OFS. What's interesting over here is around 4% is the kind of the amount in terms of the OFS, and that translates to little over 4,000 odd crores for the government of India. What they will garner out of this. So overall, that's one question. That's one stock that we should be focusing on as well in terms of Mazagon Dock, because one of the things is from 80% they have to come down to 75%. So another 4 to 5% of an offloading of the government is something that could be happening as well.
Well, definitely, and this we have Shrimi also joining in now because it's key because India is expected to be strategic and focus is kind of concluding on that aspect as well. If I can just check if my colleague Shrimi has joined in, and let's just cut across to her for a key story there. Shrimi, over to you.
Yeah, so what we are picking up from our sources that the Indian authority is not planning any knee-jerk reaction to this reciprocal duties, imposed by US. And they are emphasizing that the primary focus would remain on finalizing the bilateral trade agreement, which is already in works. So the agreement is, of course, expected to be concluded as early as August. Is that the pitch Indian authorities are making, Commerce Ministry is making? And if this happens, this is going to be a significant milestone as this is the first bilateral deal to be finalized within just 6 months. So if you remember, India already in talks with UK and EU to have a trade deals which have been hanging for over 2 years despite several rounds of negotiation. So if this happens, it will be concluded in 6 months, and that will mark as a first bilateral deal to finalize in 6 months. But the catch here is that BTA, once effective, could supersede existing tariff imposed by US administration at this point. So what officials are telling us that trade deal would have new effective tariff rates under specific clauses designed to address all the key trade issues across the sector, is what official explaining us. So this strategic move, which India and US are in talk with, and the offline discussion are already starting from this month itself, reflecting that how India is going to have a more balanced and forward-looking approach with its economic ties with the US. Now, in addition, they're also looking at, non-tariff barriers and the non-tariff issues as well. And in fact, sources tells us that they're going to set up a dedicated portal to, address all those procedurals and compliances issue which currently exporters are facing. And they will have a portal to facilitate real-time updates on the trade-related developments.
Got that view, Shrimi. Thanks for joining in. So definitely the big header there that currently India is not planning a knee-jerk reaction to the US reciprocal duties, and a bilateral trade agreement could be something that could be looking to end and come into by August as well. But that's all the time we have on this edition of Profit Buzzers. Stay tuned to NDTV Profit for more.
Whenever a film sank in 2000s, it was always flop actor. मेरी तरफ नहीं देख रहे देखो तो सही. I compare an actor's career like the stock market. Sometimes your stocks are low, right? And when your stocks are low, no one's buying. Sometimes your movies do well and your stocks are on the rise, and everyone's suddenly buying that stock.
What point do you think that the film career perhaps is not going the way that you thought?
Itch of wanting to be an entrepreneur started itching a little more, and I wanted to scratch it.
One of the most important lessons is to know when to pivot.
The burn was far more than the earn. We were burning and I was watching my money just go out and like, oh my God, what's going on here?
He sold most of his stock, 80%, as on that date.
We have requested the management to come and speak to us. They asked us, what questions will you ask? We've sent it to them. They don't want to answer it, so then let's put it to our viewers as well.
7 key questions, right? How is it that 2,000 crore goes unnoticed by all of these auditors?
Is seeking more information on the trades and the all the transaction which has happened from the exchanges, both NSE and BSE.
The Reserve Bank of India's supervisory officers, they are seeking compliance reports on their foreign currency borrowings by these banks.
The DSS is actively engaging with the Reserve Bank of India to sort of ensure the thorough examination of the matter. And
IndusInd Bank, as part of its internal review, had found that certain aspects of its derivatives portfolio was not meeting the standard that was
Well, the world in all likelihood will not be the same again. You could argue that the world at Pidilite may not be the same again as well. And we'll talk about both of these with the man, one of the captains of India and truly, and somebody who's built iconic brands, has done crisis management at another level in all the roles that he's been at. And Mr. Bharat Puri is with us. In fact, I am at his office to try and understand from him as he leaves a rich legacy behind about how does he think about the world and how does he think about the Indian consumption business. Mr. Puri, so good talking to you.
Wonderful being with you, Neeraj.
And at the outset, of course, congratulations on a fabulous innings at Pidilite.
Thank you so much. You know, the real credit, frankly, is that of the team. People like us get a lot more credit than we deserve. If you have the right team in place, your job is with the orchestra conductor just to see that they play in tune. But really, the credit goes to, hundreds and actually thousands of Pidiliteans who get up every morning and say, Dam laga ke haisha, and then they are at it. So frankly, I think it's the team's success more than mine.
Yeah, and every good leader says that. So I didn't expect anything less from you either. But before we get to your innings, Pidilite, and the way ahead maybe, because it's a very interesting world that we live in. We're talking right after the US and Donald Trump have decided to do something which a lot of people would have thought unthinkable, right? And from a completely globalized world, we seem to be moving more and more towards each to their own. How do you think of all that's happening in the last, let's say, 24 months or 36 months post-COVID and the de-globalization, if you will, and which has been put into a rapid pace with what Donald Trump has done?
It's absolutely the right question, because what you've suddenly seen is, till about maybe Russia, or maybe till before COVID, you always took globalization, geopolitics for granted. It was never a factor in your plans. Today, every CEO has to keep looking at geopolitics. The thing is the utter unpredictability of it. So, if you ask me what's going to be the impact of Trump's tariffs, firstly, you don't know what are going to be the real tariffs, how much time will they settle down in, what will happen, how will people... Now, this is, we are now in this world where in the good old days, we would be told, look before you leap. Now it is look while you leap, because everything is changing as you are leaping. So I think, it's interesting in one way, but also challenging.
It is certainly challenging, but what do you make of all that's happening? I mean, because in some sense, and as a captain, I would want to understand from you, as somebody who runs such large business or has done it all through his life, the people in the market or people who look at markets and economics think of this in two ways. There is a worldview that everybody is getting impacted and therefore there is no one clear loser because everybody's been slapped with tariffs per se. And there are others who say that, well, this will have ramifications. People compare it to the 1930 impact that had in the US and how it, people sleepwalked into a global recession then, and we might be doing the same thing right now as well. Maybe it's too far out, but just trying to think about as a business leader, how do you think of this?
See, as a business leader, you have to be prepared. Fortunately for us, the good thing is, I do believe India in a large way is insulated, at least in industries like ours, companies like mine. We don't have a direct impact. I mean, we have very little export or import to the US outside our pigments business. It's not substantial. That doesn't mean we will not be impacted, because obviously these are ripples that are going to be felt right across. But I think, in today's day and age, you can't commit big. You have to play every ball on its merit. And what you have to do is focus on what's within your control, because otherwise you will keep doing various scenarios, and there are far many greater economists and astrologers than I am who will predict this. I think the key is keep looking at what's right for your organization, for your country, and do it one step at a time. Don't commit big. Don't do things that you're going to regret later.
Do you fear a synchronized global slowdown, Mr. Puri?
See, I think now, I was just reading a report where they say now from 20% the chance of a, minor or major, I don't know how it's defined, global slowdown stroke recession is like, my simple answer is I don't know. I hope definitely not. I don't think the world needs it at this point of time. But it's clear as a watcher, and by no means am I an expert, there is a global reset taking place as we speak. People spoke much earlier about the onset of Asia. it was Europe and then it's the US and now it's Asia and there's a reset. You're seeing that in motion, and maybe historians many years later will come back and say these were inflection points. But I think we're in the midst of fairly, what I would say is transformational change rather than incremental change.
Okay. And therefore difficult to kind of predict the extent of the impact?
Very difficult. Very difficult, because who's going to get impacted where, how, and where's the extent of impact? I think it will, by the time there's, mist clears, in my view, it will be 4 to 6 months. It won't even be weeks.
Okay. The other thing is, a lot of people also are of the opinion that India was never a large exporting economy. You spoke about Pidilite that way, but for India as well, it's never been a very large exporting economy, and therefore a hit to global trade will impact India relatively lesser than some of the export-driven economies. Fair assessment, or is it too simplistic?
I think it's a fair assessment. It will have an impact, but yes, we're a consumption-based economy, and therefore a lot of that is domestic consumption. While we are not insulated from the rest of the world, I think we're probably a little more resistant than a lot of other nations.
Okay, well, and therefore we may not have to fix it.
I think we'll have to fix it, but maybe it's, the leakages will be small.
Okay. Maybe some waterproofing will do it. Fair call. A word on consumption within India as well. There is a pivot of sorts that us commentators thought of when we saw the budget this time around, maybe much needed as well. And the early signals from corporates who've given their quarterly updates for Q4 are not necessarily very enthusing about the consumption revival as well. Maybe it happens from April, who knows. I would love to understand your view, sir. Do you reckon that the Indian consumer is ailing, or was it a temporary dip or a blip which might get corrected as the time comes, or has already been corrected, not just for your business, but maybe for the businesses within your landscape and for India Inc. at large?
See, our belief is it was or is temporary, definitely in nature. I don't think anybody can take away from the medium term optimism of the India growth story and the India consumption story. I think you will have some bumps along the route. But when we look at it, my belief is on a broader consumption. Fortunately, it's also the advantage of being in what I call a little more advantaged sector. We've had a fair amount of tailwinds, and we as an organization have also worked on our portfolio to, in a sense, make it more growth oriented. But having said all of that, I think the measures taken in the budget, putting more money in the hands of the consumer, a better monsoon, I think possibly by the second quarter or the end of the second quarter, I think this year, in this financial year, the second half should really be a much, much better second half.
And this is despite what Donald Trump has done. Yeah,
I think so, yes. There may be some specific sectors that get impacted. But I think from an India consumption point of view and money in the hands of the Indian consumer, and I think, India has done a commendable job of managing inflation, because frankly, the biggest tax that, an emerging economy, especially the lower middle classes pay is inflation. I think that's being managed fairly well.
Okay. I was talking to a very large money manager yesterday who said that, Neeraj, you guys worry too much about growth, because we've trended circa 6% for a really long time. When it goes to 5%, people suddenly feel that, it's doomsday. Goes to 7%, the optimism rises around 8-9% and stuff like that. But it's always been around this, so it will continue to chug along, and some policy measures sometime hopefully will do this. Do you think, in your long tenure, right, in the consumer business, and maybe you've catered in your previous, even in the previous roles, it's been mass consumption all through, right? Have you had to incessantly worry for a long period of time around growth, or you don't?
No, you don't. Frankly, I think in India, you have to be ready for growth. It will come. It will, by definition, emerging economies will never form the steady, straight pattern of a developed economy. You will have bumps along the way. You will have these little peaks and troughs. But when you average it out, you look at the Indian elephant trudges on. In bad years, we are at 5%. In good years, we are at 8%. But we don't, we remain in that range. And I see no reason why that's going to change.
Okay. And would this, Mr. Puri, be a consumption-driven economy per se? Because we were a consumer-driven economy for a long time, probably still are, but services took center stage. Now there is an attempt, a serious attempt, to make manufacturing really shine. I would love to understand from you, how do you think, as you foresee the economy and maybe Pidilite's role within it, but for now, let's think the economy for the next 5, 7, 10 years, or maybe the better part of this decade. How do you see the economy chugging along? What contributes the most? How do you see the policy framework contributing to each of these facets?
See, if you look at the targets itself that the government has taken for itself via the Viksit Bharat program, we have to step up growth, right? We have to continue growing, and to reach those targets, we need to step it up. Frankly, I think one of the lowest hanging fruit is manufacturing. There is no reason why India, and I don't say China +1, etc. I just say India has the right to be a strong manufacturing base for large parts of the world. I think as long as we have that intention and we are going along that path, clearly it is stated, but we have a long way to go. I think that has to be a driver of growth, because, with hopefully a boom in manufacturing and services which continues, things like tourism or education, come jobs. With jobs comes money, with money comes consumption.
Okay, fair call. How do you see, under your stewardship, maybe 2.5 times revenue growth over a period of 8-9 years, operating profit growth in that fashion, margins expanded meaningfully from what they were in March 2015 to where they are right now as well. Multiple product innovations, multiple brands built out, acquisitions, global presence. You've done a whole lot in those last 10 years. Share with us a little bit about that journey. Share with us what would probably be the standout moments for you in the last 10 years, if you will. And as you look ahead, or maybe start with that, then we'll think about the looking ahead part.
See, the lovely thing is Pidilite was always a very strong company, right? It had strong foundation, and therefore it was clear what Pidilite needed was evolution. It didn't need revolution. There was no burning deck that you had to jump off, otherwise the ship would sink kind of thing. It was a steadily running ship. When we took a look back, this was around 2015-16, we said, listen, what makes Pidilite unique is its model of being a pioneer. We spot unserved, underserved categories, we fill those with a brand, and then we work tirelessly with consumers and users until we create the category. That's the story of Fevicol, that's the story of Dr. Fix-It, that's the story of M-Seal. But when we were looking at our portfolio, we did this division where we said, we have 3 kinds of categories: core, growth, and pioneer. Core was, we've created the category, woodworking adhesives, a Fevicol, a Fevikwik. We sell a few million tubes of Fevikwik every single day. So these are categories we've created. However, obviously there is still a scope to grow them. So our job is category created, grow the category, and we said we must grow the core at 1 to 2 times GDP. Because we're also clear that, listen, in emerging markets, growing the core will still be your greatest driver of growth. Then you have growth categories. In growth categories, you're actually competing against non-consumption. Take something like waterproofing. India, 4 out of 10 homes are doing waterproofing. Our job as leader is to make this 4 into 5 and 6, not worry about getting share only within the 4. That's very, in a sense, inward looking. So therefore, take tile adhesives. 1 out of 4 consumers in India actually uses an adhesive when they put tiles in their home. But as tiles become bigger, now slowly from the small tiles you've come to the big tiles, tiles become vitreous and thinner. If you don't use a tile adhesive, it's going to fall. Again, it's a classic case of fighting non-consumption. So therefore, we have a whole set of growth categories, and we said these we must grow 2 to 5 times GDP. Because, the scope is there are enough people who can afford them. It's a question of creating the category by educating both the user and the consumer. And then we have pioneer categories. Pioneer categories are very simply tomorrow's growth categories. As a company that thrives on innovation, we must always have a lot of experiments going on. I have 2 of my most senior-most managers who were actually pulled out of their CEO jobs, whose job is to scout the globe and keep looking at prospective categories, which will be, the categories of the future for India. They may have already existing in a Brazil or a Thailand or a China in developed markets, and we keep working with that. When we started on this journey, Neeraj, it was 80-20. 80 was core growth in Pioneer was 20. 8-9 years later, we are now at pretty much 55-45, 52-48 to be exact, but let's say 55-45. Now that itself has given you a tremendous flywheel for growth.
Of course.
And to do this, then you have to create the organization. In the end, organization, we had simple three things. Hey, this country, the lovely thing is this company is known. Whenever you tell people you work for Pidilite, the first thing they'll say is, we love your advertising.
Yes.
The second thing we'll say is, you have such innovative products.
Yeah.
I've used X, Y, Z as a child. I was using your school glue. My shoe broke and I did this. So people all know you. The second thing was, listen, you have to be a digital company. And clearly you have to use it for competitive advantage, not because it's fashionable to do. And the third, which in my view is the most important, is create a culture which marries the best of the West and the East. I call it pronorial, where you take the professionalism of the multinationals. I've been fortunate, I've spent half my life in well-run multinationals and half my life in well-run Indian companies. If I can get the system, the capability, the rigor, the capital allocation of a multinational, but I marry it with the risk-taking ability, the entrepreneurial ability, the apolitical nature, the ability to tolerate mistakes, and marry this true and create what I call a pronorial culture, you will have something that is unbeatable. And that's the journey we've been on. Fortunately, as I said, when you have the right people in place, you have the right team. I always say a leader should be clear where he's going, but most importantly, he should be able to persuade others to go with him. Once they're ready and going, then you have to watch them go and just see that you've created enough mattresses that when they fall, they don't hurt themselves, and you've got guardrails that they don't go all over.
A lot of management lessons out here. Did you say pronorial?
Pronorial, yes.
Okay, pronorial. That's a word that was not there in my dictionary ever, so now I at least know this. But thank you for that. But I will still ask you, there would have been some favorite moments. I mean, I can recite some of the Fevicol ads that have been my favorite all through and through. So, I mean, those were my favorite moments for a Fevicol brand from outside, right? And Pidilite is not just Fevicol, of course, but just saying, most advertised, if you will. Surely there would have been some moments. It would have been a crisis management or something.
I mean, what I'm saying is moments of first recognizing that you must keep growing the core and doing things around the core. Then, for example, the wonderful thing is, in one of the analysts who does our sector came and told me, he says, listen, one of the reasons why we've done this analysis, you guys are successful, is you're one of the few companies that has not only innovated around its core and grown the core, but you're one of the few companies that's created new categories.
Yes.
I mean, the lovely thing is, of my turnover today, there is close to 2,000 crores that comes from business that did not exist 8 years ago. So, the ability to create categories. I mean, we took over Araldite. It was like, a brand that grew at an average of 5 to 8% for the last 10 years. In 3 years, we doubled the brand. So I think, many, many happy moments. And it's also been a tumult. I mean, when you look back at history, we started with demonetization, we went to GST, we went to COVID, we went to Russia, Ukraine. But, as you say, listen, that makes life interesting.
Anything? Okay, one more memory question, if you will. I'm just trying my luck here. But probably the most shocking moment for almost everybody in the last decade or maybe this century would have been the COVID shutdowns, right? And some corporates took some decisions, some took some others. Is there some story out of COVID that you maybe not have shared too much or spoken about very little or not spoken at all that you would like to share? Because we kind of, I mean, before coming here for the last 3 odd months, we've done some homework by talking to people who were a part of Pidilite during that period as well, and a lot of positive comments. I'm just trying to understand anything that stood out for you from that particular shock. Would love to take a management lesson maybe.
Absolutely. See, when COVID happened, it was obviously a shock to everybody. But in a crisis, we really said 2 things. One is, guys, this will go away. But how we behave during adversity is really the real test of our culture. Neeraj, in good times, everybody is a great person, right? It's only when, there's an old adage that honesty is best tested on an empty stomach. Similarly, culture is best tested during adversity. The lovely thing was, we said, listen, we will hold hands. If there is any impact, the senior management must feel it before junior. So we took salary cuts for 3 months, but we didn't touch any of the junior fellows' salary. We didn't let a single person go. We said, listen, we are all in this together. If there is an issue, we will keep you informed. We created a whole COVID task force. It doesn't matter where you were as a Pidilite employee. Anything you needed, this task force, I mean, somebody's relative needed oxygen cylinder, somebody's needed some kind of medicine. There was a task force 24/7 that was doing that. It was actually, finding fellows doing that. We were also one of the greatest compliments post-COVID I got was I went to one of these meets, and I remember it was in Chandigarh, and we have about 7 factories in and around Chandigarh, in Baddi and Kalam and Nalagarh. One of the employees stood up and said, sir, I want to say something. I said, bhai, bolo. He said, before COVID, I thought I had only one family. But, I got COVID, I was critical, and I was in the ICU for some 7 days. I must tell you, my team and my factory people were outside the ICU with my family all of the time. I realized at the end of it, I'm hale and hearty now, that I don't have one family, I have 2 families. If somebody tells you, it's heartwarming, then you realize that your culture is working. This is, this is a great exhibition, and the senior management doesn't have to, the people there thought this is the right thing to do. So really, many, and again going back, when we got back and we saw that, listen, COVID, now business is coming back, actually profits were because commodities had fallen. We restored increments from the start of COVID. Not most companies did it from the start of when business started coming back. We were one of the few companies that did it from the beginning. Again, just do the right thing, have your heart in the right place. That's the real test. So, things like this one stay with you.
Most certainly they do. Last couple of questions, Mr. Puri. The way ahead for Pidilite, as you step down from the day-to-day affairs or whatever, the stewardship of Pidilite, you reckon that what you've done in terms of growth, in terms of operational metrics, in terms of brands, etc., you think that pace continues, or is it difficult to call that right now?
No, I think the best is yet to come. There are far smarter, far more dynamic people than me in charge. There's no doubt about that. And as I keep saying in all my company forums, I'm switching from the front seat where I was driving the car to the back seat. I will take a 6-month nap so that everybody settles down. But after that, I'll keep whispering in their ears if they are going off course. But I think, just look at the macro indicators. 70% of the housing stock that India needs to build by 2035 is to still start being built, right? As I said, most of our sectors, therefore, are very well positioned, not just from an economic growth, but also a penetration point of view. We've got a wonderful team in place. We're now operating across 37 different verticals. So, we're a little mini conglomerate. So I think, and I keep telling the team, listen, the best is yet to come. The only danger is complacency. Don't ever believe what people are saying and writing about you. Remain hungry and keep your, ear to the ground.
I have one last question for a lot of startup entrepreneurs or a lot of people who must be starting a business, because a few people who recently started a business and been successful told me that one of the most important things that they thought was a part of their success was that they wrote down their culture statement, formed the whole culture around the organization very early. I've heard you speak about culture thrice in this conversation, and very fondly at that. I would love to understand from you, how much importance would you give to the culture that you were able to create at Pidilite? And is that something that even young companies, which might be just 3 employees old, take very seriously as they are forming large businesses?
Without any doubt, Neeraj, without any doubt in my mind, that old Drucker statement of culture eats strategy for breakfast is so true. In my view, and this is one of the first things we did, at Pidilite, we actually went back. We said, listen, culture is about 3 things. First is the values that are dear to us. And we distilled it and made it simple 4 values. Then it's the way we work, because finally culture is the way people behave. It's not what people are, what's put up in conference rooms, so on. And see what's the compass, and we call it Marg Darshak. What is the things that we will always do in Pidilite and what we don't do? And just to give you a metric, that I went personally to every single location and actually took them through all of these and said, this is the organization we're going to create. And therefore, and we actually did Bollywood scenes around each of the elements of culture. This is empathy and respect. This is act ethically. This is act like owner. And we would do this with fellows saying that this is permissible, this is not. And that, in a sense, just created an organization where there was a shared purpose and a belief that, listen, we're on to great things.
Well, I'm sure Pidilite is on to great things, but I'm guessing the whole of India Inc. will benefit tremendously if you stay within this ecosystem and keep on whispering, not just in Pidilite's ears, Mr. Puri, but in many years, and maybe some of it through us. But thank you so much for today. And thank you so much for all the rich conversations that you've had with us all through the last many years. It's been an absolute delight talking to you, sir.
Thank you so much, Neeraj. I must tell you, I've thoroughly enjoyed our interactions over the years, and they will continue. Don't worry. As I said, I will not only just whisper in your ears, I will also tell you on your channel whenever you want me to tell you something.
Sounds like a perfect plan. Thank you so much, sir.
Welcome. Thanks.
And viewers, thanks for tuning in to this conversation.
Whenever a film sank in 2000s, it was always flop actor. मेरी तरफ नहीं देख रहे देखो तो सही. I compare an actor's career like the stock market. Sometimes your stocks are low, right? And when your stocks are low, no one's buying. Sometimes your movies do well and your stocks are on the rise, and everyone's suddenly buying that stock.
What point do you think that the film career perhaps is not going the way that you thought?
Itch of wanting to be an entrepreneur started itching a little more, and I wanted to scratch it.
One of the most important lessons is to know when to pivot.
The burn was far more than the earn. We were burning and I was watching my money just go out and like, oh my God, what's going on here?
He sold most of his stock, 80%, as on that date.
We have requested the management to come and speak to us. They asked us, what questions will you ask? We've sent it to them. They don't want to answer it, so then let's put it to our viewers as well.
7 key questions, right? How is it that 2,000 crore goes unnoticed by all of these auditors?
Is seeking more information on the trades and the all the transaction which has happened from the exchanges, both NSE and BSE.
The Reserve Bank of India's supervisory officers, they are seeking compliance reports on their foreign currency borrowings by these banks.
The DSS is actively engaging with the Reserve Bank of India to sort of ensure the thorough examination of the matter. And
IndusInd Bank, as part of its internal review, had found that certain aspects of its derivatives portfolio was not meeting the standard that was set by the Reserve Bank of India.
Hello and welcome. You're watching India Market Close here on NDTV Profit. I'm Harsh Saita. With me is Neeraj Shah. We'll take you through the last hour and a half of trade. Let's quickly start off with what are we seeing in markets at this point. The Nifty 50 down 1.5%. We're very, very close to the day's low as we speak. The Nifty Bank is the only one in terms of sectoral indices, which is holding up, but it's a big one and therefore in some form or shape insulating the damage. Broader markets down over 3% each, both mid cap and small cap. Pressure across the board. Look at all of those sectors. All of them are down over 3% each at this point, and therefore market breadth is extremely weak. Let's look at all of them as we speak. Nifty 50, let's pull up the intraday chart. 1.54% odd lower. We've broken 23,000 decisively today. We're now just off the day's lows. 22,874, we're currently sitting at 22,894. So just 20 points from the day's lows as we speak. Let's look at the heat map on the Nifty 50. Again, the breadth is painful to watch, except for a Tata Consumer and select pockets otherwise, which have come out with some earnings. Couple of private sector banks there, HDFC, Axis, ICICI, and a couple of NBFCs. Outside of that, everything is a sea of red. Metals leading the pain at the start, and thereafter you will see auto, pharma, a flavor of pretty much everything, including some of the heavyweights, all present in that basket of pain. Nearly 2% plus, nearly 30 stocks sitting 2% plus lower in trade. So a lot of pain across the board. Anyway, point being, let's look at the advanced decline as well as it has moved through the day. And this one too is really painful to watch. Just look at that ratio. The mouth of the alligator is extremely wide and just getting more and more painful as the day has gone by. Lastly, I want to quickly look at sectors. And if we can have the sectoral heat map. Nifty Bank, Fin Nifty in the green, so that's a positive. Nifty Bank flat, private banks helping at this point, and PSU banks are down 2%. So despite this, private banks and the Nifty Bank holding up decently well. Look at just the bottom of this table, and you'll see there's just so much pain. Oil and gas down 4, realty down 4, Nifty Pharma down 4 plus, Nifty Metal down 6.5. Uncertainty, yes, to a certain extent in maybe a pharma, in maybe a metal. IT down 3.5 as well. But Niraj, broader markets also not looking good at all. The breadth is weak. Broader markets down 3.5%. Some real pain in some pockets there as well.
Yep, most certainly. I mean, the outliers are probably the ones which are actually doing well. So you can count them on your hands, the likes of UBL, Federal Bank, maybe a Colgate, but minor gains at the mid-cap end of the market, but the losers and a clutch of them. So it's not just ONGC, by the way, which is cracked. Oil India has had a big gash too, and result of the crude price correction that we've seen. So that bucket is doing badly. I wonder if the oil marketing companies have had a good move today, because that should also come up while upstream has come off. You know, the weakness in the markets at large is hitting the downstream companies as well. BPCL down 3%. Metals taken to the cleaners with Hind Copper, Vedanta and the likes. Nalco looking about, all of them 8%. So metal is clearly the one key loser in trade, in addition to pharma as well as IT. And lastly, just bring up the Nifty IT components. Yes, we'll have the large cap losers out there too, but the broader end of the spectrum, emphasis, persistent, etc., some very, very deep gashes there. Persistent systems, from being 5,400 3 days ago, is now probably at 4,600 or 4,500. A serious price destruction seen in these. Richard Jain, Vice President Equity of Technical Research, Johnson at Wealth Management, Motilal Oswal, Johnson on the show. Richard, difficult to maybe give a smile, just that the number of stocks and the way they are correcting. But how do you see the charts today? Is today giving a fresh signal or a change signal on the downside?
Yeah, very good afternoon, Neeraj. Definitely, I think post that yesterday's trading session where markets tried to digest in that news flows of the tariffs, but today we have seen that follow-up buying is completely missing, and the 23,000 I think was the very important support level, because since last few trading sessions the market was hovering around this support, which was the 50-day as well as the 20-day exponential moving average. And rather than the index, I think the market breadth speaks a lot. So if you look at the overall market breadth, it's completely negative. No signs of pullback move. Not even intraday pullbacks of 0.5% in many of the stocks that we have seen. So this clearly indicates that this is a fresh breakdown, and we should see no further downside in the coming days in the overall markets.
So are you initiating a fresh short, Ruchit, today?
Yes, we are recommending to go select. We have recommended short stock specific short positions. So
okay, no, just before I get to Ruchit, sorry, just before I get to those specific stocks and sectors, on the Nifty or the Nifty Bank, are you initiating any fresh shorts?
So not on the bank Nifty, Neeraj, but Nifty, once it has broken the 23,000, we have recommended to go short over there. And we expect on the downside markets to come around 22,700, 22,600 range, considering the retracement level of this recent up move from 22,000 to 23,800. So I think yes, the index should correct further from current levels. Avoiding bank Nifty because of the relative outperformance that we are seeing, we can see that clearly the selling pressure which is there in the sectors is more from IT, metals, and not from the banking and the NBFCs. So not going short in the banking, but the NBFC space.
Okay, so pointed question one, at 22,900, is Nifty a short now? And of course, couple that up with your stock ideas.
So I would say for index, creating fresh short positions, if you have existing shorts, then hold on. And if you want to create fresh shorts, then if you get minor pullback moves around 23,000, 23,050, because that should act as a resistance now. Go short, create open fresh shorts on pullback if you get it. As far as stock ideas are concerned, Naukri future, Info Edge future, we are recommending to go short. So primarily, IT is one pocket which has seen consistent selling over last few days and which is still continuing. Now this stock has given a fresh breakdown below its previous swing lows coupled with high volumes. So would recommend if one has to take a stock specific approach over here, then Info Edge, Naukri could be shorted with stop loss over 64.80, expecting target somewhere around 61.30 to 6100 range.
Okay, so those are some levels and some stocks. Ruchit, if I can venture a quick question with regard to financials, because that pack relatively doing better today, and specific names, the larger cap private sector banks and HDFC, and ICICI Access, and larger NBFCs, Bajaj Finance and Shriram Finance. Give us your view. Is that one pocket which is relatively safer in this market, and how would you position yourself therefore?
Yeah, good afternoon, Harsh. So I think banking and NBFCs, one should not look at only today's trading session, but if you look at last 2.5 months, what this entire sector has done. When the broader markets were correcting, I would say, maybe post since the later half of February month, when the markets were in the last phase of that correction towards 22,000, we had seen that the Nifty Financial Services Index had bottomed out in the month of Jan itself, and then when the markets were correcting, the financials were going higher, especially the private sector banks as well as the some of the larger NBFC names which you just said. So I think when the markets was in a corrective phase, this sector was doing well. And now we can see that when the markets have rebounded recently from the lows, the leadership was taken from the sector. So clearly, I think this is an indication from a broader perspective that the buying interest is there in the banking and the special financial space. Or we can, if we take it other way around, then there is no selling pressure in these sectors. So we believe that these private banks and selective NBFCs such as Shriram Finance, Bajaj Finance, Cholamandalam. So I think these would continue its relative outperformance in the short term. In case of any correction, I think fresh buying interest definitely would come in this private banks and the NBFC space.
Okay, and curious to know your view with regard to metals. The move today, extremely painful. What do you recommend at this point?
So recently we had seen a good pullback move from the lower levels in the metal space, but today the important supports has been breached, and primarily there's a direct correlation what we have seen in the international markets, where the metal space prices have corrected. So it has broken its important 200 DEMA support. So I think metals should see further down move from current levels. Swing lows of around 8,000, 8,100 could be tested. Even now the index is around 8,400, 8,500 range. So I think further downside should be there in the metal space, because one can clearly see that it's a combination of long unwinding which is happening in the metal space because of the a good outperformance was seen in the recent pullback move, plus fresh short formations are also there in certain stocks where corrections have been supported by rise in open interest in the future segment. So whenever we see such combination where longs are getting unwinded and even fresh short formations are there, I think that's why the corrections, the price-wise corrections are sharper. So this is one of the phase that we are witnessing there. So I think 8,000, 8,100, which was the previous lows that was seen in the month of Feb, that could be visited in the Nifty Metal Index.
All right, Ruchit, we'll leave it at that. Thank you so much for joining us and giving us that perspective this afternoon. Of course, crucial afternoon, the way in which markets have moved. But, even more reason, we speak with good voices to give us better perspective. And we have Sushant Bansali, CEO, Ambit Asset Management, joining us this afternoon to give us perspective. Sushant, you've recently also written a newsletter which gives more context with regard to what to do at this point. You've quoted Harvard marks at various points of time in that newsletter. But in the Indian context of things, where are we at? Is there value on the table when we are looking at it from a longer term perspective? Is it time to start becoming greedy? And if so, at what point would you start becoming greedy?
Well, definitely, I think we interesting times. The slide and the shift to quality, which started now almost 9-10 months back after the general election results, is very much into play. 3 years prior to that, I think there was lots of excesses. Almost every company was delivering great results, and thereby investors had lots of choice and people made lots of money. But since general election results, the tide has turned, and now earnings are getting concentrated. Very few companies are able to deliver 20% plus earning growth on a year-on-year basis. If you look at the quarterly charts, it reached almost a high of almost 65-70% companies delivering that post-COVID. And then sliding towards now, it's almost 15-20% companies which are expected to deliver 20% earning growth in the BSE 500 in the coming quarter. From that perspective, I would say that the broader market is now less earning editing, but from a concentrated portfolio perspective, it's a great time because it is a stock pickers market, and one can find value. I think across value was available even 6-9 months back into many financials, especially private sector banks, and they have played out really well. Even in today's market, we are seeing those signs that quality and value is picking up well. Going forward, if you look at it from a 2 to 3 year perspective, I would say there will be more bargaining which will get available in the coming months. The trend has just started. This is not here at the bottom. So one should start investing, but keep staggering and not go all in at this point of time.
Okay. And Sushant, plenty of uncertainty around the geopolitical from a geopolitical perspective, yes, but even from a tariff perspective. From an India-centric standpoint, how are you viewing this? Do you believe, firstly, that this is realistic? Can these tariffs be levied? And do you think it's sustainable for the US to do this? And if so, how is India placed relative to the global in the global scheme of things, in your view?
So look, it is, I would say it will be second guessing, figuring out whether they are doing the right thing or the wrong thing, because the general common sense will tell you that if you put tariffs, then inflation will increase, right? Which will lead to people consuming less and which will lead to recession. And so if US wants a recession, probably this is the recipe for the same. Probably they might want to do it so that interest rates can come down, because there is a heavy debt on their balance sheet, a big heavy debt. And to service that, the interest rates, if they come down, will be very easy for them. So who knows, that might be the reason for this. But without second guessing on what are the intentions behind these tariffs, if you look at if it continues, then I think from an India perspective, so far what has happened in terms of the rates, India is, I would say, in a positive trajectory compared to many other competing markets for us for various sectors, be it textiles, be it autocom, be it light goods, engineering. There are many sectors where I would say India will be a beneficial position where there'll be an opportunity to increase wallet share and market share for Indian companies because of the lower tariff. And if there will be deals which will happen, and probably if India is amongst the few ones which are getting it sooner than later, then there will again be a big bonanza for Indian companies. So lots of good opportunities in my view in this whole episode which is playing out. At the same time, if you look at, let's say nothing happens, the tariff rate remains the same and 26% for India continues. From that perspective, not much of loss from India perspective, especially listed markets in India, because the export component to US is not a significant one. And even from a macroeconomic perspective for India, the exports are not a large part, and that too to US is something which doesn't disturb the whole economy. A large part of our economy is basis domestic, whether it's on the agriculture side, whether it's on the services side, whether it's on the consumption side. Very less play on the export to India compared to many other nations, especially emerging markets. And from that perspective, if the economy is not impacted big time, then from an investments perspective, India becomes a much probably positive markets for investors, both domestic as well as globally.
Got it. Sushant, Neeraj here, and I was looking at your note, and from the note, some of the data or some of the charts that have come out also points out that despite the corrective move, the markets are expensive. I heard you say in an initial answer that the number of companies which are delivering 20% growth has also shrunk, even if opportunities remain, which leads me to believe that you are doing a lot more bottom-up than top-down investing currently. Maybe it was always the case, but currently it does seem to be the case, and correct me if I'm wrong here, of course. So my question is, if there are opportunities in an expensive market wherein you're approaching bottom-up, is it possible to know where is it that you believe outsized gains could come from? Because there is an opportunity to buy some buckets which have corrected quite viciously in the last 12 months or last 6 months. I've seen real estate, information technology, some of the energy themes, all of them having corrected viciously. Are there relative bargains in the market currently at all?
Yeah, depending on the time perspective, I would say that bargains are definitely available across the market. But
across.
From the perspective of 6 to 12 months, let's say from that perspective, the focus will be on quarterly earnings from here on, and not from a 1 year perspective.
So Sushant, so can I ask you, what is it that you are watching out for when you're looking at the quarterly numbers? Because abhi tak dekhe to, I mean, the BFSI pocket has delivered, let's say, fairly decent numbers, but maybe it was anticipated. What is it that you're watching out for the most, wherein you might be watching out for a surprise because the street may be positioned differently ahead of the numbers?
So one also has to look at what people are looking for now. So gone are the days when people are looking for 25% and 30% or 40% earning growth. I think in these scenarios, when economy is, I would say, just doing reasonably well and nothing extraordinary, and there are global headwinds rather than tailwinds, a 15-20% earning growth will be very well received by investors. And from that perspective, there are many options available. And more importantly, I would say, results are known only after they are announced. Right, so guessing the numbers and then getting them right is a phenomenal task in itself. So investors also, I would say, will focus more on where the predictability of this earning growth is much higher, and not just the actual results. So where people believe that there are good competitive modes, the management teams are strong, and the target opportunity side of the market, TAM as we call it, is huge. Those are the places where investors will hide behind, and these uncertain times. Now, whether this time will last for a few weeks or few quarters, one doesn't know. But right now, the focus is to get into companies where this predictability is much better understood and very easily ascertainable, along with the actual delivery, for sure.
Understood. So therefore, how are you positioning it, Sushant, if I can push you to or nudge you to help us with maybe a couple of sectors where you believe that there is both a balance of good growth visibility along with decent valuations? What would those be?
Yeah, so from predictability perspective, I would say one has to focus on domestic and not export-driven sector. And from a pure earning growth perspective, let's say take a number of let's say 15%, then probably, and look at the valuations around it, then financials definitely are very visible, and it was visible for almost a year. But people were going after 25 and 30% earning growth, and that's why I missed it. We've been holding few private sector banks for almost a year, and we're getting brickbats for the first 6-9 months as to why are we holding these. And in just about 2 or 3 months, they've played out extremely well from our portfolio perspective. So these are the some pockets, I would say. Financials is the top pick from our perspective, but pharma is another one which we believe that the inflationary part of that will lead US to not, even if they have announced that there might be significant tariffs, we believe that the chances of that happening will be much lesser because we have seen in the last 2 or 3 there have been more supply shortages than demand shortages.
And how should one play gold therefore in this environment, Sushant?
It's a risk-off environment, so gold will definitely do well, but it has already given, I would say,
From
big
here,
return.
yeah, sorry. So even from here, you continue to be
It has given big returns, so it will be volatile. While the direction might be the similar to how it has played out in the past, but there will be volatility. I think to expect some equity sort of volatility in gold prices in the coming weeks and months as well, because as and when some ray of hope comes, and I think there will be some crashes in metal prices as well during short term. But direction wise, I would say it looks like more positive, depending on how much uncertainty continues for how long.
Okay, point taken. Thank you so much, Sushant, for coming in, giving us that perspective. It's always great speaking with and getting perspectives on a day like this. So thanks for doing this. But let's quickly switch focus. What we'll do is we'll slip into a short break. But before we do that, let's listen in to what Sandeep Tandon from Quant Capital thinks at this point with regard to the markets and what the best bets are in this volatile kind of market. So listen in.
See, I think obviously consumption broadly is a very broad sector, is the biggest beneficiary in the budget. So consumption theme should play out very well from a longer term perspective. Then in the current environment, our focus is more from a domestic economy, large infrastructure space. Okay, if you really look at even the NBFC, given the interest rate pressure which can come down. So I think the way you look at the domestic company, insurance sectors, so in hospitality space, even we like pharma, despite some narrative is floating around today, I think is a great sector because cost of production of generic drugs in the US will be few times what you do it out here. So far exemption we have seen, but even some tariff comes, I think Indian companies are in the position to pass immediately. So I think we have to wait and watch rather than just reacting on some interviews of some noise which is floating in the market. I think it's a great opportunity. As long you have earning visibility, whether it's from the domestic perspective or from global perspective, I think, and valuations are attractive, I'll be all in such names.
गोल्ड क्लास ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ.
Whenever a film sank in 2000s, it was always flop actor. मेरी तरफ नहीं देख रहे, देखो तो सही. I compare an actor's career like the stock market. Sometimes your stocks are low, right? And when your stocks are low, no one's buying. Sometimes your movies do well and your stocks are on the rise and everyone's suddenly buying that stock.
What point do you think that the film career perhaps is not going the way that you thought?
Itch of wanting to be an entrepreneur started itching a little more and I wanted to scratch it.
One of the most important lessons is to know when to pivot.
The burn was far more than the earn. We were burning and I was watching my money just go out and like, oh my God, what's going on here?
he sold most of his stock, 80% as on that date.
We have requested the management to come and speak to us. They asked us, what questions will you ask? We've sent it to them. They don't want to answer it, so then let's put it to our viewers as well.
7 key questions, right? How is it that 2,000 crore goes unnoticed by all of these auditors?
Is seeking more information on the trades and the all the transaction which has happened from the exchanges, both NSE and BSE.
The Reserve Bank of India's supervisory officers, they are seeking compliance reports on their foreign currency borrowings by these banks.
The DSS is actively engaging with the Reserve Bank of India to sort of ensure the thorough examination of the matter. And
IndusInd Bank, as part of its internal review, had found that certain aspects of its derivatives portfolio was not meeting the standard that was set by the Reserve Bank of India.
Real estate might look to sell their paper business to ITC. So that would be an interesting deal, not too big for ITC, but from AB Real Estate's perspective currently.
On the 20th, he reported this in his segment Heard on the Street, which runs at 2:30 p.m. every day.
Back with India Market Close right here on NDTV Profit. Now it's time for the Heard on the Street segment, wherein Sumit Sarkar joins in with what is it that he's picking up from his dealing room sources. Sumit, good afternoon, and what are you picking up today?
Well, some stock-specific action in PFC and Jubilant Food is what I'm hearing is that there are some buy flows coming in on the mutual fund and the HNI desk on lower levels for both these counters, Power Finance Corporation and Jubilant Food. Axis Bank is another counter where there are buy flows on the FII desk. Among large banks, the margin of safety seems to be much more, at least relatively much better compared to other large banks is what dealers are indicating, and some FII flows when it comes to Axis Bank. On the flip side, it's Kotak Mahindra Bank where there are sell flows on the FII desk. Some negative news is what is expected by the street is what the dealers are indicating when it comes to Kotak Mahindra Bank. Federal Bank, again some sell flows that we are hearing on the large HNI desk. Even from days high, if you look at Federal Bank has come off. There was also a positive note that had come in from CLSA. They had initiated coverage on Federal Bank. The stock was up 1.5% during the day, but now it has slipped down, is up just up 0.2% in trade. Reliance Infra is another stock that remains in focus. Dealers are indicating that there's some positive corporate development that could come in for Reliance Infra. It could either be an order or some development at the group level is what the street is expecting for Reliance Infra. And lastly, it's Castrol, which remains in focus. Large influential HNIs have been seen buying this counter of late. Today also there are some buy flows from that influential HNI for Castrol in trade. The stock was up around 2.5% at one point of time during the day.
Thanks for that, Sumit. Appreciate that. Well, time to get in a very special voice. Neelkanth Mishra, Chief Economist, Axis Bank and Head Global Research at Axis Capital with us on the show. Neelkanth, always a pleasure to talk to you. Thank you for taking the time out.
Thank you, Neeraj. Thank you, Neeraj. Thank you very much.
No, the pleasure is entirely ours. How are you viewing the developments of the last 48 hours? And let's start off with the basic act of the tariffs that have been levied and some counter tariffs that have been levied by some countries, and how and India's plan about the same.
See, of the 12 countries slash groups like the European Union, which account for about 85% of US imports, 3 have said that they will contest slash retaliate. So that is Canada, China, and the European Union. Even within the European Union, I think, for example, Italy, Giorgia Meloni, who was the only European leader to attend Trump's inauguration, has said that we have to work with the US. The rest want to retaliate. But my sense is that the retaliatory measures will perhaps be serious only from China. And we have to see once the tomb sweeping weekend holiday is over, what exactly they come up with. And this is where I think the risks are, which is the second order effects. So while the Treasury Secretary Scott Bessent did say that immediately after the Rose Garden speech that countries should have patience, that these are just headline tariffs, that we are open to negotiation, and don't be in a hurry to slap basically retaliatory measures. I think the concern will be that especially countries like China, where the duties are as high as 54%, may have no option but to devalue their currency. And the moment the devaluation of the currency starts to take effect, then I think things start going out of control. And frankly, to take a step back and just to lay down the framework instead of just responding to each of the steps that the Trump administration is taking, I think it's very important to understand what their objectives are and why are they doing what they are. And we can see 3 key objectives. The first is they do not want the US to pay the cost of maintaining the multilateral world order. And so the executive order actually explicitly states that they had started with bilateral deals in 1934. And after the Second World War, they tried to get the multilateral order working. The most favored nation status rates were set. And then they found that those rates were unfair to the US. And therefore, they are now going against it. And they are going to the bilateral world order. Now, when that starts to happen, all kinds of industrial policy measures now become fair game. And so export subsidies, currency devaluation, labor subsidies, and so several types of behavior will now come into action and which will make predictability very low. The second objective is they want to generate revenues out of this. So the tariffs announced the night before account for about $50 billion. Remember that they had only about $79-80 billion of revenues from tariffs in the previous year. Now they want to add about $50 billion, and in parallel, they want to offset this with tax cuts. So this by itself is also an objective. So even though eventually some of the tariffs will get negotiated down, like for example, I don't think they have any hope of being able to manufacture footwear or apparel and do it cheaper than India or Bangladesh or Vietnam. So those tariffs will get brought down. But I don't think they're going to give up on the desire to generate revenues out of giving access to the US consumer. And the third objective is that they think that the US dollar is far too strong because of the US dollar's reserve currency status. It tends to be excessively strong. It bears the burden of global uncertainty. So whenever the world used to be uncertain, the dollar would appreciate, and they want to move away from that because they think that it is becoming unsustainable. So when you see these 3 objectives, a lot of what they're saying and what they're trying to do starts to make sense. It is not justified economically. Even the decisions that they've taken in terms of how the rates have been decided, and they've been explicit about it. It's right there on the USTR website. It is like, trying to achieve bilateral trade balance, which anyone will tell you is not achievable. So in this context, what we should expect is continued uncertainty. Remember that even if the tariff receipts were to be converted into tax breaks for the US consumer, the problem is that because of uncertainty, those will be saved. And therefore, this is a fiscal contraction. In fact, on a ballpark estimate, one can safely say that 1 to 1.5% of world GDP growth can be at risk because investments get pushed out, because for another 6-9 months, companies will not be clear on what the eventual tariffs are going to be, what the eventual currency exchange rates are going to be. And therefore, they will pull back on investments. And that itself will drive a slowdown. So I think we are headed for a period of sustained uncertainty, which is not very good for financial markets.
So Neelkan, with an assumption that that's exactly how it plays out, and then uncertainty is the name of the game, what can economies and central banks of countries like India do? We have a central bank meeting next week. For now, the RBI and the government have put up their hand and say they want to support. But this, is it out of the blue for a country like India, which may not be exporting as much, but could be impacted by the collateral damage of global growth suffering? And how does India combat that?
So frankly, I don't see that. I mean, and on a relative basis, I think the economic risks to India are among the lowest that I can see. The only concern I have is on the markets, because frankly, the markets are much, much more integrated to the world than our economy is. So I will not reiterate what I'm sure every guest that you had over the last 2 days would have told you, that exports to the US as a percentage of India's GDP is very low. In fact, our estimate is that the additional duties will cost about $10 billion to India or Indian exporters, and the US consumer will have to bear almost 60% of that. Basically, don't assume that all of these $550 billion will be paid by the exporting country, because many of these prices will get passed on, and therefore the US consumer will be paying the burden. So if you adjust for that, there's like a 0.1% impact on the Indian economy. In fact, on the medium-term basis, if Vietnam is not able to bring down its tariffs, a lot of electronics assembly, a lot of apparel assembly can actually start shifting to India as well. So frankly, economically, I think there is less of a risk. What has also happened, and thankfully so, that the drivers of India's economic slowdown in the last year, which were fiscal, regulatory, and monetary, the fiscal is, I think, less of a headwind than it was. Like last year, we saw 80 basis points of fiscal deficit decline. In FY26, we are going to see only about 40 basis points. So it's less of a headwind. Regulators have, financial regulators, I mean, there are new ones in place. They're saying that we don't want to be impediments to growth, and regulatory easing has started. And on the monetary side, the biggest problem was that liquidity was unduly tight for 16 months. The gap between the certificates of deposit, which effectively mark the rates on the certificates of deposit, which effectively mark the cost of funding for financial firms, for banks, were 150 to 200 basis points higher than what the OIS, basically the repo rate was. And so that was primarily because of tight liquidity. I think in the last 2-3 months, we have seen the RBI act very forcefully, very decisively, and now has replenished the liquidity that was lost because of currency interventions. So the CD rates have started to come off. It is, I think, reasonable to expect that that over the next 2 months, the deposit rates will also start to come off, and then finally the credit easing cycle will take off. I think in the MPC meeting next week, the consensus is, I'm still worried about inflation, but I think the overturn window for the MPC is very narrow now. They are very likely, I think, to cut rates again. The repo rate comes down to 6%. So some of the self-inflicted growth slowdown is now starting to reverse. And therefore, economically, I see less to worry about. I'm more worried about what happens to the financial markets, because the equity risk premium, despite all the economic uncertainty we've discussed, is still near historic lows in India and the world. India's P premium is low, but the P multiples globally are also still elevated. I also see a risk of sometime in the next 3 to 6 months, the Chinese currency coming under pressure. And that will create new types of policy headaches for everyone. And of course, then there is the global growth slowdown, which I don't think we can be totally immune to, given that we do have some exposure through our exporters to IT services companies and, of course, global commodity prices.
Understood. Fairly detailed in that sense. Nilkant, Harsh also joining in. You've mentioned the Chinese currency risk a couple of times. Contextualize that for us and our viewers.
No, that's it. Thank you for asking that. Get ready for another long answer. So, for a country that has a $1 trillion goods trade surplus and has maintained a current account surplus for most of the last 3 decades, people will find it surprising that the balance of payments in China are under stress. Is under stress, and I think that there are good reasons for that. The first is that their net international investment position, so how much of global assets they own and what are their minus what their global liabilities are, is only about $2.4 trillion. So this is only about 12-13% of GDP. What is even more worrying is that, and this is partly because a lot of the current account surplus they booked over the past 2 decades has been lost because of capital flight. So just in the last 10 years, the errors and omissions in the balance of payments, which is a measure of timing differences, has and should cumulatively be zero, is actually $1.4 trillion. So that's at least the amount that they've lost because of capital flight. So and therefore the earnings that they have on all of the past savings are actually less than the cost that they have to pay on their foreign liabilities, and their primary income is actually negative. So as we all know, they also have a negative services trade balance. So they have a lot of outgoing tourists. They have a number of students that study abroad. And so when you combine all of this, their current account is actually not as good as you would think it is. But I think the biggest challenges for them are on their capital account. Today, their net FDI is minus $200 billion because inbound FDI has more or less stalled and I think will remain weak for a while. Outbound FDI needs to be high and has been high. So in order to sidestep some of the retaliatory actions against China and just the US, but if the Chinese start dumping into other markets, I think this will the barriers will start getting erecting in other economies as well. They have to do a lot of outbound FDI. This is exactly what Japan did after the mid-80s, where it started to invest in factories outside Japan. China needs to do the same to protect its market shares. What is even more important is that their 1.7-1.8% yield on the 10-year bond is far lower than what you see even in the developed market. So therefore, in the last 12 months, the 12 months ending September, their trade credit outgo was like $200 billion. So on the balance of payment side, they actually have a negative balance of payments. The reason why they are, I think, preventing the RMB for depreciating is that, like what we saw in India, when we move from a fixed exchange rate to a volatile exchange rate, there is a very sudden shortage of dollars, which is exactly what India went through. And I think in China also they will go through that, where exporters suddenly stop their supply of dollars because they think the currency is weakening. The importers try to start to hedge when earlier they were not hedging. And when you put all of this together, it creates temporarily a lot of pressure on the currency. Now, the problem is, if because of these tariffs, the trade surplus itself say shrinks by $200-300 billion, imagine how much the pressure on the balance of payments is going to be. So they may not be doing it immediately, but when they see that this is inevitable, I think there will be a lot of volatility in the currency markets.
Okay, point taken. And how should one look at, and one on the global macro, one on the domestic macro, and therefore, sir, explain to us. One is you've already seen a 0.25% cut on the repo. You're expecting one more rate cut next week. How quickly does this start to translate on Indian lenders as well as consumption? So on both of those, you're already starting to see that in terms of certificate of deposit, etc. But true translation or true transmission will happen when deposit rates and loan rates start to change. How quickly do you think that happens?
That starts to happen in a couple of months. So see, already the 12-month CD rate, which was at 1.760 for a certain type of borrower, has fallen to 710. There are people who expect it can actually fall to 675. There are some extreme cases where people think it can fall to 650. Let's see what happens. But the point is that the spread, see the OIS, the overnight index swap, which is effectively the average expected rate of the repo rate over the next 12 months, when it was 610, 611, the CD rate was 760. So there was a 150 basis point gap. And for some of the smaller banks, it's actually 8% plus. That 150 should actually be 60, 70 if the normal liquidity conditions prevail. And so if the repo rate is at 6 and the 1 year OIS is at say 590, and so then I think 650 on the 10 years, the 1 year, 12-month CD does not seem that irrational. I'm not sure it will fall that fast, but it may. And so as that happens, the marginal cost of funding for all banks starts to come down significantly. And I won't be surprised if in the next week or so, maybe immediately after the MPC meeting, we start to hear of deposit rate cuts. So as that happens, the weighted average, so the MCLR then starts to fall. The weighted average cost of financing for the banks falls. And then given that credit growth has slowed so sharply, there will be products which are very rate sensitive, say like mortgages, where the banks will start cutting rates. And so I think in a few months, we should start to see the transmission happen. Frankly, just 2 months back, I would not have expected that because liquidity conditions were so excessively tight. But courtesy the significant interventions by the RBI in terms of large amounts of OMOs and very significant amounts of buy-sell swaps, they have more than offset the 5 lakh crores of liquidity they had been forced to suck out when they sold dollars. So this decisive action by the RBI, in addition to, I think when the RBI dividend gets paid in end of May, durable liquidity can actually go to 2% of NDTL, which I think will be a very healthy level. What we are also seeing, and this is very comforting, that at one point, the RBI had an $80 billion forward short position on the dollar. Now, think about a bank which is looking at those numbers, and as of end of February, and you're worried that there is also an NDF short, which is not visible there. And what if the RBI is forced to sell more dollars and then the liquidity dries up again? Right. How can I sort of grow my lending? But now what has happened is that it looks like NDF shorts are now like $10-12 billion. From what currency traders estimate, the 80 billion forward short is now 60 billion of forward short. And so when you put all of this together, there is sufficient comfort that banks can take, and therefore they can start growing their credit book, which is actually very supportive for the Indian economic momentum.
Touch wood. So economy is relatively unscathed. I heard you say twice that you're worried about the markets. I'm guessing collateral damage in addition to growth could be the issue as well, even if the economy grows per se. But what could turn this, Neelkant? I mean, is it renegotiation by various nations, including India, and therefore global growth not suffering as much? Because the sideshow of a lower crude price, lower DXY, all of that should be net positive. So what can turn Neelkanth Mishra's stance? Is it the solution to the trade talks, or is it something else?
Well, my stance, I'm an observer.
Okay, observation. Let's put it that way.
I'll tell you what the signals that I'm looking for. So you're absolutely right. I don't think. So these are very large costs. While, as we discussed earlier, the Trump presidency interprets its electoral verdict as sort of breaking apart the current system, which was not working for the US, is their interpretation. And therefore, I think they want to sort of build a new system. Now, in doing so, they seem to be doing things in a very haphazard way. So the question to ask is, what can force them to pull back from all of this seemingly random destruction? And it has to be like it's a democracy. I think there are some voices of discontent which have started to emerge in the Congress, for example, against these tariffs. Remember that it will be his party first which has to start putting this pressure. As of now, everyone is aligned. They all know that if the president supports them, they can get re-elected and so on and so forth. But as the economy weakens, I think popular support, and this is how democracies function, that there will be a feedback loop that starts to get generated, and then corrective actions can start happening. So we have to wait to see, the popular support for the president start to turn, because the pain then starts to become very real. Remember that he's also trying to address some of these concerns, like, for example, if, say, prices for some products go up, but he's going to position it as the cost of bringing manufacturing back to the US. He's also pressured the OPEC to increase oil output so that fuel prices at the pump, which are a very important signal for inflation expectations in the US, actually come down, which frankly will benefit us as well. But these are things that they will keep doing. There are other items on their agenda on how to bring down debt to GDP, how to weaken the dollar, and so all of these, I think, will be coming into play. The corrections start to happen. The uncertainty starts to erode only once the popular support for the president starts to come down, and that means real economic pain on the ground in the US. What I'm most worried about is that it is somewhat easy to break apart a current system where there was multilateral agreement, where people had over decades after Bretton Woods, but even after Bretton Woods in 45, it took 12, 13 years for the Bretton Woods agreements to get implemented. There have been flaws, there are problems, but at least there was a collective decision to behave. Once you break that apart, I think reassembling that becomes a significant issue. So it'll be very challenging. I'm hoping it doesn't go that bad, but it is reasonable to expect that things will worsen a lot before they get better. The only thing I worry about from the perspective of equity markets is that the equity risk premium, which needs to be at a certain level, because equities are a risky asset class, are at historic lows when economic uncertainty is at historic highs. And so that it's not a modeled variable. So equity risk premium is a discovered variable. It is when some investor just gives up. I mean, look at what happened to Pharma today, right? Yesterday, I felt that Pharma makes no sense for the US to impose duties because most of the value of Pharma is IP. Manufacturing, it does not really make sense when you do it. I mean, generics companies, sell for 20 cents and it's sold at $7 in the US. The point is, he still wants to impose those duties. And so eventually investors will get fatigued, tired, saying that, look, we can't predict this behavior and therefore we are kind of pulling back. And that's what worries me, that I think that's where there is a disconnect, and the price to earnings multiples we are used to need to be revised down.
Yeah, so well said. It's in simple terms, maybe just the uncertainty will take its toll more than anything else, because or unpredictability of what Donald Trump does. So well put. Nilkan Mishra, well, thank you so much for all of these insights. Just absolutely lovely talking to you today.
Yeah, thank you. Thank you for having me.
All right. Just so well said. Harsh, this is exactly something that we were talking on in the afternoon show, right, at 12:30. It's just the unpredictability of this all.
Correct, absolutely. And but you know, the one major takeaway, at least for me, Neeraj, is the fact that India in relative terms is insulated to a certain extent from an economic perspective, but even from a policy perspective, we are headed in the right direction. I think he seems to be positive on both of those counts, which kind of stood out. In an environment like this, had we not been confident on the domestic front, that would have been a real double whammy.
Yeah.
So there are areas, I believe, of the market where you will see, you will be able to hide for cover, even in these largely uncertain times. So that's the one possible positive I'd take out of this one. So.
Can you take any positive out of what's happening to metals, though, is the key question, right?
Yeah, I think Mihika's standing by for that. Let's take it straight to her. Let her take charge of that. Mihika.
Yeah, it's funny because yesterday, at the face of it all, metals was one sector that may have not had a direct impact of the reciprocal tariffs. But today, the Nifty metal is one of the top losing sectors of trade. Its index has hit an intraday low of over 6.5% and trading lower even now, almost 7% right now. And all constituents throughout the day have traded in the red. Now, in terms of the top losers, you have stocks like Vedanta, Hindustan Copper, you have something like a Tata Steel as well as a Nalco that is seeing heavy pressure, cuts of almost 10% right now. Now, when you look at why the negative sentiment, well, there is no direct impact of the 26% tariff on steel and aluminium because we export very less of steel and aluminium to the US. However, the indirect impact of tariffs have caused more of the uncertainty that we are seeing, the higher possibility of severe US recession and the risk around US slowdown can impact the metal prices and especially the aluminium prices. Now, prices as well as the earnings and valuations of the companies, which is why you have something like a Nalco as well as a Vedanta and Hindalco Industries that's down in trade. Now, as per MK, in the scenario of a US or global slowdown, aluminium prices could trend downwards to around $2,300 per ton versus $2,420 per ton currently. In a situation of a US or global recession, the prices could turn down to around $1,900 per ton, which is obviously negative for the realizations of these companies. And then when you lastly talk about the EBITDA sensitivity, at a price where aluminium is at $2,300 per ton, Hindalco has a 20% EBITDA sensitivity at this price, Vedanta at 25% and Nalco under 28%. So there is potential risk to the earnings, especially the aluminium companies, and even the base metals as well as the steel stocks are seeing pressure today.
So, Mega, net aluminum, the biggest potential loser?
Yeah, right now it's seeming that way because steel prices have seen price hikes in the last few months. But right now, aluminium, which has had a great run, in fact, the last 2 quarters, so have all the base metals. But right now, aluminium is a key thing to watch out for because even from the China demand side, there's a lot of uncertainty there as well.
Okay. Thanks for that. And clearly a sector that is really reeling under pressure. Let's get Kunal Shah's view. He's senior technical and derivative analyst at Mirae Asset Sharekhan, joins us on the show. And Kunal, reason to be worried if anybody was long on metals, let's start with that since we were talking about metals. How do you see the price behavior today? Does it open up downsides enough for anybody to take a fresh trade at these levels, Kunal?
Good afternoon, Neeraj, and good afternoon, everyone.
Very good.
Definitely, the call what we have got today is concerning because if you look at the correction what we had earlier in the Nifty index, before that pullback what we got from 22,000 to 23,800, metal was the only sector. If you look at from January 2025, it was just consolidating when the markets are correcting. So it was forming a base on the lower end. And then post that, on 5th of March, we got a breakout from this sector. It rallied from 8,600 towards the mark of 9,200. And the initial signs were that it has bottomed out and we might see a further strong rally on the upside. But today's fall in that metal space has breached all the critical support zone for this entire bottoming out scenario. And now all the critical levels have been broken in today's trading session. So now that bottoming out scenario gets fizzled out, and now the downside gets opened. The scenario is that we expect now the Nifty metals, which have taken a support at around 8,000, that will be also taken on the downside, and we might head towards 7,600, 400 levels. So I think that is also looking on the weaker side. So I think any pullback what you get into the metals, that would be again an opportunity to sell or exit. The structure which was earlier forming as a bottoming formations has been negated. So now the view is cautious. Utilize rallies to sell the metal index.
Okay. Kunal, your picks for this afternoon, therefore.
I think two stocks which I would like to suggest from these. One would be on the buy side and one would be on the sell side. The first stock which I would recommend on the buy side is Indigo. Clearly, in the weaker market, the stock has been gaining a lot of strength with the fall in crude again. We can expect Indigo to reach its all-time high levels again. And overall, it has already given us a breakout. And then again, we are seeing some reversal patterns on the technical charts. So this could continue the momentum on the higher end. So that's a buy for me at the current levels. The stop loss is 4950, and I can expect targets of 5200 to 5300 on the higher end. So Indigo is the first stock which is there on the buy side. On the sell side, Varun Beverages, I think the major run-up what we got in the recent time, that has been completed. And now I expect some further retracement into the stock. So it has a good sell opportunity. The risk to reward ratio is also favorable. So one can go short, currently trading at around 533, 535 zone. Keep a stop loss of 550 and look for targets of 520 to 500 on the downside.
Okay. So those are some stocks for you as well to keep on your radar. But what we're going to do is we're going to slip into a very short break. On the other side, we'll give you a perspective bull versus bear on one of the counters. So stay tuned for that. And we'll be joined by Neeraj Diwan. We take his views along with Kunal's on various specific stocks. So stay tuned.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Whenever a film sank in 2000s, it was always flop actor. लेकिन मेरी तरफ नहीं देख रहे। देखो तो सही। I compare an actor's career like the stock market. Sometimes your stocks are low, right? And when your stocks are low, no one's buying. Sometimes your movies do well and your stocks are on the rise and everyone's suddenly buying that stock.
What point do you think that the film career perhaps is not going the way that you thought?
Itch of wanting to be an entrepreneur started itching a little more and I wanted to scratch it.
One of the most important lessons is to know when to pivot.
The burn was far more than the earn. We were burning and I was watching my money just go out and like, oh my God, what's going on here?
He sold most of his stock, 80%, as on that date.
We have requested the management to come and speak to us. They asked us, what questions will you ask? We've sent it to them. They don't want to answer it, so then let's put it to our viewers as well.
7 key questions, right? How is it that 2,000 crore goes unnoticed by all of these auditors?
Is seeking more information on the trades and the all the transaction which has happened from the exchanges, both NSE and BSE.
The Reserve Bank of India's supervisory officers, they are seeking compliance reports on their foreign currency borrowings by these banks.
The DSS is
Welcome back. You're watching India Market Close here on NDTV Profit. Now on to our bull versus bear segment, and this one is an interesting one because it's something even I'm keen to hear in terms of what both sides of the coin seem to look like, and Bharat Forge is the one which Puneet is dissecting today. Over to you, Puneet.
Well, thanks for that. So really scampered through for the bull case, to be honest, in this one. Lot of things to look at in terms of Bharat Forge. 30-35% of the company's revenue coming from the US, and now that the tariffs have been put in, it's going to be one of the companies that gets impacted by that deeply. Of course, it's expected to impact the Class 8 truck demand as well for the company. We saw those tariffs coming yesterday, and that is definitely one of the bear cases in the first case. On the bull side though, it's non-auto business, specifically the defense business, has been gaining up traction. Now they've finally got an order worth 6,900 crores for the advanced gun systems. That is expected to, of course, play out over the next 3 to 5 years, and it's a big, huge order for the company. It's the only listed player who's gotten the ATAGS order. The other one's Tata Systems, that's a private company, but definitely a big win, and that will essentially, at least sustain earnings going forward. That might be impacted because of the tariff system. When you look at the second bull and bear case for Bharat Forge is, of course, the Class 8 truck order. If we can move on to the next one and look at the bear case, there has been weakness in March sales, which is the preliminary number which comes in the first week of the next month. Essentially, it's down 14% on a month-on-month basis, down 22% on a year-on-year basis. And if you look at from September to March onwards as well, it's been down roughly about 9 to 10% also. The outlook for the Class 8 trucks also doesn't look very well. On the other hand, the company is looking to boost its profitability as well as the profitability for its subsidiaries essentially, and its foreign arms as well. So that will be something to watch out for. It had guided that it is looking to do that in FY26 as well, and there will be subsidiaries in Europe as well as the USA. Right now they are loss making, so something to watch out for, and on that aspect going forward. The third key point was the specifically the US EPA green norms. Now essentially in the US, green norms were expected to come in for 2027, and that was expected to trigger a pre-buy in FY26. We saw the US EPA head come in with comments that they might be looking at that, and we know Donald Trump's stance on looking at fossil fuel as a fuel. So the green norms might potentially be delayed. This will not trigger a pre-buy. That was essentially the bull case that was anticipated, but that might not come in now. So that is another thing to watch out for in terms of announcement. In case that doesn't happen, the norms stay, it could trigger a pre-buy in FY26, the much needed trigger for the company. And finally, in terms of valuation as well, trading at 31 times price to earnings for FY26, while not cheap, is definitely a lot lower than its 5-year average as well. But another key trigger was today that Morgan Stanley had downgraded the company, estimating cuts of about 15% in this fiscal year of FY26. So overall, a lot of questions to answer for the company, especially in terms of commentary for what is expected in the US. But it is one point that I want to make finally, that for the US, Bharat Forge or the Indian forging companies are very cost efficient, and that's across the sectors that US might get impacted because of higher costs. So in terms of optionality from the others, might not be too much, but definitely in the short term we might see an impact from these multitude of factors that we just spoke about.
Okay, thank you so much for breaking that down for us, Puneet. Of course, tough one in that sense. But also joining us today is Neeraj Diwan, independent market expert. Neeraj, if I can quickly take your views with regard to something like a Bharat Forge, would you at this point, would a counter like this interest you? Would you stay away given the uncertainty? And if so, at what point would you want to enter something like a Bharat Forge?
Yeah, good afternoon.
Good afternoon.
Yeah, actually, stocks like Bharat Forge, which depend to, like you right now also mentioned, 30-35% the revenues come from US. So there is this short-term uncertainty, that we need to get some answers for whether whatever they say in the result con call which happens for March quarter, it will be very interesting to listen to most of these companies there and what kind of impact, what is the kind of negotiations or the power, the selling power they have with the buyers in US. So all that needs to be watched right now. I think one should not be in a hurry because it is not that you are getting it at a deal price right now. It is still, even after the correction you've seen in the last couple of days, it's still available at 30-35 times next earning. So that's not really that cheap evaluation or that kind of a deal you're getting right now. So I think I'd rather wait and see what is the news flow which is coming because of the tariffs and what is the commentary which comes from the management.
Okay. Kunal, your quick view on the technical side of things with regard to a Bharat Forge.
Yeah, I think Bharat Forge already was trading in the deep oversold territory. It had witnessed some technical bounce, but post that we have not seen any follow-up action. Today, action again indicates that the stock has reached the 20 DMA on the technical side, and that opens up more room on the downside. Now, the next support for the stock on the weekly chart is the level of 992. So I can expect that level to be tested. So the short-term view is negative. Pullbacks would be an opportunity to sell it. 990 is what I'm expecting on the downside.
Understood. Okay, got it. The other one that's in focus within the auto pack is Tata Motors. CLSA had a high conviction outperform on this one. They've downgraded the stock to an outperform. They've reduced the target price substantially by nearly 200 rupees. Puneet here with all of the views. Puneet, what changes according to CLSA now?
Well, what's interesting is the high performance outperform rating came actually just a month earlier. So it's a big change that's come in this particular month, and that's of course led by the US tariffs impact. Target price now 765 versus 930 earlier, downgrade to outperform, as you rightly said. They mentioned that FY26 as a year will be a year of rebasing, and that will be of course led because of the US tariffs. US has a tariff of 25% on foreign automobiles, and Tata Motors imports all of those from UK. So they are manufactured in the UK as well as Europe, and this is the Jaguar and Land Rover brand which is then imported in the USA, and that will get impacted. While it is expecting free cash flow to be positive in FY26, we might see some cut in capex. They have a $15 billion plan over 5 years for capex for Tata Motors, and a huge amount there. That will be of course in the rebranding of Jaguar as an electric brand as well. The update on demerger is that it could coincide with the CV down cycle getting closer to the bottom. So it could be something to watch out for in terms of valuation, because CV business very profitable, 11 to 12% EBITDA margins there. But definitely on JLR it's going to be some pain point going forward. So it's something to watch out for in terms of from CLSA, but definitely it's one of the target prices that's at the higher range between 760 across the brokerages right now.
Okay, Neeraj, first off, thank you Puneet for that. Again, Neeraj, give us perspective on how you view something like a Tata Motors. Large chunk, 25% of revenue comes from JLR and from US in particular to a certain extent. What in your view could the impact look like, and is the stock reaction warranted?
Actually, the kind of correction we've already seen in Tata Motor, I think one should keep it under watch now, because another 4-5% from these levels, if it comes to 560, 570 kind of level, I think it'll start becoming attractive again for someone to start accumulating for, if one is looking at 1 to 2 years investment. And I feel somewhere down the line, definitely, the domestic business will become very important, because here economy is picking up. So you can see pickup happening in their commercial vehicle space in India. So that pickup can help them, increase again their profitability from this side of the business. And as far as the EV side of the business in India is also concerned, which is doing well for them. There can be some slowdown here and there for a couple of months, 1 quarter, 2 quarters, but generally it's been on the right direction. So I feel that because the correction has already been huge in Tata Motors, so I think one should be looking at buying this on dips, further if you get 4-5% from these levels.
Okay, and what's the technical view on this one, Kunal? Interestingly, because this one has corrected substantially and continues to see pressure, right?
Yeah, I think overall, if I look at the long-term charts for Tata Motors, the breakout what we had got earlier on the monthly chart was around this zone of 600 mark, and now we have come to 613. So I think we will again test this breakout zone on the downside. So I'm expecting 570, 580 to be tested on the downside. And I think from there it would be a good entry point, at least to play for a pullback again back towards 700 levels. So I think waiting for more declines in the short-term perspective, 575, 580 is what I'm expecting. And from those levels, you can again look for the buy perspective, and targets would be 700 on the upside.
Okay. Now the other pocket that's also facing some pressure today, and we've been talking about this from the morning, are pharma companies. Under pressure after US President Donald Trump remarked about the upcoming tariffs in the sector. My colleague Varsha joins us to tell us why it's difficult to levy these tariffs. We also have a CLSA view. But Varsha, first off, your view.
So yes, Nifty pharma index is actually down now. Why? Because Trump says that pharma tariffs are coming soon in near future, and he clearly said that pharma tariffs will be at level which we haven't seen, and pharma will be a separate category. Now the important point over here, so if you see a lot of every stock, you take a name, you Gland Pharma, Aurobindo Pharma, Dr. Reddy's, Supply, and all the pharma stocks are actually down on the back of this news. Now the important point is, would it be rational to impose tariffs on pharma and generics? Let's see, the value of US drug imports was almost $170 billion in 2023. India exports pharmaceutical goods worth $10 billion to US, which contributes 6% of the US pharma imports. If I want to talk about generics provides more than $400 billion in annual savings to US healthcare sector. So clearly this seems that it's actually not possible or not rational to put tariffs on India when US is so much dependent on India when it comes and even on other countries when it comes to pharmaceutical products. Even for China, PII data shows that there was exports of $2 billion from China to US in 2023. Now, why? The important point is why tariffs on pharma will actually not work. One is healthcare is actually not a discretionary spending, and supply chain is quite elongated and complex. Even if Trump says that come to US and put up facilities, it would take 4 to 5 years to put a facility and start running. So that's not viable to do that. Large capacity building can actually take a decade or longer. Now let's talk about which are the top pharma products exporting countries to US. Starting with Ireland, in 2023 it exported almost 28%. If you see, Germany exported 21% of pharmaceutical products to US. India exported 11%, and the other categories fall at around 50%.
Okay, right, Varsha. So Varsha, quick follow on. Now on top of all of this, we've seen these threads before as well. So what's the view? What's the view that the street is taking? What's the view that analysts are taking? Give us that.
Have you seen any tariff threats before? So previous tariff threats in first term of administration led to promises of US manufacturing. Now companies pledged capex and facility shifts, but nothing materialized. Also, US scientists and manufacturing costs are actually 5 to 10x higher, and this leads to lower ROC and longer break-even times for US drug manufacturing. Lastly, let's talk about what ICICI Securities or what brokerage firms are saying. So ICICI Securities says that a 20% of tariff increase will lead to a product cost 120 rupees from 100 rupees. Now pharma companies may stop selling low margin products in the US, and increased cost will actually be passed on to insurance companies, pharmacies or consumers, and insurance companies will likely not cover branded drugs, and CDMO companies are likely to be unlikely to be impacted as they are hard to replace. So these are the views coming from ICICI Securities, and their investment recommendation is the current pharma stock dip is a buying opportunity, and long-term earnings are not expected to be significantly affected as per ICICI Securities.
Okay, there's also a CLSA view. Thank you so much firstly for that, Varsha, for that update. It's also a CLSA view coming through that this looks a little bit difficult to implement, and that eventually the probability of something like this going through, Neeraj, is very, very difficult. But first, I mean, it's 3:20 and therefore the BTST STBT call. Kunal, let me come to you with regard to that. Neeraj Diwan requesting you to wait for just a couple of minutes, take your views on pharma before we let you go. So first off, Kunal, BTST STBT.
Yeah, I think I'll go for a BTST idea, and the name of the stock is Marico. Already the stock has been trading in a strong uptrend. In today's trading session, it has given a breakout over the previous 5 days high. With volumes, the breakout has been, so this is the buy. One can buy with a stop loss on the downside of 660 and look for targets of 690 to 700 on the upside.
Okay. Neeraj, your view with regard to pharma. So we've set it up in terms of how pharma is stacking up and what the risks are like. What do you believe? Is it realistic to expect heavy tariffs in the pharma industry?
Yeah, I think so. There is definitely a fear that has been building up there, barring yesterday when pharma was not in the part of the tariff list, so people thought that it'll be excluded, and again that those hopes are dashed. But it may be difficult. Like the CLSA view is also there. Trump can come and say that it doesn't matter to him if car prices go up in US for the consumer for some time. But pharma is an industry where it is difficult to take that kind of a call. So if the prices of drugs and pharmaceuticals and all they go up, that is something which has a really wider impact. So definitely, I think it will be difficult to do this. And to what extent they exactly do it is also not clear right now. But I feel that one can be stock specific and use this opportunity, especially API manufacturers. They are, I think, in a better position because that is something which I feel is very difficult for even a pharma company in the US to do without. So I think one should be stock specific there and use this opportunity, the correction that we've seen in the pharma space right now.
Is this therefore a day like this an opportunity to buy, and if so, what are you buying and what's the rationale?
Yeah, that's what I said, that API companies, something like DV's Lab, there's a smaller one like Senores. These are the kind of companies I feel, these are the ones which are in my list of buys. So I'd be buying these. So I'll wait for a day or to see again, that if the reaction continues, like today is the first day when we saw seeing such a major reaction. So we can wait for a day or two and see if the reaction continues, then they should be the ones which I am looking at buying.
Neeraj, I know we have to thank you. This is Neeraj here. Good afternoon. But just one quick word, Neeraj. The IT stocks which have been hammered now by 28-29% from December peak, are they baking in the works?
Yeah. Hi, Neeraj. I think IT was one space which I think we've all been discussing, we've all been avoiding. So I think that problem still is not clear, because if all this is going to lead to a slowdown in US, a lot of these companies are depending a lot on US for the business. So it may take a little longer time for things to reverse. So I think IT one should still wait. though, we've seen a major correction. Some of the stocks will be attractive at these levels. Some of them have India exposure, which is larger also. But I think I'll still wait and see. I think let's not be in a hurry to buy IT. I would rather buy it on a rebound when things are getting a little more clearer. But right now, there's so many, moving parts there. One, of course, a slowdown which can happen because of tariffs. Then there's this visa issue which may crop up. So there are a lot of things which may happen for the IT industry, which still you need a lot of clarity on.
Okay, Neeraj, we'll leave it at that. Thanks so much for taking the time out and giving us your thoughts. Have a good weekend. We're glad, a lot of people will be glad that the weekend is coming. Kunal, how damaged are the charts for, let's say, a Persistent Systems or a KPIT? These are usually the stronger stocks, but they have gotten damaged quite viciously in the last few days.
I think, Neeraj, first I'll talk about the Nifty IT index.
Okay.
So I think Nifty IT index, if you see, here the trend had already got weakened when the IT index had broken the 200 DMA. So that was a clear-cut trend reversal for the IT index, and we were very cautious on this. The 200 DMA was broken on 24th Feb 2025. So that is where we were cautious that Nifty IT has broken it down, and from there onwards we have been seeing a lower top, lower bottom formation. Now coming on the weekly chart, it has already given a rising trend line breakdown, and now it has touched on the weekly chart the 200 SMA, and this has been the point where the 200 SMA has not been broken on the IT index except for the COVID. COVID was an exceptional case when it was broken, but Nifty IT has never reached this 200 DMA. And now we are on a break of that. In fact, today the weekly closes, so we are going to close below that mark. So this is a worry for the IT index, and probably from next week the results would be coming in. So you might have some sideways consolidation or a pullback over here, but the larger term trend now is looking weak for the IT space, and a sustained move below this 200 DMA will add further selling pressure. And we expect IT index can test on a short-term basis the mark of 30,000, 31,000, which is the next support zone. So currently trading at 33,500. So any pullback you get into the IT space, that would again be a probability to sell. Now the resistance for the IT index is placed at 35,700, 35,600 mark, which was the recent swing low what the IT index had made. So you might get some pullback, but again that pullback would be an opportunity to exit.
Okay, and the same thing for, I believe, quick 20 seconds, Kunal, the same thing for a Persistent, KPIT, all of them the same template, right?
Exactly. I think even the charts are looking much more worse than the IT index, and that is where even Persistent, if we talk about that, has reached the swing low 4,900, 5,000 mark, and probably we can expect some pullback. But the next support zone, what I see for Persistent is somewhere around the mark of 4,400.
All right. Thank you so much, Kunal. We'll let you go on that note. It's been a tough day, and now we're sitting at nearly where we were an hour and a half back. So no real major change in that sense, but 1.5% shaved off the Nifty. But the real pain sitting in the broader markets. Let's quickly pull those up. The Nifty 50 trading 1.5% lower. We're just about touching 22,900 at this point. And in terms of how the heat map is also shaping up, if you can pull that up, you'll see the pockets where there is some bit of respite in trade today. Financials, maybe consumer, Nestle, Tata Consumer standing out, and Asian Paints standing out, and HUL standing out. So maybe those couple of pockets doing okay. But other than that, there's pretty much deep pain. 25 plus stocks trading 2% plus lower in trade today. But steel stocks, IT, Pharma standing out. Those are the three pockets where there is the most amount of pain. And IndusInd Bank sitting 3.5% lower. There's another downgrade that's come, and that is reflecting in the stock price today. Tata Steel down 8.5%. Really, that's the story of the day. Let's pull up the contributors on the Nifty as well. And within that basket, you'll see financials in some way able to insulate all the pain. And here, of course, some of the heavyweights reflecting, and of course the Tata Steel, despite it not being a heavyweight, making it here is because of the 8.5% fall in the stock price that we've seen today. Let's look at the advanced decline. We've closed for the day. Let's look at the advanced decline. Well, clearly painful, evidently, as you can see. Just about 1900 declines for just 300 advances, and therefore plenty of pain in broader markets as well. But first, let's pull up the weekly chart on the Nifty. Let's contextualize the week. Let's step back a little bit. And that's how the week has played out. 2% lower after the 1.5% fall that we've seen today. Let's pull up the Nifty mid cap and small cap indices as well, and thereafter the Nifty Bank, because that was the one pocket which was in some form an outperformer. 2% lower for the week on the mid cap, but more than 2.5% is the fall in trade today. 3% plus on the Nifty small cap in trade today, just 1.7 for the week. So a predominant part of the pain, at least in the broader markets, have come today, whereas on the Nifty 50, we've seen that kind of flat line pretty much through the week. We've seen 2% lower on the Nifty 50 now for this week. That's how it's played out. But let's look at the Nifty Bank as well, because that's one which has been a rank outperformer, 0.5% higher this week, flattish today as well. So that's how it's played out, and largely insulated by some of the larger private banks, at least in trade today as well as through the week. Now let's talk sectors, and let's pull up the sectoral heat map, and what we'll see is, of course, no surprise, the Fin Nifty has also closed in the green, so that's another key positive. Nifty Private Bank largely flat, so no surprise there. But Nifty Metal, Nifty Pharma, Nifty Oil and Gas, that's where a lot of the pain is. Nifty Realty bounced back from the lows of nearly 4% low, and Nifty IT also down 3.6. That's where a bulk of the pain is. Nifty Autos also seen some bit of pain, 3% lower in trade today. The Nifty PSU Bank, which was doing very well yesterday, down 2.5% today. I want to quickly zoom into the Nifty Metal for the week, because we've erased quite a bit in terms of that index today itself, and for the week as well. A major part of the correction has taken place today itself. So nearly 7% down for the week on the Nifty Metal. Metal is a pack which is going to be in focus now, and we'll have to wait and watch. The other one is IT, and I also want to pull up Pharma, because plenty of pain pockets this week. 7.5% lower on IT. So bulk of the pain front-ended at least this week in the Nifty IT index. The Nifty Pharma, if we can pull that one up, there you go, 2.3% lower on the Nifty Pharma index. Yesterday doing relatively well, but outside of that, we've seen a 4% correction in trade today. Let's lastly go to the BSE 500 top gainers, top losers, and there you go. Those are some names which stood out in trade. A bulk of those within the metals pack. A Polymed, of course, exporting medical equipment, and that one also facing a brunt of tariffs, and therefore you're seeing that reaction on the stock price. Some financial names in the list on the positive side as well that we can see. But let's last off look at what to watch, because we have a weekend in front of us and a bit of a relief in that sense, as Neeraj mentioned. India Forex reserves, Canada unemployment, US unemployment rate, and we'll have a speech by the chairman of the Federal Reserve. It's also in terms of the last day for the Siemens demerger, Siemens Energy India to list on Monday, on the 4th of April. So something to look out for. Some of these stocks saw quite a bit of pressure in trade today, but shares expected to exit lock-in. KRN Heat Exchangers was one such stock which really saw pressure today in trade, but keep your eye out on these, because you'll see lock-in expiry coming Monday. But with that, we are out of time for this week. But we have one quick exclusive for you before I let you go, and thank you and wish you a great weekend. But we had the Paytm CEO, Vijay Shekhar Sharma, who reacted to the US tariffs. Listen in to what he had to say. Interesting take from a startup perspective. Listen in.
So Paytm Soundbox, you've seen everywhere, has the method that it speaks the amount of the money. We added the element that you can talk about it. Yeah, that's right. So it can make a payment. So this shows the amount that the customer has made. It can speak, it can do the zero volume. So at many point of times, shopkeepers do not want to speak the amount. They can keep seeing it. So we made it a visual sound box. So this is a visual sound box, not just an audio sound box.
That's huge. That is a biggie. It's on
Gold Class Clear Glass. पार हो या नियर, सब कुछ दिखे clear.
Whenever a film sank in 2000s, it was always flop actor. मेरी तरफ नहीं देख रहे, देखो तो सही. I compare an actor's career like the stock market. Sometimes your stocks are low, right? And when your stocks are low, no one's buying. Sometimes your movies do well and your stocks are on the rise and everyone's suddenly buying that stock.
What point do you think that the film career perhaps is not going the way that you thought?
Itch of wanting to be an entrepreneur started itching a little more and I wanted to scratch it.
One of the most important lessons is to know when to pivot.
The burn was far more than the earn. We were burning and I was watching my money just go out and like, oh my God, what's going on here?
Welcome, you're watching Market Express and I'm your host Himakshi Bahugna. Now let's get straight to the show. US benchmark indices end lower as tariff storm takes over the globe. The Nifty drops 1% to end below 23,000 levels, whereas Sensex drops over 900 points to end below 75,400 levels. Broader market bleeds underperform benchmarks. All sectoral indices bleed in tandem with the Nifty. Metals melt under tariff heat. Pharma weakens 4% on hint of tariffs. IT, Realty and PSU banks follow. Rupee strengthens by 20 paise to 85.25 levels. This comes as the dollar index and oil prices dropped sharply amid concerns over the impact of US tariffs on the economy. CLSA downgrades Tata Motors to outperform, cuts target to 765 rupees, says FY26 will be a year of demand rebasing in US led by increased tariffs. CLSA also says that demand elasticity will impact JLR's FY26 volume in US due to tariff hikes. JP Morgan is cautious on the IT sector, says the chances of FY26 being a complete washout are rising. List its top picks as TCS, Infosys, HCL Tech. CLSA says that these companies pay out most of their free cash flow and profit after tax to shareholders. Ashok Leyland expects medium and heavy commercial vehicle segments volume to grow in double digits in first half of FY26. Overall, the MHCV growth for FY26 growth seen around 6 to 7%. At the analyst day, Ashok Leyland says that the truck cabin AC norm will increase vehicle prices by just 1%, but hopes for regulatory headwinds for commercial vehicles to surpass in the next 5 years. The pharma sector sprung to cautious mode after the US President Donald Trump hints at tariffs on the healthcare sector. Says the pharma tariffs will be at level which you haven't seen and will be a separate category. However, tariffs on the pharma sector will be difficult to levy. The value of US drug imports was at $170 billion in 2023. India exports pharmaceuticals goods worth around $10 billion to US. Indian exports contribute around 6% of the US pharma imports. The reason why the pharma tariffs won't work is because healthcare is not discretionary spending. Now, supply chain is quite elongated and complex. Large capacity buildings can take a decade or long. Aditya Birla Fashion hints at strong growth. The next 5 years will be about organic growth. No further merger and acquisitions. The company says that it does not want to do any further fundraising and drive profitable growth. The company targets to double revenues in 5 years, whereas expects to be a debt-free in 2 to 3 years. L&T Finance slowed down after retail disbursements for quarter 4 of FY25 were 14,870 crore rupees, registering a degrowth of 1.16% compared to 14,531 crore rupees recorded in quarter 4 of FY24. L&T Finance offers financing for two-wheelers, consumer goods, homes, farm equipment, women entrepreneurs, rural groups, real estate and infrastructure. Bandhan Bank, on the other hand, reports strong loan and deposit growth in quarter 4 business update. The lender informs the exchanges of its strong loan and deposit growth. Now, the company has seen as much a needed shrink in loan to deposit ratio, whereas return of the CASA growth. RBL Bank reports a 7% rise in total deposit to 1,10,942 crore rupees as on March 31 of 2025 against 1,03,494 crore rupees recorded the year before. So the bank continues to focus on growing the share of granular retail deposit in the overall deposit mix, with deposits below 3 crore rupees constituting approximately 49.8% of the overall deposits of the bank as of March 31. Yes Bank's gross advances grow 8% year on year to 2.47 lakh crore rupees. Now, deposits grew 2.6% quarter on quarter, up 7% year on year to 2.84 lakh crore. LIC issues clarification denying any preferential treatment by the Indian government or regulators after the United States Trade Representative reports acquisition regarding sovereign guarantee to LIC. Currently, the Indian government maintains an explicit sovereign guarantee on every life insurance corporation policy, stated that the USTR report. Now, as a result, many customers choose to buy LIC policies over those offered by private insurers, giving LIC an unfair competitive advantage, it said. Less than 2 years after being onboarded to 361 WAM for starting its global unit, veteran banker Vikram Malhotra has resigned from the firm, along with 10 other private bankers who were a part of his team. People aware of the matter told NDTV Profit. Malhotra and his team working for 361 Global were based out of Dubai and Singapore. All of them are now on gardening leave and will be leaving in another 3 months, the above mentioned people said on the condition of anonymity. HSBC initiates buy on Ventive Hospitality. The brokerage firm says that the hospital is catching up quickly with peers, with 11 hotels across India and Maldives and 4 annuity assets in Pune. HSBC highlights the underperformance of the hospital, highlights the strong balance sheet and healthy free cash flow as key strengths. Goldman Sachs maintains a buy on Zomato but slashes the target to 310 rupees. Goldman expects the company to remain one of the fastest growing internet firms, sees some tailwinds in near term, expects a positive impact of tax cuts starting FY26, says the risk to do food delivery margins are on the upside. Benchmark crude slips below $70 per barrel again. Now this has an impact on the margins for oil and marketing companies. Lower crude prices could lead to higher marketing margins. Now, whereas fuel margins could continue to trend at higher levels. Metal stocks feel the heat, hit over 5% intraday. Some metal stocks have lost as much as 6%. Now, metals are a large contributor to the FY26 Nifty EPS. The sector is now vulnerable with new capacity coming in and amid chances of lower prices. Morgan Stanley downgrades Bharat Forge to equal weight from overweight and cuts target to 1,170 from 1,366 rupees. Now says US challenges offset gains in defense segment, highlights the scaling up of its non-auto business well. Registering 58.5 in March, the seasonally adjusted HSBC India Services PMI Business Activity Index was comfortably above the neutral mark of 50 and indicated a sharp rate of expansion, stated a press release on Friday. Although below February's reading of 59, the headline index remained above its long-run average of 54.2. Meanwhile, the HSBC India Composite PMI Output Index increased to a 7-month high of 59.5 from 58.8 in February to signal another month of above-trend growth. In an NDTV Profit exclusive, we learned that Maharashtra government has served notice to Ola Electric and sought explanation on stores operating without trade certificates. Maharashtra Transport Department sends letter to Ola Electric on 31st of March 2025. The letter sought explanation from Ola Electric on stores operating without trade certificates. Ola Electric had 3 days to explain why this action shouldn't be taken against it over violations. Now, an email has been sent to Ola Electric for a comment on the matter. Zepto co-founder Adit Palicha responds to Commerce Minister Piyush Goyal's jibes at the Startup Mahakumbh. In a post on platform X, he says, and I quote, "It's easy to criticize consumer internet startups in India when compared to deep technical excellence being built in US or China. Zepto brings over 1,000 plus crore tax contribution to government every year, has brought $1 billion of FDI brought into the country. Now, India doesn't have large-scale foundational AI models because we still haven't built great internet companies." End of quote. Broking firm Angel One's gross client acquisition fell on a month-on-month basis in March 2025 for the third straight month. Now, on a month-on-month basis, Angel One's gross client acquisition fell 2.2%. On a year-on-year basis, now it's down 43.6%. Angel One reported a 2.8% month-on-month rise in the number of orders at 10.2 crore. Now, the market share in both retail and F&O has fallen. Jefferies says that reciprocal tariff announcement come across as a relief. Says they see no incremental adverse impact on the large exporting sectors, adds that 27% tariff on India is looking reasonable from a relative perspective. Now, the key risk to view is a prolonged global risk-off. UBS maintains sell on IndusInd Bank and cuts target to 600 rupees from 770 rupees. Says the bank has weak visibility into a likely very challenging year. Speaks about multiple overhangs to drive further derating for the stock. UBS adds that IndusInd's deposits flow, new CEO and external auditor report will be key signposts. UBS upgrades Bank of Baroda to buy from neutral and hikes target to 290 rupees from 270 rupees. The upgrade to buy comes on stable outlook and attractive valuations, whereas the net interest margins will witness relatively lesser pressure versus private peers. UBS upgrades State Bank of India to neutral from sell and hike target to 840 rupees from 760 rupees. Says the bank's risk reward is balanced and net interest margins sustained are key for re-rating. Siemens Energy has set the record date for demerger on April 7th, 2025. The Siemens Energy will be a separately listed entity and the demerger ratio is set at 1:1. Now, which means Siemens Energy's constant price will be determined on Monday. Union Bank tumbles after the bank missed its loan growth and deposit guidance for the financial year 2025. The bank's domestic deposit as on March 31st rise 7.5% to 12.7 lakh crore quarter on quarter. Now total global deposit as on March 31st rise 7.7% to 13 lakh crore rupees. SpiceJet has introduced daily non-stop flights between Delhi and Kathmandu, set to begin operations from May 10, 2025. The announcement was made on Friday and marks the airline's first new international route following its successful qualified institutional placement, that is the QIP, it said. Motilal Oswal reiterates buy stance on Prestige Estates, revises target to 1,725 versus 2,040. MOSL hails the company's strong pipeline to result in 1.5x growth in pre-sales, expects pre-sales growth of 14%, of FY24 to 27. IEX says that quarter 4 electricity volumes rose 18% at 31,747 million units. On the other hand, the company's renewable energy certificate trade multiplies 108% to 68 lakh year on year. MK wants investors to brace for volatility as Trump tariffs were more than severe than expected. Now says the tariff announced are a pivotal turning point from EM assets in the coming months. Adds that disruption and larger drag from uncertainty increase recession probability. Karnataka will implement a 5% cess on aggregator platforms, including Amazon, Flipkart, Ola and Uber, to establish a gig workers fund, Chief Minister Siddaramaiah said on April 3. The platforms will pay a 5% cess of the total payout to gig workers. The state government will provide additional funds to support welfare schemes for gig workers, Siddaramaiah said in a post on X. Ola Electric launches Hyper Delivery, an initiative that is focused on offering same-day registration and delivery of vehicles in the country. Now, the pilot program has been commenced by the EV manufacturer in Bengaluru and will be expanded across the country in phased manner in the quarter. Veteran Indian actor and film director Manoj Kumar, who was widely known for his patriotic films, died at the age of 87. Having a nickname Bharat Kumar, he died at Kokilaben Dhirubhai Ambani Hospital. PM Modi arrives in Thailand for a 2-day visit to attend the 6th BIMSTEC summit, where he was warmly received by the Deputy Prime Minister and Minister of Transport. Now, in his departure, he says that the BIMSTEC has played a crucial role in advancing regional development, connectivity and economic growth in the Bay of Bengal region over the past decade. After the implementation of tariffs on the countries, Donald Trump has said that he's open to negotiate on tariffs if the offer is phenomenal. With its funding and bilateral efforts, the Quad grouping is facilitating the delivery of relief supplies, deploying emergency medical teams, and supporting humanitarian partners working in Myanmar to provide care for those affected by the earthquake. Falcon 9 lifts off from Pad 4E in California, delivering 27 at Starlink satellites to the constellation. This single booster has launched 3 missions with 3 different payload types in just over 3 weeks. Kolkata Knight Riders defeated the Orange Army Sunrisers Hyderabad by 80 runs. Playing at their home, KKR put up a score of 200 runs and restricted the visitors at 120 runs. Viewers, with that, it's a wrap on Market Express. Stay tuned to NDTV Profit as there's more lined up ahead for you all.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ.
Whenever a film sank in 2000s, it was always flop actor. मेरी तरफ नहीं देख रहा. देखो तो सही. I compare an actor's career like the stock market. Sometimes your stocks are low, right? And when your stocks are low, no one's buying. Sometimes your movies do well and your stocks are on the rise and everyone's suddenly buying that stock.
What point do you think that the film career perhaps is not going the way that you thought.
Itch of wanting to be an entrepreneur started itching a little more, and I wanted to scratch it.
One of the most important lessons is to know when to pivot.
The burn was far more than the earn. We were burning out. I was watching my money just go out and like, oh my God, what's going on here?
He sold most of his stock, 80%, as on that date.
We have requested the management to come and speak to us. They asked us, what questions will you ask? We've sent it to them. They don't want to answer it, so then let's put it to our viewers as well.
7 key questions, right? How is it that 2,000 crore goes unnoticed by all of these auditors?
Is seeking more information on the trades and the all the transaction which has happened from the exchanges, both NSE and BSE.
The Reserve Bank of India's supervisory officers, they are seeking compliance reports on their foreign currency borrowings by these banks.
The DSS is actively engaging with the Reserve Bank of India to sort of ensure the thorough examination of the matter. And
IndusInd Bank, as part of its internal review, had found that certain aspects of its derivatives portfolio was not meeting the standard that was set by the Reserve Bank of India.
Real estate might look to sell their paper business to ITC. So that would be an interesting deal, not too big for ITC but from AB Real Estate's perspective currently.
On the 20th, he reported this in his segment Heard on the Street, which runs at 2:30 p.m. every day.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
He sold most of his stock, 80%, as on that date.
We have requested the management to come and speak to us. They asked us, what questions will you ask? We've sent it to them. They don't want to answer it, so then let's put it to our viewers as well.
7 key questions, right? How is it that 2,000 crore goes unnoticed by all of these auditors?
is seeking more information on the trades and the all the transaction which has happened from the exchanges, both NSE and BSE.
The Reserve Bank of India's supervisory officers, they are seeking compliance reports on their foreign currency borrowings by these banks.
The DSS is actively engaging with the
The tariff shock rattles global markets. The tariff storm sends equity markets worldwide into turmoil, snapping a two-day winning streak. The Nifty lost its grip on the crucial 23,000 mark, while the Sensex plunged over 900 points, closing below 75,400. Meanwhile, sources say India will not take a knee-jerk reaction to the tariffs and will instead focus first and foremost on finalizing the bilateral trade agreement as early as August. Meanwhile, countries begin their counter-attack on tariffs. China announces an extra 34% tariff on US goods, additionally adds 11 US companies to the unreliable list. After a very brief reprieve, Nifty Pharma drops as much as 4% after US President Donald Trump signals never seen before tariffs on the sector. And the Maharashtra government serves a notice to Ola Electric to explain within 3 days why some of its stores in the state are operating without trade certificates. This comes 2 weeks after NDTV Profit reported that the Maharashtra Transport Commissioner had directed all RTOs to conduct a special inspection of all Ola Electric stores for trade certificates. Startup founders and leaders step up to defend India's startup ecosystem after Union Minister Piyush Goyal questioned its direction and focus. Good evening, you're watching Profit 360 on NDTV Profit and I'm Sanjana. For the next half an hour, we're going to bring you the latest in markets, but national and international news as well. So let's dive right into it, shall we? Let's take a look at what happened in the markets today. The tariff storm has rattled equity markets worldwide, breaking a two-day winning streak. All sectoral indices in India have plunged, dragging the broader market lower. Metals melted, pharma stocks weakened as investors brace for the impact of aggressive tariff policies. But to give us a complete wrap of the day's action, let me bring in my colleague Harsh.
Well, Indian markets reacting to Trump tariffs. Of course, we didn't see that reaction on Thursday, but Friday and last day of the week, and we saw a very sharp reaction in trade. What we saw, therefore, is we saw the Nifty down 1.5%. We breached 23K. We, in fact, in some form or shape, were able to hold 22,900. And that's the one positive. But outside of that, we saw FMCG and banks in particular doing okay in trade today. So they were able to hold up. The carnage, though, was, and a bulk of that was in the commodities space, where you saw the Nifty metal decline 6.5%. You saw IT stocks continue to face pressure, and you saw pharma as a basket really face pressure after Donald Trump's comment. So all of that leading to pressure on markets. The advanced decline was way out of shape today. We saw the advanced decline firmly in the negative camp. So the breadth of the market extremely weak today. We saw largely the Nifty mid-cap and small-cap indices also retreat sharply. 2.5%+ down on the Nifty mid-cap, the Nifty small-cap down 3%+. And that kind of skews the way the week has gone by as well. This is a huge impact on the way the week has gone by. When you're looking at all three indices for the week gone by, you'll see a bulk of the decline come from today's impact. Pharma largely had an okay-ish week overall, 2% lower, but 4% lower today really meant that pharma was one of those sectors which stood out in trade. In terms of certain stocks which did well, and HDFC or Bajaj Finance coming out with their quarterly updates, and doing decently well in trade. Tata Consumer was the other one that really stood out, along with some other consumption names. As I did mention, the Nifty FMCG was in the green. But otherwise, a relief that we are at the start of a weekend, and therefore you'll likely see the next reaction only on Monday. But food for thought. Sandeep Tandon doesn't think or is not as negative as the reaction has been on markets today. Listening to a slice of what he views in terms of how markets ought to behave. Listening.
I think I'm optimistic. This is the worst case scenario outcome we have seen. From here. It can only improve. So no point getting capitulated at this point in time. In fact, India actually behaved quite well as compared to global market yesterday. It showcased that India could be a hiding space as compared to what the turmoil you are seeing in the global market. And we also don't have to forget that India is a very large domestic driven economy. So our impact will be relatively less. And I always say, look at not only an absolute basis, absolutes are important, but relatives are more important. So relative to other markets, the tariff differential, we are beneficiary. So I think it's a great buying opportunity in a sector which you like, rather than getting too nervous about it at this point of time.
And more updates coming in. Sources are telling NDTV Profit that the Commerce Ministry is engaging with pharma exporters as concerns grow over the potential US tariffs on Indian pharmaceutical products. While marginal tariffs may be absorbed, higher levies could severely impact sector margins, given that India supplies nearly 40% of all generic drugs used in the US. Any tariff imposition could also drive up costs for American consumers. So for more details, let me quickly go across to my colleague Rishabh, who has more insights on this.
What we're hearing from Commerce Ministry sources is that they are in constant touch for support for these pharma exporters. For any sort of boost or export guidance that is required. There is a dedicated joint secretary for all matters related to pharma. Remember, India is known as the pharmacy of the world. There is a lot of generics that go out and are manufactured right here in India and go out to the US as well as parts of Europe. About as much as about 40% of all generic drugs in the US are actually made in India and exported to the US. Anywhere between $8 and $9 billion is the current worth of pharmaceutical exports that go to the US currently. What we're picking up from major industry voices of the pharma sector is that the margins are extremely tight given the sort of very high regulations that the US FDA also has, a very high level of regulations that they require, a very high level of maintenance of plants, of standards is required, which is very, very capital intensive. So already a sector that is a bit shy on margins, and if additional tariffs come in, then it's sort of a death blow for a lot of these pharma exporters. What we're also seeing is that a tariff imposition by the US would actually hurt US consumers themselves, given how life-saving drugs can be, how important drugs can be. Any sort of a tariff that might come in on India might be very detrimental to US consumers itself. We will continue to track this situation very, very closely.
Absolutely, Rishabh. Thank you so much. The government clearly trying to allay fears at home while also maintaining its cool and keeping a stance where they are not attempting any retaliatory measures anytime soon. But just a day after Indian Pharma was saved from the day's losses and emerged as one of the top performers yesterday, unscathed by the tariff announcements. We saw that change this morning after US President Donald Trump's never-seen-before tariff comment on pharma, signaling tariffs in the near future. Now, this announcement caused Nifty Pharma to drop as much as 4.3%. Varsha, my colleague, now giving us a roundup of what happened in the markets today as this fresh warning raises key concerns around price increase for the generic medicines in the US, drug shortages, rationalization in low-margin products, and supply chain disruption that are obviously back on the investor radar. Is that not right, Varsha?
So yes, Nifty pharma index is actually down now. Why? Because Trump says that pharma tariffs are coming soon in near future, and he clearly said that pharma tariffs will be at level which we haven't seen, and pharma will be a separate category. Now the important point over here. So if you see a lot of every stock, you take a name, Gland Pharma, Aurobindo Pharma, Dr. Reddy's, Cipla, and all the pharma stocks are actually down on the back of this news. Now the important point is, would it be rational to impose tariffs on pharma and generics? Let's see, the value of US drug imports was almost $170 billion in 2023. India exports pharmaceutical goods worth $10 billion to US, which contributes 6% of the US pharma imports. If I want to talk about generics provides more than $400 billion in annual savings to US healthcare sector. So clearly this seems that it's actually not possible or not rational to put tariffs on India when US is so much dependent on India when it comes, and even on other countries when it comes to pharmaceutical products. Even for China, PII data shows that there was exports of $2 billion from China to US in 2023. Now, why? The important point is why tariffs on pharma will actually not work. One is healthcare is actually not a discretionary spending, and supply chain is quite elongated and complex. Even if Trump says that come to US and put up facilities, it would take 4 to 5 years to put a facility and start running. So that's not viable to do that. Large capacity building can actually take a decade or longer. Now let's talk about which are the top pharma products exporting countries to US. Starting with Ireland, in 2023 it exported almost 28%. If you see, Germany exported 21% of pharmaceutical products to US. India exported 11%, and the other categories fall at around 50%.
Yeah, so I think there have been comments that we'll see the pharma sector coming under tariffs very soon. So basically that review should not take long, and we'll have tariffs on the sector, and probably at levels not seen before. So that's the comments. Those are the comments that we are hearing on the sector. But I think I'll kind of reiterate my view on this. So I think even if tariffs are imposed on the sector, they will be inflationary, and so I would divide this space, pharma space, into 3 categories. One is the commodity generics, wherein I think tariffs will be passed to the consumer because there is no space for Indian companies to absorb. Neither is there are capacities in the US to replace the Indian demand that's coming, Indian supplies that is coming. So broadly, that's where I am on the commodity generics. Then there is a second part to the business, which is high value generics, like those of drugs like Revlimid and others. So I think on those we might see some impact, but the dependence is not very large as of now. So I don't think that will create, that is something we need to worry about in terms of the numbers that can basically it will not dent the numbers basically too much. And the third is the NCE portfolio. I think the only company there is Sun Pharma, which I think even there the impact should not be more than 1 to 2% of their overall net profits. So.
And while pharma was the only ongoing basket that rallied the previous day, as the White House's fact sheet suggested the sector was exempted from April 2nd tariffs, earlier in his Liberation Day speech, Trump clearly stated that the US can no longer produce antibiotics to treat its sick population, calling it a significant problem for the country. Let's listen in.
Chips and pharma tariffs are not on the table. Starting very soon. The chips are starting very soon. The pharma is going to be starting to come in, I think, at a level that you haven't really seen before. We are looking at pharma right now, pharmaceuticals as a separate category, and we'll be announcing that sometime in the near future, not too distant future. That's under review right now.
We import virtually all of our computers, phones, televisions, and electronics. We used to dominate the field, and now we import it all from different countries. A single shipyard in China now produces more ships every year than all of the American shipyards combined. Think of that. And it was a business that we used to dominate. We used to dominate it totally. In short, chronic trade deficits are no longer merely an economic problem. They're a national emergency that threatens our security and our very way of life. It's a very great threat to our country. And for these reasons, starting tomorrow, the United States will implement reciprocal tariffs on other nations.
And while tariffs continue to cause volatility in major economies, India is one of the few that has chosen to keep its cool. Sources have told NDTV Profit that India is prioritizing the finalization of its bilateral trade agreement with the US rather than taking any retaliatory action on tariffs. Sources added that certain tariff reviews are part of ongoing trade talks, which India hopes to conclude as early in August, effectively making that deal the fastest bilateral agreement finalized in just 6 months. And more updates coming in. Trade tensions between the US and China have escalated once again as China is going to impose an additional 34% tariff on all US goods starting April 10th. Beijing has also added 11 US companies to its unreliable entities list and introduced export controls on certain rare earth related items. Now, this is clearly a retaliatory move, with China filing a lawsuit with the WTO over US reciprocal tariffs. My colleague Pallavi now joining us from the newsroom with more updates on this. Pallavi, first take us through China's retaliatory actions, and if you could, for our viewers and for me as well, explain what an unreliable list actually entails and means.
Right, Sanjana. So like you've mentioned, China has just announced that it will impose additional tariffs of 34% on imports from the US. That's in retaliation for the duties of about the same amount that have been imposed by US President Donald Trump about a day back as a part of his very aggressive trade agenda. The Ministry of Commerce of China has said that the tariff will be imposed on all imported goods originating from the US from April 10th. Now, levies on Chinese exports are set to rise to more than 60% after US President Donald Trump's announcements of reciprocal tariffs of 34% that came on existing tariffs that the US had already announced previously, and the rate will be on top of the current applicable tariff rates in case of China as well. Along with that, of course, the Chinese Commerce Ministry has also announced restrictions on some of the rare earth related items. The Commerce Ministry has also added 16 US entities to its export control list. Now, these export controls are on some medium and heavy rare earth items. China has also started an anti-dumping probe on medical CT X-ray tubes imported from the US as well as from India. It has also said that it is halting imports of poultry products from 2 US companies, and it has added 11 US companies to its unreliable list, along with the 16 companies on export control list for dual-use items. Now, this is, of course, an evolving situation. We are seeing several economies talking about retaliatory tariffs after US President Donald Trump has imposed tariffs, and we will continue to bring more updates as and when we have any.
Thank you so much for that update, but also just, give me a sense of how do you think, or how can we expect the US to respond? Do you think that we could see further retaliatory measures? And also, is there room for negotiation, or are we heading now for a prolonged economic tension to actually take place, given that this is slowly but aggressively becoming a full-blown trade war? Let's also remember that Donald Trump just earlier this morning had actually given another very cheeky soundbite, as he usually does, about whether there is room for negotiation. And he very explicitly referred to the TikTok deal. So wondering whether that's still on the cards, and what could be the potential strategy for both economies moving forward. board?
Right, Sanjana, that's a good question. So, at the moment, from what we're gathering, every country sort of has its own strategy in how they want to tackle the situation going forward. Now, like we've been discussing, in case of India, the Indian government appears to be of the view that retaliatory tariffs might not be the best course of action in the given scenario and has instead opted to negotiate with the US government. In case of China, that is clearly not the case. As such, negotiations and how they pan out, when they take place and what the result of those negotiations are appears a tad more bleak in case of economies like China, since they have outright decided to impose retaliatory tariffs. But what we've been gathering from the economists and trade experts we've been speaking to is the fact that every time a country, especially major economies such as China, are taking these measures, the downside risks to these domestic economies as well as on a global front is definitely on the rise. Now, there's going to be obvious repercussions from a domestic perspective, but clearly with every instance of a country imposing retaliatory tariffs after what the US has done.
Sure. Pallavi, sorry to cut you off, but I'm also being joined on the phone right now with Richard Harris of Port Shelter Management joining us on the phone line. Richard, thank you so much for your time. We're looking at retaliatory measures coming in from other major economies. China, not the one to step down. Pallavi and I were just discussing this, but I'm going to pose this question to you. How do you expect the US to respond? Are we going to see further retaliatory measures?
I don't think so. I think certainly with China, the US has gone about as far as they can without saying, okay, let's have 100%. No, I think that China's playing a waiting game. They are the one country that can stand up to the US and basically just eyeball them. I mean, can you imagine the difficulty that Apple is in, maybe with having 60 or 70% tariffs on their iPhones? That's going to cause a bit of a row in the US. So I think China is now also playing the bluffing game. And what we've seen with Trump in the past is that if somebody stands up to him, he normally backs down. But it's difficult to exactly say how this is going to happen. If we're looking at the markets, I think that, we're seeing a down day today in Europe. The US is going to be very important. Are people going to start selling? Are people going to start getting worried about deleveraging? What exactly is going to happen? And I think the weekend is going to be very important to see what kind of sentiment is going to come through for Monday morning.
Richard, besides that, I think also the question on everybody's minds, especially in America and China, is how will this affect consumer prices in both the countries?
Well, it's got to be inflationary. I mean, China won't be too worried because they've needed a bit of inflation for a while. But, the US, I think, is in a very fragile position. Rates are already, on the high side compared to where they have been maybe over the last 8 or so years. And the Fed will have to make a decision. Are they going to put rates up to curb inflation, or are they going to have to put them down to deal with a slowing economy? And my guess is that what we're going to see is that interest rates falling will win because the Fed doesn't want to be accused of stalling the economy. So we could see a position where bonds might do okay. Rates come down. However, that means that inflation will remain high and probably stubbornly high unless we get a real recession coming in.
Richard, my last question to you before I let you go. Do you think that this could push US companies to diversify supply chains away from China?
It's very, very difficult to do that. I mean, don't forget they are already. There are a lot of companies moving into India, Vietnam. I mean, Vietnam, of course, is now doubly hit because it has very high tariffs against them. I think it's just very difficult. If Trump is sort of saying, okay, build your auto plants in the States, he's probably going to be 90 if all those auto plants are actually working. So it's just not going to happen. And I think what we're seeing now is an exercise in futility. He's tried the old New York real estate bluff. It's not going to work. It may work with the UK. It may work with isolated countries in Europe. It's not going to work with China, and it probably won't work with India. But I think India will stay back and just watch the fun and see what everybody else is going to be doing.
Richard, India is not one to retaliate at the moment, definitely keeping it cool. Thank you so much for your time. Remember, China retaliating as hard and as large as 34% additional tariff on US goods. Let's take a listen in to what US President Donald Trump indicated earlier this morning with a willingness to negotiate tariffs if other nations provide something phenomenal in return, is what he said. He emphasized that tariffs are not merely about protectionism, but serving as a strategic tool in trade negotiation, and wondering whether that still stands true. Let's listen in.
It depends. If somebody said that we're going to give you something that's so phenomenal, as long as they're giving us something that's good. For instance, with TikTok as an example, we have a situation with TikTok where China will probably say, we'll approve a deal, but will you do something on the tariff? The tariffs give us great power to negotiate. Always have. I've used them very well in the first administration, as you saw, but now we're taking it to a whole new level because it's a worldwide situation. And it's very exciting to see.
All eyes on what other major economies will do. Let's shift focus to what's happening now in Maharashtra, where the government has now issued a notice to Ola Electric Mobility Limited demanding an explanation within 3 days for why some of its stores are not operating without a license. Now, this action follows a directive from Maharashtra Transport Commissioner, if you remember, had ordered all regional transport offices to conduct a special inspection mission on March 21st to verify compliance across Ola Electric stores. My colleague Tushar now joining us live on the story. Tushar, we have been tracking this story relentlessly. Give us the latest that we know. We understand now sources are telling you that the Maharashtra government has clearly upped the ante and asking now for a reason as to why these stores are still functioning, and that too within 3 days.
Yeah, hi. Good evening. So essentially the story has been panning out for almost a month now. All the what has been found so far in multiple states is that Ola Electric stores are operating without trade certificate, which is mandatory for operating a dealership as well as service center. It's the TC number, the trade certificate TC number is what is issued with a vehicle when you are actually going to purchase it. Now, most of the action, what we have seen so far, the highest number of actions has come through from the Maharashtra Transport Department. The Transport Department has first of all raided Mumbai and Pune stores, and following which a few vehicles were confiscated. That expanded to a special inspection mission to all the stores in the state. After that, on 31st March, a new notice was issued to the company, which essentially meant that the company has to now actually respond to the company about to the Maharashtra government about why their stores should not be shut down for the lack of a trade certificate.
Absolutely, Tushar. Thank you so much for bringing us those updates. Maharashtra clearly cracking down now on Ola Electric. We'll continue bringing you the latest developments. Moving on, this month, the Adani Group's Mundra port became the first Indian port to handle over 200 million metric tons of cargo. My colleague Agni was there on ground to get you a special ground report from India's largest port operation.
In the desolate, forgotten edges of Gujarat, where India shares a border with Pakistan, clean energy is being generated. Enough clean energy to power all the homes in Canada, Poland or Spain. Adani Green's Khavda Park is the world's largest renewable energy project with a mixture of solar and wind energy.
This was a land until a few years ago that was barren in every meaning of the word. No plants could grow here, no animals could sustain here. The nearest village, the nearest sign of human population is at least 80 kilometers away. But this is the place which was perfect for a renewable project. Winds of up to 8 kilometers per hour, solar radiation which are as high as those seen in Ladakh made this region the perfect spot to establish wind and solar plants.
The Khavda Park covers 538 square kilometers. That's almost as big as Singapore.
So far, Kavda has commissioned 4.6 gigawatts of power and expects to reach 30 gigawatts by 2029. The scale of everything in Kavda is extreme. Even the windmill turbines, which have a capacity of over 5 megawatts each, as compared with 3 megawatts in regular windmills.
The company says that the park is 5 times the size of Paris, and which is about the same size as that of Mumbai. Now, if you think about it, the company repeatedly claims that this project can be seen from up in space.
Back in Kavda, though, the park is expected to power 1.6 crore homes. This clean energy is equivalent to the carbon offset of 300 crore trees, or taking 1.4 crore cars off the road. In the remotest corner of Gujarat, the future of energy is taking shape.
Whenever a film sank in 2000s, it was always flop actor. मेरी तरफ नहीं देख रहे हैं. देखो तो सही. I compare an actor's career like the stock market. Sometimes your stocks are low, right? And when your stocks are low, no one's buying. Sometimes your movies do well and your stocks are on the rise, and everyone's suddenly buying that stock.
What point do you think that the film career perhaps is not going the way that you thought?
Itch of wanting to be an entrepreneur started itching a little more, and I wanted to scratch it.
One of the most important lessons is to know when to pivot.
The burn was far more than the earn. We were burning and I was watching my money just go out and like, oh my God, what's going on here?
He sold most of his stock, 80%, as on that date.
We have requested the management to come and speak to us. They asked us, what questions will you ask?
Hello and welcome to this very special edition of KYC, Know Your Company. Today we're going to break down, analyze Bajaj Auto. We're going to start off with obviously trying to understand exactly what Bajaj Auto does. I'm going to start off by telling you all that it's of course the flagship company of the Bajaj Group, manufactures two-wheelers, three-wheelers, and it does both passenger vehicles within that two-wheeler pack to consumers, as well as in the CV space, it does three-wheelers as well. So wide variety in terms of product suite. You're looking at some of the brands that it operates. KTM through its ownership of the KTM brand, through the Austrian brand, which is KTM. But outside of that, pretty much all brands are in-house and developed in-house. Chetak, of course, EV being one of the newest brands that they've launched within the EV space, and quickly gaining market share, that one. This is how the overall sales have stacked up for FY24 versus FY25 full year. Of course, now we have full year numbers in terms of sales. Looking at 7% overall, but look at domestic, it's just 3%, and that's where some of the softness in terms of the numbers have crept into in terms of the company as a whole. The two-wheeler export market on a low base has done around 13 to 14%, which is okay. It's a low base, and therefore you would expect something better from it. But at least FY25 numbers, okay. This is the place where it's been slightly soft, the operating metrics, where Bajaj Auto is concerned. But I want to try and highlight some of the verticals and the pillars of Bajaj Auto. One, it has a 100 to 110 cc segment where it runs the Bajaj CT and the Platina brands, 125 cc and above. It has Pulsar, KTM, Avenger, among others. And then it has Pro Biking as well as Triumph. So those are some of the other brands that it runs, Bajaj Auto. It also does three-wheelers where it has a 75% plus market share. Exports as well is fairly large for it. It does exports in 80 countries worldwide. Mexico, Peru, Ethiopia, Turkey, Saudi Arabia are just some of them. You also have a Bangladesh and a Myanmar and an Afghanistan as part of that pack. It's also ventured into Latin America. So Africa, Latin America now being the big focus areas. And we will also have a conversation with the management, Mr. Rakesh Sharma, Executive Director, to talk to us about what the outlook is like going forward with regard to a Bajaj Auto. But let's quickly look at what are the metrics that we'll be tracking for this particular company. We're going to start off, of course, with the four basic ones: income statement, balance sheet, cash flows, shareholding and return ratios. Those are the five basic ones. Thereafter, we'll look at street cred, street coverage, and we'll also look at the valuation picture. And joining me today to break this one down is Puneet Javeri. Welcome, Puneet. Let me allow you to start off with the income statement. This is home turf for you.
Yeah, well, definitely, and it's a very strong income statement. The company has over the last 5 years. We've definitely seen post-COVID the strong recovery in financials after that blip in 2020. So, revenues of FY24 was about 44,000 crores for the company. It's grown at a strong CAGR of 17% over the last 3 years. EBITDA has also kept up pace, much higher, 21% growth for the company, while on a profitability basis, it's more than 7,400 crores of profits generated in the last year. That momentum has continued in this particular year as well, and profits have grown at a CAGR of about 18%, Harsh, overall. So definitely it's a flagship brand, much known about the company, but definitely a very big financial gain for the company, essentially very positive on that aspect.
Yeah, they've done well on profitability as well, right, Puneet? Clearly a thumbs up, 2,000 crore plus of PAT. They also do 20% plus of margins, which is very, very healthy for an auto two-wheeler and three-wheeler maker. And they've also to some extent signaled the larger focus on profitability versus going only for top line and volume growths. That's basically what they've signaled. And therefore, compared to peers, this one is doing something slightly more differentiated in that sense. So something to be kept in mind. Let's quickly look at the balance sheet as well. No concerns here whatsoever, frankly. It's a net debt-free company. It's got nearly 2 lakh crore plus of market capitalization, and thereafter being net debt free and generating strong free cash flows means that debt is not a concern, at least at this point, and therefore clearly a thumbs up on this count. No concerns. Puneet, cash flow.
Well, cash flows also kept up pace very strongly. The cash flow from operations for FY24 was roughly at 6,500 odd crores. And when you compare it over the last 3 years as well, it's been very well at 28% CAGR. This is despite, the new EV brand of Chetak launched in the two-wheelers. They've also launched the electric three-wheelers as well. And while on an EBITDA margin basis, it's not helped growth because the two-wheeler business has been growing, but they've maintained the EBITDA margin at 20%, and that has flown to the cash flow as well. The net cash flow number as a whole is coming at 319 odd crores. It's 11% CAGR, Harsh, on that aspect. But overall, both income statement and balance sheet doing very well, and that's flown into the cash of the company as well.
Absolutely. I'll quickly take you through shareholding as well. Thereafter, we'll also look at return ratios. But in terms of shareholding, you're looking at promoter holding at 55% currently cumulative. Mind you, there's been a buyback as well, and therefore actually promoter holding has only gotten better, and that's one key positive. Bajaj Holding is the key promoter, of course, promoter entity. 34% is what Bajaj Holding holds. It's been this way for the last at least 7 to 8 years, and therefore what you're seeing is good strong promoter ownership continuing, and intent of the promoter as well to continue to hold. You have then Jamnalal Sons Private Limited, which is one of the other entities, which holds around 9.3%, and a Maharashtra Scooters, which is also a listed entity, holds around 2.5% of the company at this point. And then there are, of course, smaller shareholders within the promoter group. But overall, it's a very, very strong promoter holding, and it's a well-held, closely held company in that sense, of course, of the Bajaj group. So unlikely that this will change significantly. A clear thumbs up on this one. Return ratios, Puneet.
Well, definitely. We've seen very strong return ratios for the company. Return on equity more than 30% for the company in FY24. And, that's reflective of the strong profitability that's flown into return ratios as well. Return on capital employed, and that's very key for this company, more than 28.8%, and that's actually improved to 30% in the 9 months of FY25, Harish. So no complaints here as well. It's a big thumbs up on this aspect as well.
Okay. Let's go across to street coverage then, Puneet. So that's how it really stacks up in terms of street coverage. Is fairly healthy coverage in that sense. But just in terms of upside, there are analysts on the street, Puneet, which believe that a TVS, an Eicher, and other auto stocks look far more attractive than this one. And yes, therefore we call this a neutral, even though it's very, very well covered. It being a Nifty 50 stock, in that sense, it's very, very well covered. But nonetheless, we'll call it a neutral. 66% buys, and of course the upside being 20%ish. But there are much better opportunities out there, as per what analysts seem to suggest in this segment. But you want to take us through street cred?
Yeah, and definitely, just one comment, because Eicher as well as TVS, they both have, so TVS has a scooter portfolio, and that segment has been growing very well. And I think hence it is much overvalued, and we'll get to valuation there. And Eicher specifically, it's tapped the export market for the first time this year. They've crossed 10 lakh, and hence I think the growth aspect there is much higher. Hence, your specific point of 66% buy calls, and that's why still a neutral. The street coverage, though, we've seen a strong return potential. 277% has grown in the last 5 years specifically. Compared to the Nifty, it's at 180%, and dividend yield has also been 1%. But I think we were speaking about this before as well, because if you remove the March first part of the March, if you take it from March 1st, I think the return hasn't been as high as expected.
Yeah, I mean, when you pull it back a couple of months, because of course 5 years exactly will mean the lowest of lows of COVID.
Yes.
Therefore, is that fair to look at returns from the lowest of lows of COVID? Maybe not.
Yeah.
But if we were to look at it, say from 1st of February, the returns it's been a 2.5 bagger in the last 5 years, which is fairly satisfactory. But what we've seen is that it's underperformed the index marginally. And therefore, what you would therefore believe is that maybe a better performance. And the second piece, Puneet, which you kind of highlighted to me, is that some of the other players, like a TVS, have done phenomenally well in the same period of time.
Yeah, I think TVS has grown 8x in terms of share price performance in the last 8 years, and right now around 2400 is where TVS is. That's fallen from 3200, so it was much higher there. Similar with Eicher, if you just count on this metric, it's around 320%, so 3.2x bagger in that aspect. So,
but even this one's fallen nearly 30%.
Nearly 30%,
right? So,
yes, definitely. And
so that is to match
TVS, yes. So, but on this particular metric, we've seen the other two, Eicher as well as something. And while they have outperformed Hero MotoCorp definitely in terms of growth and share price performance, I think that is one key thing to highlight as well.
Fair point. And what about valuations, Puneet? You're the best to drive that.
Well, valuations was tricky to say the least, Harsh, essentially for this in the two-wheeler space, because we've seen TVS being a key outperformer with 37%, 37x,
FY26
price
to earnings.
And Puneet, sorry, but each of these cater to a very different market.
Each
of them have very different priorities in terms of how management looks at the market as well. So sorry, yes, please.
No, definitely, because for Aisha specifically, we've seen the export market growing very well in this year, and it's 350cc and above, so it's catering to the premium market, and growth has been there in this year, and hence visibly there. For Hero MotoCorp, largely caters with the 100cc segment of the company. The growth has been largely absent, and now there are reports also that there is a lot of discounting happening, so might affect margins, and that's why it's trading at roughly half the, like more than 150% below something like TVS. And TVS is a complete product portfolio, multiple brands. They have 3 separate scooter brands, unlike Bajaj Auto, which has the Chetak already. But with Jupiter, with Ntorq, that market is growing very rapidly. Apart from what they have in Apache in the motorcycle segment, and now they've added Norton as well in the ultra premium segment. So I think that's where the valuation comfort is there, specifically for TVS. When you look at Bajaj, it has fallen from its, we've seen the 30% correction, and hence it's become more favorable. And now the Chetak brand has been doing very well in the EV segment, sales of about 2.3 lakhs. But we've given it a neutral basis on the higher growth prospects of TVS as well as Eicher Motors.
Right. If I can just ask you, and this is completely off the bat, FY27, would you have visibility on how these P ratios move, especially for the first two?
I think currently most analysts are penciling in, and are waiting for the management commentary in Q4, because the domestic market has fallen for 6 consecutive months for Bajaj Auto, and I think that's why the comparison is not available for FY27 specifically. But definitely, I think in that aspect as well, Bajaj might offer a very interesting opportunity going forward, because the company has a lot of cash. We've spoken about that. So I think eventually, once there's visibility on growth over the next year or so in terms of sales, I think those valuations become more attractive for Bajaj Auto.
And we've asked the management exactly that. So maybe we'll wait for that. But let's quickly look at how the rating parameters stack up in that sense. There you go. So income statement, balance sheet, cash flow, shareholding is a clean thumbs up on all 4. Also, in terms of street coverage, a neutral there. Street cred valuation, a neutral, but return ratios again very, very healthy, anything between 28 and 30%. That's how the KYC rating stacks up for a Bajaj Auto. Mind you, we do factor in that this is a Nifty 50 company, and therefore we factor that into the ratings that we give, and therefore you might see that compared to a benchmark, you will see a slight bit of more rigor with regard to how we give a rating on a Nifty 50 stock. You would have higher expectations from it as well. But let's look at SWOT, Puneet. The strengths being, there's very strong brand visibility. Chetak has been a brand for Bajaj Auto since the time me and you were born, and continues to be a very strong brand. So and Bajaj Auto therefore has had a very strong brand. I remember when I was a kid, Hamara Bajaj was the big ad, and that continues to be the case. But what they've done, and what really stands out for me here, is that they've been able to hold on to margins. A 20% margin for an auto company, which is also doing EV. Is commendable in that sense. And we've asked him the outlook with regard to that as well. So listen in. But in terms of weakness, two-wheeler market is seeing a slowdown. They're letting growth go. We spoke about the operational metrics. We gave that one a thumbs down. Remember, even though that's not part of the metrics in the KYC rating, but we did give it a thumbs down. And there's also a slowdown in the export market. It's starting to pick up. But what's the visibility like for FY26 is something which will hold the key. That's currently the weakness. But what are the opportunities and threats, Puneet?
Well, definitely, the new EV segment, the two-wheeler Chetak brand has been doing very well. It will look to build on to that growth. And we've spoken to the management about the growth aspect of the EV segment. They've also added the three-wheeler EV. Now they've relaunched a brand called GoGo, which will host essentially the three-wheeler business of the commercial vehicle side. That is a very interesting opportunity. And valuation versus peers, we discussed in detail. Currently, there's less visibility on the growth aspect of the domestic two-wheeler business. I think the export growth was absent this year, and hence we've seen that correction in the stock price as well. But overall, for the next year, they will have Africa come back, which is a big export market. They've added Latin America, Brazil capacity has been increased now. So overall, it'll be very interesting to see in Q4 the company's commentary on growth for the next year,
Puneet, let me pause you there. So after this, once we're done with this, I want to also look at the graphic of the March numbers and probably try and break that down before we go across and speak on the interview, because that's what you're talking about. Sorry, please go ahead.
No, definitely. And that's the key aspect, because currently they had penciled in 6 to 8% growth for this year. It's coming at 7%. So definitely meeting guidance, but it's still slower than something what TVS has done. And the threat is, of course, the slower two-wheeler growth. We've spoken about that as well with the management in terms of how next year is shaping up. And the export market, that is currently, we've mentioned that as an opportunity as well. But we've seen increased competition from the likes of TVS. TVS now exports roughly 1 lakh units a month in terms of exports. And that's very close to what Bajaj does. Bajaj is at 1,40,000, 1,50,000, and that it doesn't take too much time for the brand like TVS to increase that aspect as well. So definitely could be a threat, but the opportunity as well as the strength of the brand is something to talk about here.
We spoke with Bajaj Auto's Executive Director Rakesh Sharma, I beg your pardon. Here's what he had to say on the potential challenges for the company going forward. Listen in to a slice of that conversation.
Well, yes, over the last 5-6 months, and if you see, in fact, the entire year, we've sort of come out flattish when you look at volumetric growth. Our approach has constantly been in the market to optimize the top line, bottom line, and our. So therefore, you will see that this year we have achieved a milestone of 50,000 crores at an overall level. And at least in the first 3 quarters, as you know, our EBITDA margins were 20% plus. The final quarter, the financial results are still in the making and will be declared very soon. So that sort of indicates to you that it's not a one-sided approach which Bajaj Auto takes. We have to constantly look at optimizing the bottom line and the top line, as I said. And there have been periods of high demand, but there have been categories where it's been like, almost a red ocean kind of a situation over there, and we have not participated. So yes, in terms of being flattish, it's absolutely correct. In the domestic motorcycles, we have been a little bit flattish, but that's the outcome of balancing the top line and the bottom line.
Fair point, Mr. Sharma, because while I look at the last 6 quarters, your standalone EBITDA margins have been over 20%, so that's commendable. The only aspect for an investor, of course, you mentioned 6 to 8% growth at the start of the year, and you've achieved that as well because of a stronger export market growth, revival in second half of last year. But how should investors look at your share of domestic market growth, because that's been, as you rightly mentioned, it's been a negative for the last 6 months or so. So even the 125cc segment and above, because I think your 100cc segment is 8 to 9% of sales, so the rest 90% is also not growing in the domestic market. So I just want to understand, as a company and as an approach, what is, if you can guide us also, anything to watch out for FY26 also. Do you see the growth being in that 6 to 8% range, or do you see it at the lower end of that range as well?
Well, the 6 to 8%, which I mentioned earlier, and which I would say around 6% is what we would take the industry to be growing at. And we believe that we have, at least over the last 6 to 9 months, put in place a portfolio which should deliver us in the coming months, in the coming year, and a performance which will be higher than that of the industry. FY25 was also a period where the EV business was scaling up. And towards the end of FY25 is when we achieved, we got rid of the negative margins which we were getting in the EV business. And that then allows us a greater degree of freedom to actually balance out growth and profitability. With the substantial EV portfolio being now in the green zone, 25% of our domestic revenues come from the EV vehicle sales, and all that is now in green zone, and that gives us a certain flexibility. So therefore, we feel that given the kind of product portfolio which we have put in, whether it is a CNG based bike or it is the sub-segmented pulsar variants targeted at sub-segments, almost 8 or 9 of them over the last 6 months. They should be able to drive growth. And of course, there are more new products in the pipeline in the coming months.
Point taken, Mr. Sharma. Harsh also joining in. Want to quickly check with regard to where the margin trajectory goes with regard to EV. You mentioned that it's now turned green in terms of EBITDA positive. Talk to us about how quickly does it go and scale the 20% number, because that's the number you're looking at an overall level.
Well, that's quite some time. If you understand the cost architecture and the dynamics, the EV, I'm sure you will understand that for a 20% EBITDA at the EV is.
But sir, that journey, how does it go? So talk to us about FY26. Will it continue to go up in this year as well as in the next year? Is that how you see it?
You see, these things are outcomes of greater growth forces. I cannot sort of bet on it going. Of course, our endeavor is we were in the negative territory. We have now come into the green area, and we will continuously try to increase profitability over there. Like I mentioned earlier, we are optimizing top line, bottom line, and competitive position. All that is being done in the context of a very volatile international environment. To just, give you a number and say that this is exactly what is going to happen is not, it's not correct on my part. I can alert you to the various forces and our intent, but to be definitive about it, I won't sort of go up to that thing. Our intent is, of course, to keep improving the profitability, maintain our leadership, and balance the top line and the bottom line.
Point taken. And sir, PAT positive on both of these individually as well as combined. Again, the outlook there also, my guess is that you'll be non-committal. You're more skewed towards, or rather you're more focused on growth. Is that the right way to think of it?
If I've understood your question correctly, I'm saying that we are balancing growth and profitability with competitive position, and we don't calculate PAT at a business unit level.
So, a quick question with regard to export. Export, you've had a soft month in the month of March. FY26, does growth come back significantly? Of course, FY25 also you've grown decently, let me give you that. But so overall, FY26, what's the growth outlook like? Because each geography has its own set of issues.
Yeah, you're right. And, growth, the structure of growth, whether it is domestic or international, it's such that it is not linear or secular. It is not a straight line. It's more like a snake in the tunnel. We have to be, some quarters will be high double digit and some quarters will be, low single digits. That's just the nature of the markets right now. That's the nature of the construct of it. We have grown by 13-14%. And I would say that unless there is a major disruption, and always we have to put out that caveat when it comes to international markets, we should be clocking a similar kind of a growth rate in FY26.
Mr. Sharma, I just want to talk about the EV segment, because you had a very strong year in terms of the two-wheeler, and that's been highest compared to all your peers. And you are about at 230,000 units sold in FY25. For next year, what is the growth outlook? Because now you have a sizable base as well. I think you're number 3 in terms of overall sales for this year. In FY26, should we expect, firstly, on in terms of performance, any kind of growth? While if you can give anything quantification in that aspect, and on EV profitability, 2 electric 3-wheelers were already profitable a couple of quarters ago on EBITDA. The electric 2-wheeler business is also EBITDA profitable. On PAT profitability of electric 3-wheeler, can we expect that in FY26?
I just said that we don't calculate PAT at a business unit level. The PAT is done at a corporate level, which is a combination of all the 6 business units which we have. The growth prospects for electric vehicles are promising. The industry is growing at about now 20% or so. The subsidies, as you know, have been halved in two-wheelers. We have to see what the impact is, but we think that it will certainly be still at a 15 to 20% growth. Q4, Chetak became number one, and therefore we've got the momentum. We've launched a new platform, which is our 3.5 series. A few more products are in the anvil. The bottom line has turned positive. So things have lined up very well. New products, positive bottom line, industry growing at 15, 20%, which is quite decent. So I think we should be able to outpace the industry again in this segment as well.
That's unfortunately all the time we have on this edition of KYC. From Puneet, myself, everyone who puts this show together, thanks so much for watching. Hope this was productive. And stay tuned to NDTV Profit. More action on the other side.
Whenever a film sank in 2000s, it was always flop actor. मेरी तरफ नहीं देख रहे, देखो तो सही. I compare an actor's career like the stock market. Sometimes your stocks are low, right? And when your stocks are low, no one's buying. Sometimes your movies do well and your stocks are on the rise, and everyone's suddenly buying that stock.
What point do you think that the film career perhaps is not going the way that you thought?
Itch of wanting to be an entrepreneur started itching a little more, and I wanted to scratch it.
One of the most important lessons is to know when to pivot.
The burn was far more than the earn. We were burning and I was watching my money just go out and like, oh my God, what's going on here?
The overhaul of the new tax regime that has kicked in this month means that all of us are going to be paying less tax. But you know what they say, ye dil mange more. Can you potentially save even more? I was talking to someone recently and he said that he'd decided to register his HUF or Hindu Undivided Family for tax purposes. And my first reaction was, why? What advantage does that give you? I started asking around and found that a lot of people are considering this or have toyed with the idea. If you're one of them, or if you don't know what I'm talking about, this episode of MoneyWise is for you. Join me today is Bijal Ajinkya, partner at Khaitan & Company, and CA Nitesh Buddhadev. Thank you so much to the both of you for taking the time. Let me start with trying to understand where this concept emerges from, and obviously the best person in this room to answer is the lawyer. So tell me, where did this HUF concept start?
Okay. Thank you, Alex. So what is very interesting is that the concept of joint Hindu family, firstly, under law, there is no concept of a Hindu undivided family. That's a concept and a construct which is developed under the Indian tax law, which he will surely talk about. And under the Hindu customary law, given the fact that you always had situations where families actually lived jointly and together under one roof, they conducted business together, either by way of energy, by way of capital, etc. To that extent, you had a concept of joint Hindu family property. And it is from there wherein by custom, families worked together to really build in the common hodgepodge. They were taken care of by together, as maintenance, lifestyle, etc. But of course, the question which really arises that is this concept of a joint Hindu family property something which is interesting, important, or beneficial today, or it's really a relic of the past?
And you mentioned that HUF is not something that finds itself in that law. It's not mentioned.
In the Hindu Succession Act of 1956, there's absolutely no mention. What we really refer to as joint Hindu family is really considered as co